Chapter 8, 1995 to 1999. Introduction. The 1995 to 2004 decade was marked by compounding growth. Not only did the headline figures such as revenues, earnings, and shareholders' equity expand, but the sheer number of acquisitions increased noticeably. Berkshire's 1996 acquisition of the second half of Geico and the 1998 acquisition of General Reinsurance supercharged its insurance operations. These two acquisitions were the final two cornerstones of the insurance group, which would see average float balloon to over $45 billion during the decade. Insurance was certainly a dominating force at Berkshire, but its many non-insurance acquisitions further diversified its earning streams. A number of these new acquisitions, such as within the jewelry and furniture retailing segments, resulted from existing industry relationships Berkshire subsidiaries had with non-competitor peers. Some acquisition opportunities manifested suddenly after past troubles caused a need for new ownership. Other times, acquisitions occurred after financial buyers, such as private equity groups only interested in short-term profits, caused the business to falter, and which were revitalized under Berkshire's protective umbrella and conservative financing. Some acquisitions during this period, most notably Mid-American and Mytech, came with additional outlets for cash after they made their own acquisitions. All these acquisitions added to the family tree that was Berkshire, but did not alter the overall structure of the company. The Berkshire Hathaway that ended the decade like the one that began was a conglomerate with many diverse businesses. At the end of the decade, it was just a larger and more rounded-out conglomerate. Insurance was the main engine, followed by its wholly owned businesses and important long-term investments in marketable securities. In order to comply with SEC regulations, Berkshire increased its directorship with 5 new members to its board of directors. In some ways, Berkshire's size finally began catching up with it. Interest rates continued to decline during this period, making idle cash that much more painful to hold and driving up valuations in controlled businesses and marketable securities. The dot-com boom that started in the mid-1990s and continued into the first years of the new millennium did have one silver lining. While others were busy bidding up businesses with no cash flow or long-term prospects, Berkshire picked up numerous old-line businesses with long histories of producing cash. Yet even with these acquisitions, Berkshire ended the decade with over $40 billion of cash and no immediate place to put it to profitable use. 1995. The year 1995 represented the start of Buffett's 4th decade at the helm of Berkshire Hathaway. Oftentimes, executives think about retiring or at least reducing their workload. Buffett reached the typical retirement age of 65 that August, and Munger was already 71, so it was a fair question whether Berkshire's 2 capital allocators would soon slow down. While both were outwardly showing some signs of age, their minds were not. If anything, they were getting better. As Charlie Munger would say at the annual meeting in 1996, Buffett, though this also applied to Munger himself, was a learning machine. Berkshire would benefit enormously by having top managers without any preconceived notions of retirement, allowing their knowledge to compound just like the capital under their control. Defying Buffett's predictions, again, that Berkshire's size would be an anchor to future returns, headline figures for 1995 showed an enormous increase in net worth. After adjusting for shares issued in connection with 2 acquisitions, per-share book value increased an eye-popping 43.1%, compared to the S&P's increase of 37.6%. More exciting were 3 acquisitions that doubled Berkshire's revenue and significantly added to its long-term earning power. During 1995, Berkshire acquired 2 non-insurance companies, Helzberg Diamond Shops and R.C. Willey Home Furnishings, using Berkshire shares, and half of an insurance company, Geico, of which it already owned 51%, using cash. The Geico acquisition technically closed January 2, 1996, so 1995 was filled with discussions about the upcoming event. Helzberg Diamonds. The Helzberg acquisition closed on April 30, 1995. Founded in Kansas City, Missouri, Helzberg grew from one location in 1915 to 134 stores in 23 states by the mid-1990s. In 1994, the company had $282 million of revenues, which was an almost 30-fold increase from the $10 million in revenues it had in 1974, proving Buffett's point that the best strategic plan was no plan. The company arrived on Buffett's radar accidentally when Barnett Helzberg, the company's CEO and the grandson of its founder, saw Buffett on a street corner in New York City and approached him. Helzberg was comparable to Berskhire in that both sold jewelry at rates per square foot far above their competitors, and both had low overhead compared to their competition. But the businesses were different in other respects. For one, Helzberg operated a chain of stores that were predominantly in malls or strip malls. Berskhire was a one-store location that had over $50 million of inventory, a huge selection that couldn't be replicated over dozens of locations. As Buffett put it, Berskhire can't be Helzberg's, and Helzberg's can't be Berskhire, but both were good businesses. It is interesting to note how good returns on capital can be produced in two different ways in the same industry. Helzberg's success stemmed from its rock-bottom operating costs and prime locations in busy shopping malls nationwide. The average Helzberg store had $2 million of annual sales, far more than its competitors. Helzberg's higher sales also produced lower expense ratios compared to competitors. Helzberg was a quintessential Berkshire Buffett acquisition of a good company with great management. For the selling family, it was a tax-free way to diversify their holdings. R.C. Willey. Berkshire's other 1995 acquisition, also completed via a stock transaction, was R.C. Willey Home Furnishings. The R.C. Willey acquisition came about through Irv Blumkin of Nebraska Furniture Mart. Irv Blumkin, Rose Blumkin's grandson, knew R.C. Willey's CEO, Bill Child, and had spoken to both Child and Buffett about the merits of a partnership. Like the Helzberg family, the Child family wished to diversify and take care of estate planning while continuing to run the family business. Berkshire was a perfect fit. As with Helzberg and Berskhire, some differences existed between R.C. Willey and its sister company, Nebraska Furniture Mart, which Berkshire purchased in 1983. Nebraska Furniture Mart, like Berskhire, was Omaha-based and operated out of a campus of adjacent buildings. Both R.C. Willey and Nebraska Furniture Mart had similar sales. R.C. Willey had $257 million in revenues in 1995, but unlike Nebraska Furniture Mart, R.C. Willey operated out of 5, soon-to-be 6, Utah-based locations. Both Nebraska Furniture Mart and R.C. Willey were also retailers, a business Buffett knew to be very difficult. Both were run by managers with long track records of success, a key criterion for Buffett, who told shareholders, "Buying a retailer without good management is like buying the Eiffel Tower without an elevator." Also, just as Nebraska Furniture Mart had a lock on the Omaha market, R.C. Willey had over 50% of the furniture business in Utah. The acquisition was funded by a combination of Berkshire stock and cash. The exact price was not disclosed. Geico. The third and largest acquisition of the year was the second half of Geico, which legally closed on the second day of 1996. Shareholders were very familiar with Geico, which had been on Berkshire's books as a marketable security since 1976. Berkshire's ownership grew from 33% to 51% in that time, owing entirely to Geico's frequent share repurchases. In 1995, the opportunity arose to buy the remaining half of the business. Compared to the $46 million it cost Berkshire to buy the first part of Geico, the $2.3 billion price tag for the remaining portion was enormous. This implied a roughly $4.8 billion valuation for the whole company, or about 2.5 times its year-end 1995 book value of $1.87 billion. The price tag was large, but not exorbitant. Geico had $3 billion of float, and its long history of profitable underwriting meant the float would be profitable and had a high probability of growing. This proved true. At the 1996 annual meeting, a discussion on float and Geico suggested Berkshire got a bargain. Is float better than equity? In response to a question on the intrinsic value of Berkshire's insurance companies, Buffett offered insight into his and Munger's thinking on float. It was and is somewhat counterintuitive, but upon reflection is astoundingly simple and brilliant. Buffett, always one to use extremes to prove a point, posed a rhetorical question. Would I trade that, Berkshire's float, for $7 billion of equity and not have to pay tax on the gain, but then have to stay out of the insurance business forever? His answer was no. We wouldn't even think about it very long. Buffett was saying he would not take a genie in a bottle arrangement to magically transform a $7 billion liability into $7 billion of equity. This should have caused everyone to sit on the edge of their seats. The reason Buffett would not take such a hypothetical arrangement was that he expected the float to grow over time and at an attractive cost. Berkshire's insurance businesses were gems due to one simple fact. An insurance operation is valuable only if its float does not cost it money, or at worst, cost it what it would cost the government to borrow funds, which is cheaper than the cost a corporation would have to pay. Berkshire's insurance businesses were arranged over time and not without some bumps and lessons along the way to deliver cost-free float. Float, a liability to the company, was more akin to equity than it first appeared. If float could grow over time, it would be that much more valuable. This assertion that a liability could be considered equity can be a hard concept to grasp. It helps to think about what pure traditional equity is. Is not the equity owners put or retain in the company a liability due them at some unspecified future date? Does it not come without the requirement to pay interest? Why not then define equity as funds held by a company that have no explicit repayment terms and no explicit cost or interest rate? Following this logic, it stands to reason that the right kind of float can be considered equity, or in some cases better than equity if it generated an underwriting profit over time. Furthermore, such quasi-equity did not dilute shareholders' ownership like a pure equity investment would. Berkshire's float, and especially Geico's, was money owed to policyholders in one form or another, but that, because of its revolving nature, could not be called in its entirety like a loan. In other words, individual policies would be paid daily, but new premiums would be written collectively that could reasonably be expected to maintain the overall level of float. Considering Berkshire had a recent history of writing profitable business and growing float, even under poor pricing conditions, this was an easy argument to make. If we assume that Geico's float would, at worst, break even and not grow, it could appropriately be considered quasi-equity. Adding this quasi-equity to its book equity, we arrive at a purchase multiple of 1 times book value. See Table 6.4. We can also use an earnings approach as a check. This framework results in an initial pre-tax earnings yield that may seem low. Considering this did not account for any expected growth nor any look-through earnings from the investment portfolio, it is worthwhile validation of the $4.7 billion valuation for Geico that Berkshire paid to acquire the rest of the company. Insurance. Underscoring the good year Berkshire had in 1995 was a third straight year of underwriting profit and yet another year of growth in float. All told, Berkshire's insurance operations generated a pre-tax underwriting profit of $21 million, and float increased 18% to $3.6 billion. It is worth highlighting the conservatism embedded in Berkshire's insurance operations, not only on an operating basis, i.e. its unwillingness to accept improperly priced risks, but also on an accounting basis. For more attentive readers, the financial statements contain clues to the margin of safety built into Berkshire's accounting. Berkshire's reported results were better than the headline underwriting gains would suggest due to accounting practices that did not factor in the time value of money. In its structured settlements business and certain reinsurance contracts, payments would be made years or in some cases decades in the future. This meant Berkshire benefited from the use of funds over time. However, the accounting required that all future expected losses, except for structured settlements which were discounted, be booked on an undiscounted basis, that is, up front. It was the economics that mattered most, not the accounting. If any gray area existed, Berkshire would err on the side of conservatism, even if it made results look worse. Conservatism and smoothness are sometimes lumped together, but they shouldn't be. Buffett liked conservatism and was also okay with lumpiness, or uneven results. Berkshire's entrance into the supercat business brought large policies and large, but infrequent, losses. Berkshire at this time was willing to underwrite a $1 billion policy, though it was rejected. The largest policy it wrote was $400 million. Large policies would create volatility, but were also a competitive advantage that led to superior long-term results. Competitors preferred a smoother ride that ensured the safety of their jobs. The reinsurance group wrote and earned higher premiums in 1995, but pricing began to soften as competitors flush with capital looked for business. Unfavorable loss development added $30 million to losses. Accounting charges from deferred charge amortization and discount accretion of structured settlements were also responsible for reinsurance swinging to a loss of $21 million from an underwriting profit of $81 million in 1994. Berkshire's more traditional and less lumpy primary group performed magnificently. National Indemnity wrote to an 84.2% combined ratio. Home state operations turned in an 81.4% ratio, and Central States Indemnity grew volume 23% and underwriting profit by 59%. Buffett had nothing but praise for Ajit Jain, Don Worster, Rod Eldred, Brad Kinsler, and John Kaiser, all of whom Buffett pointed out were under 45 years old. Geico, not yet part of Berkshire, turned in strong results in 1995 that rivaled Berkshire's entire existing insurance operations. Manufacturing, publishing, and retailing. Berkshire's non-insurance operating subsidiaries had a few stumbles during 1995, and Buffett was quick to point them out. "Just tell me the bad news, the good news will take care of itself," was the philosophy Buffett attributed to Munger in what he followed in reporting to shareholders. The shoe business, the Buffalo News, and World Book all had different problems during the year, which led pre-tax earnings for the manufacturing, publishing, and retail businesses to fall 1% to $332 million. Worse, pre-tax return on tangible invested capital fell 11 points to 38% because of higher average capital employed. After-tax return on equity was 26%, down 6%. In the shoe group, comprised of H.H. Brown, Dexter, and Lowell Shoe, pre-tax operating earnings fell 32% to $58.4 million. Buffett told shareholders he thought the problem was cyclical, not secular, and he expected operations would climb back to top-grade earnings in the future. If it was any consolation, Buffett reported that competitors in the industry made only marginal profits or worse. Including the Buffalo News in the troubled category was no surprise to shareholders. Prior reports detailed the long and winding road from losses to profits to current challenges. The paper was still a good business, but it could no longer be considered an economically superior business like some of Berkshire's other gems. Pre-tax earnings declined 14% from the year before as cost pressures weighed on results. These included newsprint costs up 40% in 1 year, employee buyouts, and changes to depreciation schedules. Still, the business was pulling its weight with $47 million in pre-tax earnings, not bad for a business that cost $35 million. World Book was also not a surprise in this group of bad news first companies. Its print encyclopedias continued to struggle against fierce competition from CD-ROMs. Earnings that year plummeted 64% to $8.8 million as the business worked to remain viable in an electronic age, including shifting toward direct distribution channels. If any of the managers at these units were worried, Buffett provided some reassurance to them. "There is not one of them we would replace." Going one step further at the annual meeting, he assured shareholders World Book would not be sold. Sea's operating profits continued to churn higher even as the growing slate of businesses meant it received less attention. In 1995, revenue at Sea's grew 8.1% to $234 million as the company pushed into wholesale and mail orders. Long beset by physical volume declines, pounds of candy increased 7.1%. Same-store sales, an important metric indicating demand from individual stores, was not disclosed. Operating profit increased 6% to $50 million, an incredible 21.1% operating profit margin, and a return on tangible equity likely in the triple digits. Together with the results from insurance, Berkshire's consolidated pre-tax operating income declined a little less than 3% in 1995 to $815 million. This was not a bad result, but it wasn't great either. Buffett's comment that there's no reason to do handsprings over 1995's gains is borne out by this operating result. In fact, most of the 43.1% gain in per-share book value was a result of the rising tide of the stock market pushing up the value of Berkshire's investment portfolio, not intrinsic business growth. Convertible preferred stocks. Berkshire's goal with its 5 preferred stock investments was to do better than fixed income securities available elsewhere. On average, it had done reasonably well. The superior performance of the Gillette issue saved the day and balanced out mistakes made with other investments in this class. The 8.25% convertible preferred issue from Gillette had cost Berkshire $600 million. At the end of 1995, it was valued at over $2.5 billion, owing to the performance of the common shares. This was a very good result, yet a more profitable path was possible. Berkshire would have earned $555 million more if it had purchased all common stock instead of the convertible issue. On the negative side of the ledger, the Solomon Preferred came with its infamous and relatively recent episode of management distraction and a serious risk of loss. The biggest mistake, though, was the U.S. Air Preferred. The airline's prospects looked better in 1995 than they did the year before, but Berkshire was not yet out of the woods. An important aspect to the U.S. Air Preferred is worth mention. The security was structured with a cumulative dividend provision. U.S. Air had stopped paying the dividend owing to its operating troubles, but those skipped dividends were still owed to Berkshire and were compounding at a rate of 5% over the prime rate. The company would have to come out of its woes to pay the monies it owed, but at least Berkshire had some protection as a creditor. 1996. Few CEOs would state that they thought it a good thing that their company's stock price changed little during the year, yet this is exactly what Warren Buffett told shareholders in his 1996 chairman's letter. Buffett and Munger wanted Berkshire's share price to closely track its underlying intrinsic value. During 1995, that relationship became unhinged, and Berkshire's stock price got ahead of its underlying intrinsic value. A year later, its intrinsic value increased significantly and caught up with a slower advancing share price. How Berkshire's business results led to that correction is the story of 1996, but first it is worth examining the numbers behind the ratio. Beginning in the prior year's annual report, Buffett began supplying a table they believed would help people trying to estimate Berkshire's intrinsic value. The table showcased the two-column method of valuing Berkshire. See Table 6.6. It supplied readers with historical data on investments per share and pre-tax earnings per share, excluding all investment income. We can make some reasonable assumptions with that data to come up with an estimate of Berkshire's intrinsic value and, perhaps more important for this exercise, view the change in the price-value relationship. The logical investment framework behind the two-column method is that Berkshire's value stems from its investment portfolio and a capitalized multiple of its operating earnings. It is important to note that especially as it pertains to investments per share, Berkshire's capital structure was conservatively financed. Investments per share could have easily been funded via debt, yet at both year-end 1995 and 1996, Berkshire's borrowings amounted to under 10% of equity capital. Its assets were funded by float, but float was growing and profitable. It was therefore appropriate to ascribe investments per share to value per share. At year-end 1996, investments per share totaled $28,500, compared to $22,088 at year-end 1995. The assumptions behind the capitalized value of operating earnings also deserve some careful thought. Since all assets are in some way tied to the opportunity cost of risk-free investments, it is appropriate to look to the long-term U.S. Treasury rate, in this case the 30-year bond, for comparison. Between year 1995 and 1996, this benchmark averaged 6.5%. Using a 10% discount rate might be appropriate here since it provides a margin above the risk-free rate. The discount rate is important when valuing cash flows. It is the rate at which future cash flows are brought back to the present. Because of the time value of money, $1 today is worth more than $1 in the future, the further into the future cash flows are, and the greater the uncertainty they will materialize, must be considered. Here we'll use a 10% discount rate for simplicity, which implies a multiple of 10 times. Based on this framework, Berkshire's pre-tax operating earnings per share of $421.39 and $258.20 were about $4,214 and $2,582 at year-end 1996 and 1995, respectively. Adding the per-share values of investments and operating earnings, we find that Berkshire's per-share intrinsic value increased by approximately 33% during 1996, but the share price increased just 6% during that time. Berkshire's price to estimated value decreased from a rich 1.3 times to 1.04 times, just about parity. The valuation exercise above also lends to the discussion of the issuance of the new B shares during 1996. At the time, Buffett and Munger said the shares were not undervalued, and their issuance would not decrease Berkshire's per-share intrinsic value. Since the shares were issued at a price just over the year-end 1995 share price, which was at a price to estimate value of 1.3 times, the assertion holds. Flight Safety International. Berkshire's 1996 share count was also affected by the issuance of shares to acquire Flight Safety International, a new operating subsidiary that trained pilots using flight simulators. Berkshire paid a total of approximately $1.5 billion for the company and funded it with 51% cash and the remainder in A and B shares. See Table 6.7. Altogether, 17,728 A shares and 112,655 B shares were issued to acquire Flight Safety. The Flight Safety acquisition came to Berkshire via Richard Server, a shareholder of both Berkshire and Flight Safety, who was familiar with Buffett's annual advertisement for seeking acquisitions. Flight Safety was the result of a lifetime of work by then 79-year-old founder Al Ultshi. Ultshi was an aviator who once piloted for Charles Lindbergh. The company manufactured and operated high-technology flight simulators for pilots of various types of aircraft. The flight simulators were indispensable to aircraft operators since they trained pilots in a realistic environment at a fraction of the cost and, perhaps more importantly, without the risk of operating an actual aircraft. Flight Safety represented a shift in Berkshire's acquisition philosophy. The business was a capital-intensive operation with 41 locations and 175 simulators. The simulators cost up to $19 million apiece to manufacture. Furthermore, they became outdated each time new aircraft were introduced into the market. Balancing out the capital-intensive nature of the business was a huge moat, something Berkshire admired and sought in acquisitions. Since competitors would have to invest tens of millions of dollars for a single simulator, the price of entry was steep. This provided a potential competitive advantage. Flight Safety's long history also gave it knowledge base to build simulators, supply its customers with numerous machines in numerous locations, and work with aircraft manufacturers to more quickly introduce machines for new aircraft. This deep well of knowledge earned it a joint venture with Boeing and a government contract through Raytheon. Analyzing Berkshire's acquisition of Flight Safety, we can conclude it was a fair price for a good company. Berkshire's effective purchase price, deducting excess investments on the balance sheet, resulted in a going pre-tax return of 8.7%. This seems very low at first glance, and it is, but Berkshire would benefit from Flight Safety's historical returns on capital and the moat protecting those returns. Any future growth the company might achieve, if anywhere near its historical returns on capital, would more than make up for the low initial return. On top of this, the company came with a passionate founder-manager. That he was 79 years old only endeared him to Buffett even more. An observer might conclude from our hiring practices that Charlie and I were traumatized early in life by an EEOC bulletin on age discrimination. The real explanation, however, is self-interest. It's difficult to teach a new dog old tricks, Buffett wrote. Like Mrs. B at Nebraska Furniture Mart, Ultshi was still on top of his game. Kansas Bankers Surety. Berkshire's other, much smaller acquisition of 1996 provides another lesson in business moats. Kansas Bankers Surety, per its name, wrote insurance policies for banks. It provided directors and officers insurance, excess deposit insurance for depositors above the FDIC limit, and other related areas of coverage. Due to its relatively small size, KBS was tucked into Wesco's insurance operations. The business was run by Don Toll and had just 13 employees. The lesson in Kansas Bankers Surety was that its relatively small size and limited opportunities for growth were the source of its competitive advantage. This sounds counterintuitive, but it's straightforward after some examination. The business required intimate relationships with hundreds of bankers, a process that takes time to build. With a limited number of clients and relatively slow turnover in bank executives, gaining an edge on Kansas Bankers Surety was hard. It was in a class of wonderful businesses that had natural size limit, but which generated a lot of surplus cash flow. Berkshire was more than happy to be a home to such a business. Insurance. Berkshire's insurance operations fell into two broad categories. The reinsurance group included the super catastrophe lines, or supercat, the relatively plain vanilla reinsurance business of taking on the risk entered into by primary insurers, in addition to the structured settlements business. The primary group encompassed everything from National Indemnity's specialized auto line and home state companies to the workers' compensation business. Geico, now a wholly owned subsidiary of Berkshire, fell squarely into the primary category. Owing to its size, Geico's operations were more than 10 times that of Berkshire's other primary lines combined. Geico was reported separately. Berkshire's insurance group, now led by Geico, was hitting on all cylinders. The overall result for the group was a pre-tax underwriting gain of $222 million on earned premiums of $4.1 billion. Aided by Geico, Berkshire's float nearly doubled from $3.6 billion in 1995 to $6.7 billion in 1996. Insurance, reinsurance. Berkshire earned $758 million in reinsurance premiums in 1996 and wrote to a 101% combined ratio. The segment was greatly aided by the supercat business, which turned in an underwriting profit of $167 million on earned premiums of $268 million. This was the third straight year of significant supercat underwriting gains, which prompted Buffett to warn that the ride would be bumpy despite expected satisfactory results long term. What you must understand, however, is that a truly terrible year in the supercat business is not a possibility, it's a certainty. The only question is when it will come. He even advised shareholders to reduce their estimates for Berkshire's earnings during years of above-average profitability when calculating Berkshire's intrinsic value. While the policies Berkshire wrote in 1996 were large, they were not unreasonable compared to his capital position. Buffett thought a worst-case after-tax loss from a true mega-catastrophe to be around $600 million, less than 3% of Berkshire's book value and easily absorbed by earnings from its other businesses. Berkshire could do better than its peers over time by striving to underwrite each deal profitably and letting results fall where they may, rather than attempting for a smooth outcome each year. Indeed, Berkshire's reinsurance business model could be described as profiting from the desire of other insurers to smooth their underwriting experiences in an uncertain world. Berkshire had three major competitive advantages in the supercat business. 1. The marketplace. Berkshire had a reputation of having the capital to pay its claimants and paying them fast, even under the very worst of circumstances. 2. Price and timing. Berkshire would always have a great willingness to write business at the right price. When times became tough, other reinsurers might pull back from the marketplace. Berkshire's reputation was now such that it was earning standby fees from other reinsurers. This gave the reinsurers comfort that Berkshire would write them a policy if others wouldn't. 3. Large policies. Berkshire had the ability and willingness to write large policies. Buffett and Berkshire's insurance whiz, Ajit Jain, stood ready to commit to evaluate risks, price coverage, and respond to his customers very quickly. Perhaps demonstrating how open the insurance business really was, Buffett wrote that Berkshire tried to price our supercat exposures so that about 90% of total premiums end up being eventually paid out in losses and expenses. Berkshire's advantage was that it was willing to walk away from risks it didn't understand. Others relied on computer models that offered a false sense of comfort. Some direct writers were unknowingly the biggest supercat writers. Companies writing business in certain geographic areas, such as on Long Island, might have the most risk. A single large hurricane could cause wind damage to an entire portfolio of claimants diverse in all ways except their geographic exposure to one large, infrequently occurring risk. They don't think of themselves as being in the supercat business, but they are very exposed. The other half of Berkshire's reinsurance operations, making up $490 million of earned premiums in 1996, was the property and casualty, excess of loss, and quota share business. This line was more straightforward and less volatile than the supercat business. Though the segment turned in an underwriting loss of $101 million in 1996 and a similar-sized losses in prior years, these were long-tail type policies that produced a significant float for Berkshire. When priced appropriately, they would produce satisfactory results over time. Insurance, primary group. Berkshire's legacy primary lines, its bread-and-butter insurance businesses, produced excellent results. On $268 million of earned premiums, the group turned in a combined ratio of 78.2%, good for an underwriting profit of $59 million. Buffett singled out the managers responsible for producing this achievement for Berkshire: Don Worster at National Indemnity, Rod Eldred of the Home State Operation, John Kaiser at Central States Indemnity, and Brad Kinsler, who ran the Workers' Compensation Group and expanded it into 6 new states during 1996. Insurance, Geico. Berkshire's new gem, Geico, run by Tony Nicely on the underwriting side and Lou Simpson on the investment side, also received well-earned praise. Buffett was clearly excited about its prospects. There was nothing complicated about Geico, but its advantages were huge. Geico's competitive advantage stemmed from being the low-cost operator and using a direct-to-consumer business model among competitors entrenched in a broker model. In 1996, Geico's customers referred 1 million others to the company, which produced better than 50% of its new business. The savings on acquisition expenses were then passed on to customers in a virtuous cycle. Employees at Geico, from Nicely down, focused on 2 metrics: growth in voluntary policies in force, and the profitability of seasoned business on the books for more than a year. It was a very simple operating philosophy: bring in more customers and make sure those that stayed were profitable. This incentive structure formed the basis of all bonuses at Geico. The 2-part structure was carefully designed to maximize the benefit for Geico's owners, now Berkshire Hathaway shareholders. By focusing on the profitability of seasoned business, the underwriting part of the equation sought to ensure Geico was pricing its product appropriately for the long term and rejecting unprofitable risks. Because it excluded customer acquisition expenses associated with bringing in new business, which hurt profitability in the short term, the structure incentivized actions that built long-term value. This allowed for liberal spending to drive future results of the business. As simple as this incentive structure was, Geico's competitors, and especially public companies, followed other paths. Beholden to the short-term thinking of Wall Street, these companies often put near-term earnings first and sometimes starved their marketing budgets. Geico's path from being the 6th or 7th largest auto insurer in the country to being one of the largest was the result of its long-term strategy. It is worth noting that Simpson, Geico's longtime investment manager, remained on to manage Geico's investment portfolio after the merger. This said a lot about how highly Buffett viewed Simpson's investment prowess. With every other insurance acquisition, Buffett had taken over the investment part of the equation and left the managers to focus on the underwriting side. In 1996, Geico's first year under the Berkshire roof wholly owned, it wrote to a 94.5% combined ratio, producing an underwriting gain of $171 million pre-tax. Manufacturing, publishing, and retailing. The manufacturing, publishing, and retail segment continued impressive operations. Earning $378 million pre-tax in 1996, the group produced a pre-tax return on invested capital of 30%. In isolation, it represented a great result, but it marked a sharp decline from the 38% return earned in 1995 and the 49% result in 1994. Deteriorating profitability in the shoe group over the past few years explained part of the decline. The addition of capital-intensive flight safety explained the drop in 1996. Most of the businesses in this category continued to contribute as they had in the past. A few business units are worth highlighting. While the going was still tough at World Book, the business had made some progress. It was now the only direct seller of encyclopedias after Encyclopedia Britannica stopped its business line. World Book also partnered with IBM and invested heavily in a new CD-ROM product. Pre-tax operating earnings at the unit grew 43% to $12.6 million, but remained below the $25 million profit earned in 1994. Operating earnings at the Buffalo News grew 7.7% to $50.4 million. The gain was partly because the prior year had higher one-time charges due to employee severance costs and certain depreciation adjustments. The current year benefited from lower newsprint costs, which came back down after skyrocketing in 1995. The shoe group saw profits increase 5.5% to $61.6 million, but they remained far below the $86 million earned just 2 years before. Management successfully capitalized on opportunities to market and distribute product and lower overhead costs. More profits were expected in the coming year. Helzberg, Berkshire's newest jewelry acquisition, stumbled during 1996 and brought jewelry profits down 18% to $28 million. Increased expenses in anticipation of a large revenue increase that never materialized caused the disappointment. Buffett said CEO Jeff Comment was addressing the expense problem in a decisive manner and that he expected increasing earnings in 1997. U.S. Air Update. The saga of Berkshire's investment in U.S. Air preferred stock continued. Only this time it was news to the upside. Despite the many mistakes Buffett admitted making with the investment, there was one bright spot. The preferred stock included an unusual provision stipulating penalty dividends, 5 percentage points over the prime rate for payments that were in arrears. Since U.S. Air had skipped 2 years of preferred dividend payments due to operating troubles, this provision was triggered. The regular 9.25% dividend was now closer to 14% for the last 2 years. This penalty provision gave U.S. Air an incentive to pay the amount in arrears. Buffett praised company CEO Stephen Wolf for working to right the ship, while he asserted that U.S. Air still had basic cost problems that must be solved. Wolf's actions saved Berkshire's investment such that Buffett now thought it worth its $358 million par value. Not one to bask in glory, Buffett admitted to twice trying to unload the U.S. Air stock, first in 1995 and again in early 1996. Both efforts failed. Buffett told shareholders after the second attempt, "You're lucky. I again failed in my attempt to snatch defeat from the jaws of victory." The Walt Disney Company. In March 1996, the Walt Disney Company acquired Capital Cities ABC in a cash and stock transaction. The deal was born of a meeting between Michael Eisner of Disney and Tom Murphy of Cap Cities ABC at a Sun Valley retreat. While Buffett attributed the meeting to his influence, he later said that he thought the deal would have eventually materialized on its own. Berkshire received a total of $2.5 billion, of which $1.2 billion was in Walt Disney stock, which Berkshire retained, and the remainder in cash. The event caused a $2.2 billion realized gain. Salomon debt issue. During 1996, Salomon Brothers, Berkshire's go-to investment bank, sold an unusual security for Berkshire. The security was a $500 million 5-year debt issue that was convertible into shares of Salomon stock owned by Berkshire. Responding to a question about the issue at the 1997 annual meeting, Buffett noted that it's a way of taking capital out of that block of stock at a low interest cost to use elsewhere, while retaining a limited portion of the upside in the Salomon stock. With stocks generally trading at elevated levels, Berkshire was again taking advantage of favorable financing opportunities, independent of any immediate need for capital. Investment lessons. Buffett provided some explicit words of wisdom for investors in his chairman's letter and the annual meeting. He stressed the advantages of a low-cost index fund, which he thought would over time beat the great majority of investment professionals. Addressing attendees at the annual meeting, he said investing is the only field in the world where the amateur, as long as he recognizes he's an amateur, will do better than the professional. Buffett frequently pointed to his own shortcomings and limitations with respect to investing. He thought investors wanting to strike out on their own and construct their own portfolios should clearly define their circle of competence and stick to it. You don't have to be an expert on every company, or even many, he wrote shareholders. Your goal as an investor should simply be to purchase at a rational price a part interest in an easily understandable business whose earnings are virtually certain to be materially higher 5, 10, and 20 years from now. These companies were rare, so investors should load up when they found one. Buffett pointed to Berkshire's own look-through earnings, which had risen in tandem over time with Berkshire's stock price, as an example of his counsel in action. The best part about investing was that it was cumulative. Buffett had studied many businesses for years, even using flight safety as an example of one he read about for 20 years before learning enough to purchase it. All it took to be knowledgeable about many businesses and industries was time and an interest in continual learning. Compounding knowledge would lead to compounding money. Class B common stock issuance. Up until 1996, Berkshire Hathaway had only one class of common equity. Buffett's unwillingness to split the stock to cultivate and maintain a certain shareholder base meant its shares were priced significantly higher than the average issue. Companies typically split shares to keep prices in the affordable range of $20 to $100. Berkshire's shares had never been split, and its per-share price, over $33,000, reflected that fact. This caused some problems for shareholders wishing to make gifts, but the problems were surmountable. The 1996 proposal to issue Class B shares was a defensive move on Berkshire's part. It was partly to protect potential investors and partly to protect Berkshire's reputation. Berkshire had successfully foiled many plans to create a unit trust stocked solely with Berkshire shares by appealing to the promoters of the trusts. Now it seems someone was ignoring those pleas, and at least one trust might be created. The potential unit trust would buy Berkshire shares on the open market and then sell shares in the trust to prospective investors wishing to buy less than whole shares of Berkshire common stock. Buffett and Munger thought such a proposal would harm investors in two ways. First, through the fees that would cause the investment to lag that of true Berkshire shares. Second, the incentive to grow those fees would cause the promoter to market the trust by promoting the high rate of return which had been achieved in the past, but which Buffett said was not repeatable. There was also the issue of supply and demand. The unit trust would have a fixed number of shares. Heavy promotion might cause the price to exceed the value of the underlying Berkshire shares. Investors would do worse than the underlying Berkshire shares as the discrepancy corrected itself over time. The high expectations of such a Berkshire unit trust investment could also harm Berkshire and Buffett's reputation. If purchasers of such a trust bought in at a high price relative to the underlying Berkshire stock, its performance would surely be disappointing over time. Even if Berkshire were not to blame, which it wouldn't have been, the negative association would remain. To thwart the promoters, Berkshire devised a plan to create a subclass of shares that would represent direct ownership, but at slightly disadvantageous terms. The newly created B shares would be priced at 1/30th of that of an A share, the original share class, but they would have voting rights of just 1/200th of the A shares. Further, only the A shares would be eligible for the charitable contributions program. In this way, there would be a slight advantage to owning the A shares, but the newer B share investors would still be owners of the company. Berkshire went even further to temper expectations and take the idea of a unit trust off the table. Guided by basic economics, Berkshire stated that it would issue as many shares as investors wanted. This would eliminate any possibility of outsized demand from temporary excitement, since Berkshire would just issue new shares to satisfy demand. Additionally, the A shares would be convertible at the option of the holder into 30 B shares, but the privilege would not go the opposite way. If B shares traded higher than the equivalent A shares for some reason, arbitrage would ensure the differential would not become too great. An investor could buy A shares, convert them to B shares, and then sell them at a higher price. The parts would be more valuable than the whole. Lastly, Berkshire publicly stated, including in the prospectus offering, that both Buffett and Munger did not think Berkshire was undervalued at the issue price and that they were not interested in purchasing shares at that price. Some shareholders thought this meant Berkshire was overvalued. Buffett made clear that should not be inferred. He said saying that Berkshire was not undervalued was not the same as saying it was overvalued. Based on Berkshire's book value at the end of 1995, the new shares would have valued the company at over twice book value. When the actual issuance was completed, the expected $100 million offering was oversubscribed. Berkshire ultimately ended up issuing 517,500 new B-class shares, which brought in just under $565 million. With no immediate plans for the money, Berkshire put it into the pool of capital available for other opportunities. Munger put the new shares in context. At about 1% dilution, he said the creation of the B shares was a non-event. Berkshire shareholders, not surprisingly, voted at the 1996 annual meeting to approve the B share issuance. The Berkshire Unit Trust idea never resurfaced, and Berkshire's reputation and shareholders were unharmed. The complete language of the offering, vastly different than anything typically found on Wall Street, is worth reading in its entirety. Warren Buffett, as Berkshire's chairman, and Charles Munger, as Berkshire's vice chairman, want you to know the following and urge you to ignore anyone telling you that these statements are boilerplate or unimportant. 1. Mr. Buffett and Mr. Munger believe that Berkshire's Class A common stock is not undervalued at the market price stated above. Neither Mr. Buffett nor Mr. Munger would currently buy Berkshire shares at that price, nor would they recommend that their families or friends do so. 2. Berkshire's historical rate of growth in per-share book value is not indicative of possible future growth. Because of the large size of Berkshire's capital base, approximately $17 billion at December 31, 1995, Berkshire's book value per share cannot increase in the future at a rate even close to its past rate. 3. In recent years, the market price of Berkshire shares has increased at a rate exceeding the growth in per-share intrinsic value. Market overperformance of that kind cannot persist indefinitely. Inevitably, there will also occur periods of underperformance, perhaps substantial in degree. 4. Berkshire has attempted to assess the current demand for Class B shares and has tailored the size of this offering to fully satisfy that demand. Therefore, buyers hoping to capture quick profits are almost certain to be disappointed. Shares should be purchased only by investors who expect to remain holders for many years. 1997. The stock markets continuing their upward trend, Buffett likened Berkshire's 34.1% per share increase in book value to a rising tide. He said Berkshire was the duck, and even though its gains beat the S&P by 0.7 percentage points, it was more attributable to luck than business acumen. This is not to say Berkshire did not make important gains during 1997. Buffett estimated intrinsic value increased in tandem with book value. Using the two-column method in our arbitrary, though consistent, 10 times multiplier on pre-tax operating earnings, we can calculate that Berkshire's intrinsic value grew about 38%, which is close to a 34% increase in book value. See Table 6.9. Buffett made sure to temper any enthusiasm. Berkshire's supercat business again experienced no major claims, and Geico had an unusually good year. Additionally, a rising stock market was making it harder to find good values there. He said prices were high and, if we swing, we will be locked into low returns. Buffett knew the value in waiting for the fat pitch, but found some things during 1997 to keep himself out of trouble. Unusual commitments. For Buffett, keeping himself out of trouble meant finding market inefficiencies to exploit. This involved 3 unusual investments: oil contracts, zero-coupon U.S. government bonds, and silver. The first was an investment in futures positions for 14 million barrels of oil. This was the remainder of a contract established in 1994 and 1995. The total profit from 45.7 million barrels of oil for those years created $62 million of profit for Berkshire. The second was the purchase of $4.6 billion, at amortized cost, of U.S. Treasury zero-coupon obligations. Paying no interest, they were a significant bet on a downward move in interest rates. The bet risked looking foolish if rates rose, but the odds were judged favorable. At year-end 1997, this bet was working out to the tune of almost $600 million. The third investment was in silver and proved the remarkable power of staying true to simple economic concepts. In this case, supply and demand. Berkshire had a position of 111.2 million ounces of silver at year-end 1997. Buffett and Munger invested in silver because they thought the world's supply and demand equation had gotten out of whack and that a higher price would be necessary to resolve the discrepancy. Buffett stressed that inflation played no part in the calculation. The logic was this. The world at that time used about 800 million ounces of silver each year, with 500 million ounces being produced and another 150 million ounces being reclaimed annually. A 150 million ounce shortfall existed. Since inventories were low, the demand would soon outstrip supply and cause a rise in price. There was an important nuance to this investment, and it highlighted the concept of inelasticity. Very simply, inelasticity in economics refers to the degree to which a given thing is price sensitive. Since the supply of silver came largely as a byproduct of mining other metals, its supply was price inelastic. This meant that no one was out there prospecting simply for silver. Supply of silver was based on the fundamentals of other metals. More demand did not induce additional supply. The demand side also had some inelasticity. Silver was used in photography and jewelry, but demand for silver was not overly sensitive to price. Combine these factors and it created a situation that clearly favored an upward price shift eventually. Like other investments, Buffett knew the if, but not the when. Charlie Munger pithily dismissed the investment at the 1998 annual meeting as being something that Buffett patiently studied for decades, only to invest 2% of Berkshire's assets. In other words, it was not something to be excited about because it wasn't going to move the needle at Berkshire. Compared to Berkshire's multi-billion-dollar investments in Coke, Gillette, and others, it really was a non-event. Still, for our purposes, the investment is interesting and instructive. Insurance. Aided by several positive factors, the insurance group hit it out of the park in 1997. Insurance earned almost $4.8 billion of premiums and wrote to an underwriting gain of $462 million before tax. Insurance Reinsurance Group. With no super catastrophes in 1997, $283 million out of $310 million of catastrophe excess of loss premiums fell to the bottom line as profit. But the possibility of losses materializing in any given year were meaningful, and they were certain to occur at some point in the future. With an enlarged capital base and appetite for new deals, Berkshire was willing to suffer a $1 billion loss without any discomfort. Berkshire had confidence in its pricing of risks and knew that over time the odds would be in its favor. Losses in other property casualty lines of $73 million and $82 million in losses from retroactive reinsurance and structured settlements brought the reinsurance group gain down to $128 million. While the lack of loss experience, catastrophes, and ensuing expensive damage claims in SuperCat was a near-term positive, it did bring unwelcome consequences. The insurance industry had long suffered from the ebbs and flows of capital coming into the industry during times of small losses, only to retreat when large losses came. The budding threat was now a new financial instrument dubbed catastrophe bonds. Buffett disliked catastrophe bonds, but not because they represented competition. He disliked them primarily because he thought they would likely be sold to unsophisticated buyers. Buffett defined them as investors, using quotes to suggest they were not informed buyers. The word bond would induce prospective buyers to associate them with the safety inherent in traditional bonds, such as those sold by corporations or governments, when in fact they were really an instrument designed to circumvent state laws, preventing unlicensed insurance activity. He also called them an Orwellian misnomer because they were not like a bond at all. They were more like a mispriced layer of insurance. Whereas a true bond requires the issuer to repay the debt using income and is usually backed by assets, these were more like reinsurance and put the greater risk on the purchaser. This is how it worked. Investors put up money to back a pool of risks. If no risk materialized, the investor would receive a payment. Unlike a traditional bond, however, if a loss event did occur, the bond capital was used to make the issuer whole, leaving the bondholders empty-handed. Like other kinds of capital influx, lower volumes were expected in the years ahead. Insurance, Geico. Geico, already a shining gem, shone brighter than ever in 1997. After a record-setting 10% growth in 1996, Geico, led by Tony Nicely, rocketed to 16% growth of in-force business in 1997. Geico turned in an underwriting profit of $281 million, up 64% from the previous year. The resulting 91.9% combined ratio reflected Geico's low-cost operation and generally favorable conditions industry-wide. Using the same two-pronged compensation arrangement focused on growth in policies in force and the profitability of seasoned business, 10,500 Geico employees shared a $71 million bonus pool that amounted to almost 27% of base salaries. For Geico, an underwriting gain of over 8%, while not unwelcome, was too high. Targeting a 4% gain, meaning a combined ratio of 96%, Geico planned to cut its rates in the coming year. Geico would do better over time, passing the benefits of its low-cost operation back to customers to drive future growth. It planned to spend over $100 billion on advertising in the coming year to capture some of the $115 billion market. Huge potential to grow Geico's 3% market share. Insurance, primary group. Berkshire's other primary lines wrote to a 15% underwriting profit during 1997. Premiums earned increased 17% from the prior year and reflected the progress of the many smaller but excellent insurance subsidiaries in that group. Manufacturing, publishing, and retailing. Berkshire's financial reports reflected its growth. Insurance, including investment income, made up 78% of pre-tax operating earnings, up from 65% in 1994, so it was natural that more information was added to each segment as time progressed. The business in the non-insurance segment, by contrast, increasingly made up a smaller portion of the growing conglomerate. Consequently, certain businesses were lumped together for reporting purposes, but that didn't make them any less valuable. Together, these businesses earned 32.8% on average invested capital, up from 29.6%. Both Kirby and World Book were combined into one line along with the Scott Fetzer Manufacturing Group. Together, Scott Fetzer made up just 7% of Berkshire's consolidated pre-tax operating earnings in 1997. The Scott Fetzer finance operation remained a separate line item. The newly reconstructed Scott Fetzer, excluding finance, reported a 2% decline in pre-tax earnings to $119 million. Most of the other non-insurance operating businesses did better in 1997 than in 1996. An exception was the shoe group. Reflecting overall industry weakness, sales volumes declined 12% at Dexter, which was struggling against a tough retail environment that included imports. The company planned a new marketing strategy using global advertising. Pre-tax earnings from the shoe group declined 21% to $49 million. Sears was the bright star that never seemed to dim. In 1997, the business grew revenues 8.2% to $269 million. Long struggling with declines in pounds sold, the year saw a 5.5% increase in poundage. The reason is unclear. Perhaps it was the legions of shareholders returning home with memories of their candy indulgences during the annual meeting who helped increase quantity and mail order volume at Sears. In any event, Sears was finding ways to increase its unit volumes while continuing to implement annual price increases. It is interesting to compare Flight Safety's, Berkshire's first admittedly capital-intensive acquisition, to Sears. See Table 6.11. Looking solely at operating margins, one might conclude by the 7.5 percentage point difference that Flight Safety was the better business. Here the lesson of capital intensity comes into play. While Flight Safety generated a larger profit margin on revenues, its capital requirements were similarly large. Flight Safety had 19 times the assets of Sears, but generated only 50% more revenues. The greater operating margin at Flight Safety did not make up for the company's low level of revenues compared to its capital employed in the business. As a result, Sears enjoyed a spectacular 65% return on assets compared to just 7% at Flight Safety. Sears did not possess the ability to reinvest that Flight Safety enjoyed. This illustrated one of the many trade-offs in business. Sears generated excellent returns on capital but had no place to put their earnings except distributing them to Berkshire. Flight Safety, by contrast, could reinvest larger sums but at lower rates of return. Berkshire welcomed and needed both businesses. Star Furniture and International Dairy Queen. Another year, another acquisition. In 1997, Berkshire agreed to acquire Star Furniture and Dairy Queen, though the latter closed in early 1998. Buffett recommended how Irv Blumkin of Nebraska Furniture Mart and later Bill Child of R.C. Willey had both identified Star as a well-run furniture store. When Melvin Wolfe and his sister Shirley Tooman decided to sell the family business, they reached out to Salomon Brothers, who in turn introduced them to Buffett. Not long after, a deal was made to purchase the 12-store Texas-based furniture business. The price was not disclosed. International Dairy Queen was a bread and butter, burgers and fries really, operation fit well within the Berkshire family of businesses. When Berkshire Hathaway agreed to purchase the company in 1997, it had 5,792 Dairy Queen locations. It sold hamburgers, fries, and ice cream, among other similar offerings, and operated in 23 countries. The International Dairy Queen parent also operated 409 Orange Julius and 43 Caramel Corn franchise locations that sold other treats. In addition, there were 190 treat centers that combined some or all three of those brands. Most locations were franchised. Dairy Queen had a troubled history. After some years of operation that saw a jumbled mess of varying franchise agreements and too much debt, a Minneapolis group purchased the business in 1970. In 1997, one of the two owners died, and his estate sought to sell the business. The International Dairy Queen deal was structured similar to Flight Safety acquisition. A combination of cash and Berkshire stock was offered, with the cash portion slightly richer to induce sellers to choose that over stock. Despite this nudge, only 45% of Dairy Queen shareholders chose cash. The total purchase price was $587.8 million, and the merger closed on January 7, 1998. See Table 6.12. Like Berkshire's other acquisitions during this period, it paid a premium price for a company earning very good returns on capital. International Dairy Queen was a different economic model from McDonald's, a stock Berkshire previously owned and sold. While both companies were, and are, franchisors, McDonald's owned and operated about one-third of its locations and owned the underlying real estate of most locations. By contrast, International Dairy Queen operated a few of its locations, but was mostly a franchisor. That arrangement made for a relatively small investment in capital compared to McDonald's. International Dairy Queen treated its franchisees fairly with a franchise fee of 4% of revenues, which was at the low end of the spectrum for the industry. Under a section of his 1997 letter entitled A Confession, Buffett wrote that the International Dairy Queen and Flight Safety type acquisitions made with Berkshire shares had cost shareholders money. He was clear that such value-detracting moves were not due to the underlying companies, but instead because Berkshire's existing group of businesses were so great. He used a baseball analogy to demonstrate his point. Trading any player for a 350 hitter was a good idea in most cases, except when it was at the expense of a 380 hitter. His point was that Berkshire already had a star roster filled with wonderful businesses. Issuing Berkshire stock in any future acquisition meant trading away a small percentage of the ownership of these wonderful businesses. For this reason, Buffett wrote that, "You can be sure Charlie and I will be very reluctant to issue shares in the future." Even though it was flagged as a mistake, Buffett did not say Berkshire would stop issuing shares. Instead, Berkshire would offer splits such as that used in the International Dairy Queen acquisition that encouraged cash over stock. The stock-type deals would remain, but as an option in the cases where sellers desired stock as a currency. Investments. While usually changing at the speed of molasses, the Berkshire investment portfolio was not immune to some fluctuations. The inevitables, a word Buffett coined in 1996 to describe those companies destined to do very well over time, were still there. Berkshire had 49 million shares of American Express, 200 million shares of Coke, 1.7 million shares of the Washington Post, and 6.7 million shares of Wells Fargo. In addition, Berkshire still held its 64 million shares of Freddie Mac and 48 million shares of Gillette. All told, the $7.2 billion cost common stock portfolio had a market value of $36.2 billion at year-end 1997, with Coke making up almost 37% of it. The next largest was American Express at 12%. The listed securities, those with a market value over $750 million, totaled 8 in name and represented almost 88% of the portfolio. Included in the top 8 was a new name, Travelers Group Incorporated. Berkshire's 23.7 million shares of Travelers were as a result of the merger of Salomon with Travelers that netted Berkshire common and preferred stock. The architect of the Travelers' deal was Sandy Weill, whom Buffett praised as a great manager with a proven record. Such comments provided an answer for why Berkshire continued with the investment. Responding to a question at the annual meeting about Coke, Buffett provided some remarkably candid insights into his and Munger's thinking on the investment. The question was whether and how to include the periodic gains reported by the company via its sales of bottlers. Buffett said he completely ignored such gains and instead focused on two variables. The two important elements in value in Coke are unit case sales and shares outstanding, he said. Looking forward a decade or two, if one thought, which presumably he did, that Coke would be selling multiples of its present volume and the number of outstanding shares were expected to go down, the company was a repurchaser of its own shares, it was as far as you needed to go in analysis. Of course, there was more to that conclusion, including the knowledge of the superiority of Coke's worldwide distribution system. At the end of the day, these two variables remained and told a compelling story. No wonder Coke made up over 1/3 of the portfolio. In addition to disposing of the McDonald's investment, Berkshire also trimmed its holding in certain larger positions, including Walt Disney, down 12% to 21.6 million shares, Freddie Mac, down 0.5% to 64 million shares, and Wells Fargo, down 8% to 6.7 million shares. In total, about 5% of the beginning value of the portfolio was sold and shifted into fixed maturity investments, including increased holding in treasuries and other government securities. One noteworthy category of bonds largely missing from the mix were corporates. At year-end 1997, the portfolio contained just a $35 million allocation, largely unchanged from 1996. On the whole, Berkshire's 1997 investment portfolio was comprised of $10.3 billion of fixed maturity investments and $36.2 billion of equity securities. The resulting stock-bond split was 78 to 22. This compared to the 1996 portfolio with $6.4 billion in bonds and $27.8 billion in equities, a split of 81 to 19. Buffett thought the equity market was at such a level that little to no margin of safety existed at current prices. If interest rates remained where they were or fell, and if returns on equity remained high, as they were in late 1997 and early 1998, then markets would not be overvalued. Judging by Berkshire's actions, Buffett seemed to be leaning toward a judgment of overvaluation. 1998. Normally, a gain of 48.3% would call for handsprings, but not this year, Buffett wrote to shareholders in his 1998 chairman's letter. After several years of such talk, Berkshire delivered average annual gains in per-share book value of 39% over the prior 4 years compared to 31% for the S&P 500. Shareholders might again dismiss this as Buffett being Buffett, but this year really was different. Berkshire did find sensible things to do during 1998, especially against a backdrop of an ever more expensive stock market, but the per-share gains in book value were not as good as they looked. The gain in 1998 was mostly due to issuing shares to make business acquisitions. For someone who had written just a year earlier that it was a mistake to issue shares in prior acquisitions, 1998 was a veritable spending spree with shares. So why did Berkshire do it? Presumably, Buffett and Munger thought their simple test had been met. In these cases, Berkshire received as much in value as they gave by issuing new shares. During the year, Berkshire acquired 3 new businesses. The International Dairy Queen merger at the beginning of January, discussed in the 1997 section, Executive Jet, and Berkshire's largest acquisition to date, General Reinsurance, sometimes referred to as General Re. Because these deals all involved issuing above-book value shares of Berkshire, the transactions instantly increased per-share book value figures. What wasn't instantaneous was a change in per-share intrinsic value if equal intrinsic value was given as received. Berkshire's per-share intrinsic value did increase during the year, but it was well short of the gain in book value per share, and therefore not a cause for celebration. Continuing to use the two-column method, see Table 6.14, Berkshire's intrinsic value increased an estimated 16%, far short of the change in book value. 2 items in the 1998 analysis deserve extra attention. One is the fact just discussed that Berkshire's book value increased along with the issuance of shares. If we presume a one-to-one exchange of value, this had the effect of decreasing the proper price-book multiple necessary to arrive at Berkshire's intrinsic value. This decline was probably less than the change shown in the table due to the second factor. General Re reported a loss in 1998, which depressed Berkshire's operating earnings. Had Berkshire not acquired General Re, operating earnings would have increased slightly. General Reinsurance Corporation. Berkshire completed the $22 billion acquisition of General Re on December 21, 1998, issuing 272,200 A-equivalent shares for the company. It was by far Berkshire's largest acquisition to date. General Reinsurance was, as its name suggested, a reinsurance business. The name General Re was technically the parent company that conducted professional property and casualty reinsurance under the names of General Reinsurance Corporation and National Reinsurance Corporation, the largest such outfit in the United States. General Re also owned an 82% interest in Cologne Re, a major international reinsurer and the oldest in the world. Through Cologne Re, General Re also reinsured life and health insurers. Why was Berkshire interested in acquiring General Re? The answer required a word previously anathema to both Buffett and Munger: synergy. The reasons were laid out in the press release announcing the acquisition. 1. Many investments. General Re would almost double Berkshire's investment portfolio with its $24 billion or $80,000 per A share equivalent issued. 2. Expansion of General Re's ability to write business. Earnings volatility would not factor into underwriting decision-making, as was the case when it was a public company. 3. The ability to expand internationally. 4. Tax considerations. Berkshire's large base of taxable earnings outside of reinsurance would allow General Re to maximize the value of its investment portfolio. 5. Abundance of capital. Berkshire's large capital base would allow General Re to operate unconstrained and write any business that made sense. The merger was summed up as follows. These synergies will be coupled with General Re's pristine worldwide reputation, long-standing client relationships, and powerful underwriting, risk management, and distribution capabilities. This combination virtually assures Berkshire and General Re shareholders that they will have a better future than if the two companies operated separately. General Re was like Berkshire's homegrown General Re was like Berkshire's homegrown reinsurance business in that it was paid for absorbing the volatility of other insurers. It was unlike Berkshire's existing insurance business in that it was publicly held. Publicly held companies are praised for their smoothness, which goes against the nature of reinsurance. Under Berkshire's umbrella, General Re could take on more volatility, assuming it was properly priced, and live up to its potential. Hidden risk would soon come to light, but this potential was the basis of the acquisition. Buffett also thought highly of General Re's management team. CEO Ron Ferguson was offered a position on Berkshire's board of directors, but he declined. Like Berkshire's other acquisitions, Ferguson will be left alone to run his business, although General Re's investment portfolio would now be under Buffett's direction. Cologne Re would remain as it was prior to the Berkshire acquisition, with its portfolio managed as before. Some figures illuminate the size of General Re's operations. As evident in the $22 billion price tag, its business was large, see Table 6.16, compared to the Berkshire Hathaway Reinsurance Group, which wrote just $1 billion in premium volume during 1998 and earned slightly less. General Re was huge. In 1998, General Re wrote and earned about $6.1 billion of premium volume across three main reporting lines. The largest, at about $2.7 billion, or 44% of its premiums, was the North American property casualty segment. International property casualty followed at $2.1 billion, or 35%, and the life health division wrote and earned about $1.3 billion, or 21% of General Re's volume. General Re's $370 million underwriting loss in 1998 was the one apparent blemish. This translated into a combined ratio of 106.1%. The company's long-term track record of success told a better story. Over the prior 50 years, General Re stood out for its nearly break-even combined ratio of 100.4%. though this included the most recent 5- and 10-year track records averaging 101%. General Re brought with it approximately $14 billion of float. This tripled Berkshire's float in 1 year's time to $22.8 billion at year-end 1998. To acquire this float, Berkshire paid a premium of 1.57 times the $22 billion price tag versus the $14 billion of float for General Re. Float, as Buffett noted many times, could be very valuable, especially if it grew and or came at a lower negative cost. But General Re's large float came with a near break-even cost, and Buffett did not expect it to grow very much. There were the synergies laid out in the press release, but could these facts alone justify the purchase price? Paying up for a business like Geico with its profitable and rapidly growing float made sense, but why pay such a premium for what seemed to be average quality float? The answers might lie within the valuation of the Berkshire currency at the time. In other words, Berkshire's share price. The merger was completed late in 1998, but the price was established mid-year based on an average closing price over a 10-day period. At the time, Berkshire was trading at over $80,000 per A share. Even conservatively estimating Berkshire's intrinsic value using the year-end 1998 figures, which includes General Re, book value grew mid-year and year-end, it appears the shares issued in the merger were overvalued by as much as 54%. Adjusting for this overvaluation, we can conclude the price paid for General Re was not as rich as at first glance. This is consistent with Buffett's comments that as much intrinsic value was given as gained. One last item is noteworthy with respect to General Re. The acquisition brought analysis attention to Berkshire because of General Re's institutional shareholder base. One of those analysts was Alice Schroeder, who later wrote The Snowball, the only authorized biography of Buffett. Schroeder, then an analyst at Payne Webber, wrote a research report on Berkshire that Buffett praised greatly. The analyst's attention would also provide a benefit for Berkshire, or at least Buffett, in that they could field calls from institutions or others about Berkshire. Since Berkshire had no investor relations department and Buffett wanted a level playing field between all investors, i.e. no special meetings with him even for large shareholders, the few analysts that now covered Berkshire were a plus. Berkshire Hathaway Reinsurance Group. Berkshire's existing reinsurance operations swung to a $21 million loss on earned premiums of $939 million, down 3%. Super Cat premiums declined 8% to $286 million, but another year of low loss events left a $155 million profit. Losses from other property casualty business totaled $86 million, and retroactive reinsurance and structured settlements recorded underwriting losses of $90 million. Geico. Geico once again simply shot the lights out. Those were Buffett's words of praise in his 1998 chairman's letter. Even after reducing pricing on average 3.3% to lower its underwriting profits to its target level of 4%, favorable weather conditions and lower accident severity led Geico to deliver big for Berkshire. Premiums written were up 16% over 1997, and Geico's underwriting profit of $269 million, or 6.7% of premiums, remained too high. Additional price cuts will be necessary in 1999. Geico brought in 1.3 million new voluntary auto policies during the year, which took total policies in force to over 3.5 million. The growth in new policies, together with the outsized underwriting profit, produced great results for Berkshire and for Geico's 9,313 associates. Geico paid out a record $103 million, or almost one-third of base salaries and bonuses, to its employees. This was the highest on record for the company. Not slowing down one bit, Geico planned to spend $190 million on advertising in the coming year to spur growth. The campaign was working. Market share had risen from 3% to 3.5% in 1998. Berkshire Hathaway Primary Group. Berkshire's other slate of insurance businesses continued slow yet below-the-radar success in 1998. The group earned $328 million in premiums and turned in a combined ratio of 94.8%. This myriad group that formed Berkshire's foundation now accounted for just a fraction of its total volume given the General Re acquisition. As small as they were individually or even collectively, they were still an important contributor to Berkshire. This was especially true given their ability to generate negative cost float. Since the General reacquisition did not close until very late in 1998, its 1998 underwriting loss did not materially affect Berkshire's consolidated insurance results. In all, including the 10 days of General Re's results, and largely due to Geico, Berkshire's insurance group reported a pre-tax underwriting gain of $265 million, another year of cherished negative cost float. Investments. The General Re merger moved Berkshire's investment portfolio even heavier into bonds, a direction Berkshire was purposely heading. Changes in 1997 took Berkshire's bond allocation from 19% of its $47 billion portfolio to 22%. General Re maintained a higher concentration of bonds, and Berkshire requested that it dispose of its 250 stock equity portfolio prior to the merger. Post-acquisition, Berkshire's investment portfolio grew to $61 billion with a 35% allocation to bonds. There were some important changes in the composition of the bond portfolio year over year. Most notably were higher exposures to foreign governments and a more meaningful investment in corporate bonds. There were also some meaningful changes to the equity portfolio during 1998. The elimination of McDonald's was discussed earlier, which in hindsight Buffett regretted selling. Buffett also reduced or eliminated smaller positions and added to American Express, buying an additional 1.08 million shares. With stock markets reaching new heights in general and tech fever raging, Buffett and Munger received several questions at the next annual meeting about investing in dot-coms. Why, some asked, if Buffett so admired companies such as Intel and Microsoft, hadn't Berkshire invested in technology? Buffett reiterated his philosophy. He and Charlie looked for businesses about which they could be fairly certain of their 10 to 15-year prospects. Technology companies didn't pass through that filter. Buffett said that in 1998, just 400 companies in the United States earned $200 million a year after tax. Yet there were many internet companies with no such earnings being valued on the same basis as some long-established and profitable enterprises. That math just didn't work out, he said. In the end, they have to succeed as businesses. This sound explanation did not stop other shareholders from prodding Buffett about his reluctance to change his ways. Fortunately for Berkshire shareholders, both he and Munger were comfortable owning basic, boring businesses. After all, a dollar earned in technology operation was worth the same as one from an old-fashioned business. Change may be exciting for speculators and good for the citizenry at large, but it was a threat to long-term investment returns. Executive Jet. The newest non-insurance subsidiary joined Berkshire in August 1998. Executive Jet was the third company acquired with the issuance of shares in 1998 following General Re and International Dairy Queen. The purchase price of $700 million required half to be paid with Berkshire's shares. Unfortunately, we cannot readily determine the valuation Berkshire placed on Executive Jet because its results were not detailed separately. Executive Jet was a simple business. The company sold fractional interest in various aircraft, which were then managed by the company for use by its multiple owners. These fractionally owned aircraft supplemented the fleet of company-owned aircraft that Executive Jet could have available on short notice. The company was founded by Rich Santulli, who Buffett credited with creating the fractional ownership industry in 1986. Although both Executive Jet and Flight Safety were classified into the same flight services category, the businesses had important differences. Whereas Flight Safety was a capital-intensive business requiring significant upfront investments in simulators, Executive Jet was a capital-light operation. An aircraft's owners, whether a single owner or multiple owners, put up the capital to buy the plane. Owners also paid Executive Jet a monthly management fee and a fee to cover hours flown. Owing to the capital-light nature of the business and its advantages over direct ownership of single planes, Buffett was enthusiastic about the business. He had started using the service prior to owning the company. After buying Executive Jet, he even sold the Indefensible, Berkshire's own corporate plane. The company had real growth prospects, and adding more owners and planes would drive costs down as deadhead time, planes flying empty to pick up passengers, was reduced. In addition, More planes across the country meant shorter wait times for customers. Already, the company accounted for 31% of all corporate jets ordered in the entire world. Executive jet was half of the flight services category, flight safety and executive jet. This category earned $181 million and represented 10% of Berkshire's 1998 pre-tax operating income. Manufacturing, service, and retailing. If there was any question about the diminished relative importance of other businesses in this category, the word publishing was replaced by service in the segment header beginning in 1998. Flight services was mostly in a league of its own among Berkshire's non-insurance businesses, with its 10% of pre-tax operating earnings. The only other non-insurance business to earn as much was the collective of Berkshire's finance and financial products businesses. Within the now manufacturing, service, and retailing businesses, only Scott Fetzer, including its finance operations, came close at 7% of Berkshire's total. Scott Fetzer earned $137 million pre-tax, up 15% from a year before. Its after-tax profits of $96.5 million was an astounding 86% return on its $112 million of net worth. Also mentioning, not for its size but its 22% increase in earnings, were the jewelry businesses, which earned $39 million. The Buffalo News had another tough year and earned $53 million, down 5%, and See's increased its earnings by 5% to $62 million. Finance and financial products. The inclusion of General Re's finance subsidiary in Berkshire's finance and financial products segment brought Berkshire's operation in this area back to the forefront, and with it a Wall Street-esque look to the balance sheet due to its complexity. Previously, the balance sheet primarily comprised borrowed funds, annuity liabilities, and equity, which financed interest-bearing receivables and investments. It now included securities marked to market, trading securities, and repo securities, among others. While some of this complexity would wind down over time, as it stood, the segment had a portfolio containing huge notional amounts of securities. The interest rate and currency swap agreements were largest at over $500 billion, $514,935 million of notional value. The balance sheet had $88 billion of options written and $90 billion of options purchased, in addition to significant futures and forwards contracts. While all of this netted against each other to a more modest $6.2 billion of trading account assets liabilities, it posed significant hidden risk for General Re and for Berkshire. Accounting lessons. Buffett took no less than 3 pages of the 1998 chairman's letter to rail against the accounting abuses committed by corporate America. Using General Re as an example, he wrote that the acquisition put a spotlight on an egregious flaw in accounting, namely that Berkshire would replace General Re's option plan with an economically equivalent cash plan. Since options had not been counted in the income statement, Buffett told readers that the proxy statement describing the merger contained a $63 million adjustment to correct for this fact. Buffett said that he and Munger made similar revisions to the earnings of the public companies they followed. It wasn't uncommon for the adjustments to reach a very meaningful 5% or 10% of earnings. In some cases, such adjustments were the difference between purchasing a stock or passing on a purchase. Restructuring charges were another sore spot. Companies would lump in all sorts of adjustments into one quarter, which would then be explained away and ignored by analysts. Even more egregious, such maneuvers sowed the seeds for future so-called earnings when charges were reversed. Such accounting machinations were the result of a hyper-competitive environment with CEOs eager to please Wall Street and auditors that blessed such arrangements. Not surprisingly, both Buffett and Munger thought such practices despicable. Buffett lauded SEC Chairman Arthur Levitt for going after such abuses and urged shareholders to read a recent speech on the subject. As for Berkshire, Buffett would tell it as it is. Regular readers of his shareholders' letters would know that Buffett was telling the truth. If anything, Buffett took too many pains to point out his and Berkshire's shortcomings. Perhaps Berkshire was the better for it. 1999. The underperformance that Buffett had long predicted finally came true in 1999. Berkshire's gain in book value per share, Buffett's preferred, if only rough proxy, increased 0.5% compared to an increase of 21% for the S&P 500. Buffett told shareholders that 20.5% underperformance was the worst of his career and that he deserved a D for capital allocation. Still, Berkshire did have some bright spots during the year, including the completion of an acquisition and the arrangement of two more. The poor performance stemmed from a couple of different spots. The first was a lackluster performance by the marketable securities portfolio. Poor operating performance of the underlying companies caused their stock prices to decline, in turn impacting Berkshire's book value. The price declines were also likely exacerbated by the internet fever still gripping the country. The Nasdaq Composite rose fivefold between 1995 and 2000, but only for companies investing in technology stock. Berkshire had made no such investments. Additionally, mistakes at General Re, Berkshire's new reinsurance subsidiary, led to a large underwriting loss that caused a corresponding pre-tax operating loss, excluding investment income. Insurance. Berkshire reported its first loss from insurance underwriting since 1992. General Re contributed most of the $1.4 billion pre-tax loss, but weakness in other areas played a part. Berkshire's 5.8% cost of float approximated long-term U.S. government bond rates at the time. General Re. During 1999, mistakes of the past finally caught up with General Re. The reinsurer had significantly underpriced its business in both domestic and international markets. Buffett hinted that the culprit might have been the compensation structure at General Re and its majority subsidiary Cologne Re. Those structures were changed. At both companies, incentive compensation plans were now directly tied to the variables of float growth and cost of float, the same variables that determine value for owners. Yet even with perfect hindsight, Buffett said he'd make the same deal to acquire General Re. Just how bad were the 1999 results at General Re? On earned premiums of $6.9 billion, General Re recorded an underwriting loss of $1.2 billion, a combined ratio of 117.1%. General Re's results fell into three main components. North American property casualty, a pre-tax underwriting loss of $584 million on $2.8 billion of earned premiums, combined ratio of 120.6%. Reason for the loss? Inadequate premium rates, higher losses, and unfavorable loss development. International property casualty, a pre-tax loss of $473 million on $2.3 billion of earned premiums, combined ratio of 120.2%. Reason for the loss? Losses on a motion picture insurance contract, catastrophe losses resulting from European winter storms, earthquakes in Taiwan and Turkey, and a hailstorm in Australia. Global life health, a pre-tax underwriting loss of $127 million on earned premiums of $1.7 billion, a combined ratio of 107.4%. While the global life health line at General Re was a relative bright spot during 1999 in terms of financial results, it bore the stain of a past mistake. Its 1998 underwriting loss was largely the result of the Unicover affair. According to an industry article written in 2014 by future CEO Tad Montross, participants in Unicover, a pool of life insurers, sold dollar bills for 50 cents via their hugely underpriced reinsurance of the policies. At the annual meeting, Buffett praised General Re for being one of the first to record the expected future loss, whereas some others had punted the loss recognition into future years. In a rare lapse, General Re had strayed from its circle of competence and was hurt, but Buffett thought it learned its lesson. Berkshire Hathaway Reinsurance Group. Berkshire's homegrown reinsurance operation, created and run by Ajit Jain, also posted an underwriting loss during 1999. Here things were a little different, as the loss largely reflected the expectations of volatility of results over time in reinsurance. The group continued to write large covers, and in 1999 it wrote $2.4 billion of premiums and earned just about the same, including a $1.25 billion from a single contract. The group's overall underwriting loss of $256 million pre-tax included a $220 million loss from a single aggregate excess contract, a type of reinsurance contract that produces a lot of float, but with one large upfront loss during the fourth quarter of the year. Other non-catastrophe losses totaled $135 million, and retroactive reinsurance reported a loss of $97 million. With a profit of $196 million, the Supercat business reported yet another year of gains. Berkshire Hathaway Primary Group. The direct or primary lines continued their understated success. Though premium volume slipped 20% to $262 million, the group wrote to an underwriting profit of $22 million, up 29%. In his letter to shareholders, Buffett praised Ron Eldred, Brad Kinsler, John Kaiser, Don Toll, and Don Worster for collectively earning $192 million in pre-tax underwriting profit over the preceding 5 years. Geico. Geico was still Berkshire's shining star, even if not as bright as the prior 2 years. Those years saw outsized profitability industry-wide, driven by lower accident rates and few to no catastrophe losses. Accordingly, Geico's combined ratios of 91.9% and 93.3% in 1997 and 1998 respectively were too low. In 1999, it returned to earth at 99.5%. Part of the reason for the return to a normal combined ratio were the effects of the higher claims and reduced pricing on the loss ratio. The other part of the equation was Geico's discretionary spending on advertising for customer acquisitions. Geico might only need to spend $50 million to maintain its policy count, but instead spent $242 million to grow its business in 1999 and expected to spend up to $350 million in 2000. Buffett said CEO Tony Nicely's foot is going to stay on the advertising pedal, and my foot will be on his. Buffett was willing to commit $1 billion a year to advertising if it would result in new business at an attractive cost. They didn't, in part because media rates were up and each additional dollar of advertising had a diminishing return. Geico added 165 million new voluntary auto policies in 1999, bringing the in-force count to over 4.3 million. Its premium volume grew accordingly, and so did its float, up 10% from 1998 to $3.4 billion. It was around this time that Geico introduced the gecko, as Geico is often mispronounced gecko. The tiny green happy creature told people, "My job is to save people money. I love my job." His job was also to attract new customers, which made Geico a lot of money. A closer look at Geico's 1999 underwriting gains shows this. Included in underwriting expenses are all costs associated with running the business, including advertising. Included in underwriting expenses are all costs associated with running the business, including advertising. Excluded is losses and loss expenses. At 19.3% of premiums earned, underwriting expenses were about the same as the year before, but they would have been another 4 points lower without such heavy advertising. At other auto insurers, and especially publicly traded ones, growth spending might be held back to report higher profits. Geico, Berkshire, and Buffett were squarely focused on the future. This meant trading current reporting profits for a chance to capture a greater slice of the overall market. Geico's share was 4.1%, a cycle that would repeat successfully in the future. Jordan's Furniture. Jordan's Furniture found a new home at Berkshire Hathaway on November 13, 1999, in an all-cash transaction. Berkshire now owned what Buffett considered the 4 best furniture retailers in the country. The other 3, Nebraska Furniture Mart, R.C. Willey in Utah, and Star Furniture in Texas, had all told Buffett about Jordan's. Buffett hinted about this in previous annual reports without naming Jordan's. Now he could talk about it freely. Buffett said Jordan's had the highest sales per square foot in the country and was the largest furniture retailer in Massachusetts and New Hampshire. Jordan's was operated by Barry and Elliott Taleman. Their grandfather started the family business in 1927. Jordan's grew by turning shopping into an entertainment experience with soda, cookies, ice cream, and even an IMAX movie theater on site at some locations to augment the shopping experience. In later years, they would again lead the way by adding indoor rope courses, therefore attracting families for every reason but furniture shopping. Upon selling the family business to Berkshire, the Talemans provided bonuses to longtime employees. They used $9 million of the sale proceeds to give each employee 50 cents for each hour they had been with the company. Each of Berkshire's furniture stores was the dominant furniture retailer in its geographical market. Together they were a furniture retailing powerhouse with revenues nearly $1 billion annually. Including Jordan's from the time it joined Berkshire in late 1999, Berkshire's Furniture Group reported $917 million in revenues for the year and $79 million of pre-tax operating profit. Neither the purchase price nor Jordan's earnings were publicly disclosed. Manufacturing, service, and retailing. Viewed as one business, the manufacturing, service, and retailing businesses earned $444 million pre-tax in 1999, which represented a return on capital of 26.7%, down 4.4 points. After tax and with modest leverage, it translated into a respectable 21.5% return on average equity. Most businesses performed well in 1999, but others struggled. The Shoe Group again reported a decline in pre-tax operating profit, down 52% to $17 million. Dexter was to blame. Its U.S.-produced product was badly impacted by imports. Over 90% of shoes came from outside of the U.S., where they had the advantage of low-cost labor. To compete, Dexter was making more shoes overseas. See's Candies again found success in its wholesale and mail order program, bringing total poundage up 7.2% over the prior year. Sales topped $306 million, up 6%, and a strong operating margin of 24%, up 2.5 percentage points, led to a 19% gain in pre-tax earnings to $74 million. As profitable as See's was, the business faced few growth prospects. Speaking at the annual meeting the following year, Buffett noted how See's, and candy in general, really wasn't that portable. See's found ways to increase its physical volume slightly, but there weren't huge opportunities for growth like other businesses. For some reason, candy didn't travel well. Soda and shaving blades did, but See's couldn't just open a store in faraway state and expect to have the same results. It was tried more than once. Berkshire's jewelry operations increased pre-tax earnings by 31% to $51 million, as costs at Helzberg were brought under control. Scott Fetzer's earnings increased 7% to $147 million. The aviation services segment, comprised of flight safety and executive jet, collectively earned $225 million in 1999, up 24% from the year before. Part of the increase in earnings was because Executive Jet was acquired in August 1998, so it wasn't a true comparison. The other factor was the ability of the businesses, particularly flight safety, to invest in profitable growth. Flight safety was a capital-intensive business but had a high operating margin that translated into satisfactory returns on capital. Its pre-tax return on capital was consistently in the mid-20% range prior to Berkshire's acquiring it. Each flight simulator required up to $15 million capital investment and could only be used by one person at a time. Together, Flight Safety and Executive Jet spent $323 million on capital expenditures in 1999, compared to depreciation of just $77 million. The sky was the limit for these two Berkshire subsidiaries. Investments. Berkshire's equity portfolio returned low single digits against the backdrop of the S&P 500, marching forward 21% during the year. Another way to view this performance is via look-through earnings. We can make an approximation based on the $464 million in dividends reported by the insurance group. This probably represented the bulk of dividends Berkshire earned, as most of its marketable securities were held in the insurance subsidiaries. On top of that, Berkshire's major investees had look-through earnings of $707 million. Together, this amounted to $1.2 billion, or 3% of the average portfolio value. Berkshire's bond portfolio also contributed to the lackluster performance of its investment portfolio. At year-end 1999, unrealized losses on the $30 billion bond portfolio had grown by $1.1 billion. A sharp rise in interest rates was the culprit. The 10-year Treasury increased from 4.7% to 6.5% from December 1998 to December 1999. Fortune magazine article. Included with the 1999 annual report was an article Buffett penned for Fortune magazine in November 1999. In it, he laid out his case for why the market was setting itself up for disappointment. While not predicting an immediate decline, Buffett hinted toward the market being overvalued. He cited a survey of investors at that time who expected annualized returns of over 22% for lower experienced investors and as high as almost 13% for more experienced ones who had more insight into markets. He said both were probably too optimistic. To make his point, Buffett used what he always did, logic. Looking at the Fortune 500 overall, the companies earned $334 billion in 1998. The market value of those same 500 companies as of early 1999 was about $10 trillion. This meant that if one hypothetically owned the entirety of those companies, they would be earning a return of something like 3.3% pre-tax. And this wasn't counting the frictional costs of moving in and out of stocks as investors did, which Buffett estimated to be about $100 billion a year. In early 1999, the 10-year U.S. Treasury note yielded between 1 and 2 percentage points higher than that 3.3%. Why would investors rationally own a group of risky companies when they could buy a risk-free government security? Likely because investors thought stocks would keep going up as they had in the past. A more rationally sounding, though not entirely rational, argument was the belief that either interest rates would decline or corporate profits would increase. Only under those two circumstances would the stock valuations in 1999 make sense. Buffett believed many company valuations were out of touch with reality. He discussed valuations at the 2000 annual meeting, traveling back in time to make his point. The first investment primer that I know of, and it was pretty good advice, was delivered in about 600 BC by Aesop. And Aesop, you'll remember, said, "A bird in the hand is worth two in the bush." He meant that investing involves deciding based on the projected value of a business in the future. Value in this case is calculated by estimating how many birds, how much cash, are in the bush. The value of that cash is further based on when it emerges and the interest rate at that time. Some companies were valued by the market as high as $500 billion, yet produced very little actual earnings. If such a company wasn't going to pay an owner $50 billion that year, assuming a 10% required rate of return, then it had to pay out that much more the next year. Assuming no payment in year one, a $55 billion payout in perpetuity was required starting the following year. Wait another year and that annual payout rose to $60.5 billion, and so on to justify the 10% of return. Recalling Aesop again, Buffett said that every year one waited to take out a bird, cash, and that many more birds, cash, were required in the future. And how certain are you there are that many birds available to take? This short lesson was important because it explained the rationale behind preferring companies earning cash today, since the longer one waited, it became that much more important to grow the future stream of cash. It also highlighted the importance of certainty. If you weren't going to get cash immediately, how much worse was it that the future cash flows were uncertain because of the risk to changing business economics? Lastly, the preceding example using a hypothetical $500 billion market cap company would have been the rare elephant, given the requirement to earn something like $80 billion a year pre-tax to get that $50 billion after tax. Since such companies didn't then exist, and even now in 2020 are rare, valuations were clearly incorporating some unrealistic expectations. As painful as 1990 was from a business perspective, with book value up just 0.5 percentage point, Berkshire Hathaway's stock price also took a big hit. Shares traded between a low of $52,000 and a high of $81,100. Considering Berkshire ended the year with $47,000 of per-share investments, the market was almost entirely discounting Berkshire's significant operating businesses. Even though operating earnings fell, Berkshire remained a wonderful, growing collection of businesses. Its long-term growth in per-share book value over the preceding 35 years that Buffett had been in control remained an astounding 24% compounded annually. Year 2000 issue. The big worry as the calendar turned to the new millennium was the so-called Year 2000 issue, or Y2K. The problem lay with computers and their ability to handle the turn of the millennium with respect to dates. No one knew if, for example, January 1st, 2000 would register as January 1st, 1900. Such a mistake could cause havoc with systems as calculations would be 100 years off, spelling disaster for timing and payment systems, for one. Berkshire incurred roughly $60 million in costs, not all in 1999, getting ready for the date change. Even though everyone knew the year was coming, some, including governments, were far behind in their preparations and testing. In the end, it was all hype. Berkshire entered the new century and the new millennium with old-world businesses in hand and a readiness to acquire more. Chapter 9, 2000 to 2002. 2000. At the turn of the millennium, Berkshire's two capital allocators faced unrelenting pressure to change their ways. With internet mania fueling the dot-com boom, Berkshire was decidedly old world and proud of it. Experienced managers Warren Buffett and Charlie Munger, now both in their 70s, stayed within their circle of competence. They and Berkshire shareholders were rewarded for this patience. The year 2000 brought some exciting acquisitions along with some spots of trouble. Checkbook in hand, Berkshire went on a spending spree. It paid close to $8 billion for 8 acquisitions, completing 2 agreed to in 1999, Mid-American and Court, discussed below, and arranging another 6. To make things better, almost 97% of the amount spent was in cash, and Berkshire incurred no debt in the process. Despite this frenzy of acquisition activity, Berkshire remained flush with investable funds and ready for more and larger acquisitions. Finding 8 new operating subsidiaries to acquire in just over a year was most assuredly cause for a change in Buffett's self-graded D from 1999, though not the A star people would flaunt to parents. Buffett characterized 2000 as only decent due to some struggles in its existing businesses. Geico had their rare off year, weaknesses remained at General Re, and Dexter struggled mightily against foreign competition. To make matters worse, Buffett thought Berkshire's equities portfolio was fully priced, meaning its value would likely not rise beyond underlying gains in intrinsic business value. Acquisitions. Our acquisition technique at Berkshire is simplicity itself. We answer the phone, Buffett wrote to shareholders. He wasn't kidding. Buffett and Munger had long talked about their strategy of not having a strategy, and the year of 2000 was proof it was working. Like business results in general, acquisitions were necessarily lumpy and could not be anticipated or rushed along. Did Berkshire's capital allocators cave and purchase some fallen internet companies? Quite the opposite. Buffett reported that Berkshire had embraced the 21st century by entering such cutting-edge industries as brick, carpet, insulation, and paint. Try to control your excitement. Though these businesses were the very antithesis of internet companies, the dot-com boom and subsequent bust did play a role in Berkshire's acquiring them. 2 factors led to this flurry of acquisition activity. One was the prospect of a near-term economic slowdown. Other people were reluctant to commit in the face of uncertainty. Berkshire was buying to keep and had its eye on the horizon. The second factor was that Berkshire paid with cash and analyzed businesses on an all-equity basis. Other purchasers relied on financing from the junk bond market, which had dried up. Number 1. Mid-American Energy. Acquisition date, March 14, 2000. Description: provider of electric service in the Midwest U.S. and the United Kingdom. Purchase price, $1.24 billion for 76% of the company. Mid-American was more than an energy business. It was a conglomeration of numerous energy subsidiaries. Like its new conglomerate parent, Mid-American had a long history and decentralized operations. Mid-America's lineage is too long to discuss here, but its history just prior to joining Berkshire is worth mentioning. Mid-American Energy Holdings Company was the result of the 1998 acquisition of a company of the same name by Cal Energy, an Omaha-based utility company. The new company was renamed Mid-America Energy Holdings Company and reincorporated in Iowa. Mid-American's chairman and CEO David Sokol and his right-hand man, President Gregory Abel, along with investor and board member Walter Scott Jr., used this base to acquire other energy assets. The Mid-American deal came about via Walter Scott Jr., who also sat on Berkshire's board of directors. Mid-American's talented and entrepreneurial management team impressed Buffett, and he thought investing in Mid-American might make sense at the right price. Buffett was cited in a press release saying, "We buy good companies with outstanding management and good growth potential at a fair price, and we're willing to wait longer than some investors for that potential to be realized. This investment is right in our sweet spot." Buffett did not detail his exact thought process in determining the attractiveness of the Mid-American investment, but there are a few factors that likely weighed into his decision. History as a low-cost operator. In addition to achieving the highest returns available under regulatory frameworks, the low-cost operator could protect and reinforce its competitive position by keeping rates low for its customers. This in turn could gain favor from regulators, allowing additional investment. Deregulation. This opened certain markets to allow customers to buy energy from the producer of their choice. A low-cost operator would have additional opportunities for expansion, aided by its ability to improve the assets it acquired. A strong balance sheet. Mid-America's investment-grade credit rating allowed it to lower its cost of debt and thereby improve its ability to keep costs low for customers. It was a virtuous cycle. Even with the prospect of wider deregulation, Mid-American remained an operator in regulated markets, most notably in the Midwest United States. During 1999, 66% of Mid-America's revenues were generated in regulated electric markets, 25% from regulated gas, and 9% from non-regulated businesses. Energy companies within the regulated markets enjoyed protected returns on capital that were typically in the low double-digit area. For example, Mid-America's Iowa operations were allowed a 12% return on equity. The downside of a regulated return was offset by the ability to invest in large sums of capital. Mid-America offered Berkshire Hathaway a place to direct the substantial excess earnings from its other businesses into long-term projects with a near certain rate of return. At a time when Berkshire was finding little else to do with a growing amount of cash, Mid-American was a fitting solution. One final attribute of Mid-American relates to taxes. Here, Berkshire could benefit in two ways. One was via a consolidated tax return. Berkshire's vast collection of highly profitable operating businesses generated a significant tax bill that could potentially be offset by Mid-America's tax position, which sometimes included tax credits. A standalone energy business might not have the ability to use favorable tax positions immediately if its taxable income was not high enough. The second tax-related attribute of Mid-American was deferred taxes. Mid-American had substantial investments in fixed assets. The acceleration of depreciation allowed for tax purposes resulted in the company paying less tax than the income statement indicated. Mid-America's ability to defer taxes was like the interest-free loan Berkshire created via its holding of appreciated securities. It allowed the company to have a higher effective compounding rate on its equity capital than even the regulated rate of return would suggest. It should be noted that regulators would take these tax advantages into account, which allowed the tax advantage to be passed along to customers. Mid-American's unregulated businesses would benefit from it, however. A regulatory restriction barring simultaneous control of regulated and non-regulated entities required a unique ownership structure for the Mid-American deal. Berkshire paid $1.24 billion for common stock and non-dividend paying convertible preferred stock, giving it a 76% economic interest in Mid-American. See Table 6.19. Its voting interest, however, was just 9.7%. Additionally, Berkshire invested $455 million in an 11% fixed income security and committed to invest another $345 million under the same arrangement. Because of this arrangement, Berkshire reported Mid-American's results on one line on its income statement and balance sheet. Instead of reporting all its sales, expenses, and other costs, Mid-American was carried on the balance sheet in the amount of Berkshire's investment and on the income statement as Berkshire's share of its net income. What were Buffett's financial expectations surrounding the Mid-American acquisition? We cannot know for sure, though the regulated return limits and the 11% fixed income security provided some clues. Using financial information for 1999, the last year Berkshire purchased its ownership interest in the company, Mid-American's pre-tax return on capital was 11%. Was this a coincidence? Perhaps. The analysis was probably much simpler. Mid-American provided Berkshire a platform to invest large sums at low double-digit returns. An added bonus was the tax benefit from joining Berkshire's conglomerate holding structure. Considering its position as a low-cost operator and its monopolistic position in certain markets, the company had a strong likelihood of earning similar returns far into the future. In other words, Mid-American was protected by a moat. 2. Court Business Services. Acquisition date, February 18, 2000. Description: renting furniture to businesses and apartment owners via its 117 showrooms. Purchase price: $386 million. The Court Business Service acquisition began in 1999 but closed in 2000. See Table 6.20. The opportunity materialized after an unfriendly takeover by one of its competitors failed to go through. Buffett liked the fine though unglamorous business, its CEO, Paul Arnold, and the price, established via the failed deal amount. Berkshire purchased Court via Wesco, its 80% owned subsidiary. Wesco's chairman, remember, was Charlie Munger. Munger summed up the deal succinctly in his 2000 letter to Wesco shareholders. Thus, in essence, Wesco paid $386 million for $54.3 million in pre-tax operating earnings. Berkshire paid a premium over the company's underlying capital, but its going-in return was satisfactory at 11%. Additionally, it had the prospect of earning good returns on incremental capital going forward if Court could continue to grow. In short, it appears Wesco and Berkshire acquired a good company for a fair price. 3. U.S. liability. Acquisition date: August 8, 2000. Description: insurance. Purchase price: undisclosed. Half cash, half stock. Augmenting Berkshire's already large slate of insurance businesses, U.S. Investment Corporation, USIC, was the parent company of U.S. Liability, a medium-sized, highly respected writer of unusual risks, wrote Buffett. USIC also came with two smaller sister companies, Mount Vernon Fire and U.S. Underwriters Insurance Company. The deal came about via General Re CEO Ron Ferguson, who introduced Buffett to USIC CEO Bob Berry. Berry's family had owned U.S. Liability for 49 years, though the company was now run by Tom Nairney, a manager Buffett praised for having achieved a rare combination of excellent growth and unusual profitability. 4. Benbridge Jeweler. Acquisition date: July 3, 2000. Description: a 65-store chain of upscale jewelry stores and shopping malls in the West. Purchase price: undisclosed. Half cash, half stock. The Benbridge acquisition had many similarities to other successful Berkshire acquisitions, including expanding a business Berkshire was already in this case jewelry. Being introduced to Berkshire by the homegrown recruitment system, this time Barnett Helzberg, and managers who Buffett admired and trusted to run the business without interference, cousins Ed and John Bridge. Buffett liked the 89-year-old company's truly remarkable record of same-store sales growth over the preceding 7 years. Like Helzberg, Benbridge operated out of multiple locations versus the one-store operation of fellow Berkshire jewelry retailer Borsheim's. Similar to the Taleman brothers of Jordan's Furniture, the Bridges gave some of their sale proceeds to employees. 5. Justin Industries. Acquisition date: August 1, 2000. Description: maker of Western boots and bricks for construction. Purchase price: $570 million. Justin was a somewhat unusual company with its two unrelated business lines, but it was right at home with Berkshire. H.J. Justin started the business in 1879 doing boot repairs. His sons expanded the business to 26 states, Canada, Mexico, and Cuba until 1948, when John Justin Jr. purchased the business from his father and uncles. In 1968, Justin Industries was formed to hold the boot business and a new unrelated sister company, Acme Brick. Justin later added Nakona Boot, Chippewa Shoe Company, and Tony Lama Boots. John Justin Jr. unfortunately passed away in February 2001, shortly after Berkshire acquired it. Justin left two managers in charge, Harold Melton, who ran Acme, and Randy Watson, in charge of Justin Boot. Acme produced over 1 billion bricks a year in 22 plants and accounted for 11.7% of U.S. brick production. Rare for a maker of bricks, Acme had a 75% name recognition rate in Texas, compared to 16% for the runner-up. This differential in brand name extended to its dominance in its local market. Because bricks are necessarily a low value per pound item, low cost and very heavy, its natural market was limited to a certain radius around each plant by the economics of shipping heavy items. Acme's brick business was subject to economic cycles, but its local economies of scale and basic necessary business would lead to long-term returns on capital that were satisfactory and protected. It appeared most of the value in Justin Industries resided in Acme Brick. The brick business grew from 52% of revenues in 1995 to 68% by 1999, and over that time acquired for over 100% of pre-tax operating profits. By contrast, the footwear business struggled over the same period. Footwear profits slowly vanished and losses mounted as management tried to compete against brutal competition. It was a familiar story to Berkshire's existing footwear businesses. We can see the relative stability in Justin's financial statements during the 5 years ended in 1999. Its revenues grew just 10% during that period, and it maintained steady margins and returns on capital. If we assume Justin would earn an average of $1.50 of revenues per dollar of invested capital at a pre-tax margin of 9.25%, about its 5-year average, the company-level return would amount to 13.9%. With its purchase price of 1.75 times the company's enterprise value, Berkshire could expect to earn a going-in pre-tax return on invested capital of around 8%, close to its going-in return when it made the acquisition. Looking at the brick business more closely reveals the true margin of safety in the Justin acquisition. As noted above, the business had all the attributes of a moat along with its associated protected returns on capital. While the data is imperfect, it reveals a growing business with solid and stable margins and attractive return on assets. Justin's overall results were dragged down by the low or non-existent profits from footwear, and this hid the true value of the acquisition. 6. Shaw Industries. Acquisition date, January 8, 2001. Description: maker of carpet, rugs, and other floor coverings. Purchase price, $2.3 billion for 87.3% of the company. Flooring is higher tech than bricks, but not much. Shaw had just the kind of attributes Berkshire looked for: a business with a dominant market share, 1/3 of the U.S. flooring market, and increasing profitability in a fundamental business. It was also a business with increasing economies of scale and one with invested family owners. A key feature of the deal was a requirement that Chairman Robert Shaw, President Julian Saul, and their families retain 5% of the company. Shaw was started by Robert Shaw's father in 1946 as the Star Dye Company. Julian Saul joined Shaw in 1998 when his family's carpet company, Queen Carpet, was acquired by Shaw Industries. By the time of the Shaw and Queen combination, Shaw had over a quarter of the market share of the U.S. carpet market, and Queen controlled 8%. With $4 billion of revenues, Shaw became Berkshire's largest, by revenues, non-insurance subsidiary. Reflecting on this in his charismatic humor, Buffett told shareholders, "Now if people walk all over us, we won't mind." Buffett said the Shaw deal came about when Robert Shaw, Saul, and an unnamed CEO of a potential suitor for Shaw Industries came to see him about writing an insurance policy. Shaw had a potential merger partner with asbestos liabilities from prior years which it desired to lay off on an insurer. Berkshire was unwilling to assume an open-ended risk and the insurance deal fell through, but the meeting planted the seeds for the acquisition soon after. What did Buffett see in Shaw and what was Berkshire getting for its money? To start, revenues grew 43% between 1995 and 1999. Part of that growth, to be sure, came from acquisitions, including the 1998 acquisition of Queen and from strong housing starts in the U.S. Its pre-tax margin, as adjusted for certain non-recurring items, doubled between 1995 and 1999, and its pre-tax return on capital almost tripled in that same period. These are evidence of the company achieving economies of scale. Shaw's 1999 operating results translated into a return on tangible capital of 36%. If these returns could be sustained, Berkshire would see its going-in pre-tax return continue to grow from a base of 15%. Even if we assume 1999 was a high year and the Shaw's normalized return on capital was its 5-year average of 20%, Berkshire's resulting earnings yield would be 7.8%. In either case, Berkshire's purchase price would be pulled upward over time if the business continued to grow while earning good returns on the capital it employed. 7. Benjamin Moore Paint. Acquisition date, December 8, 2000. Description: paint. Purchase price, $1 billion cash. Benjamin Moore added to the slate of low-tech housing-related companies joining the Berkshire family. The 117-year-old business operated via a system of independent dealers commonly found within hardware stores. The deal came about in July 2000 when a director of the company, Bob Mundheim, who was also general counsel of Solomon, broached the subject of a possible deal with Buffett. Buffett said he liked the business and its management, Richard Rube and Yvonne Dupre. He and Munger made a $1 billion cash offer on the spot. Other financial details of the company were not disclosed. 8. Johns Manville Corporation. Acquisition date, February 27, 2001. Description: manufactures and sells insulation and building products in North America, Europe, and China. Purchase price, $1.8 billion. Johns Manville took a long and winding road to its acquisition by Berkshire. The insulation products manufactured and sold by Johns Manville previously contained asbestos and were subsequently found to have caused many health problems. Litigation led to the company's bankruptcy in 1982. To compensate victims, the bankruptcy court set up a trust for the victims and used a controlling interest in the company as the major asset. The trust now sought a buyer to diversify its holdings. When a leveraged buyout, LBO, firm could not find financing, Berkshire made a quick, all-cash, no-financing, strings-attached offer. Buffett convinced Jerry Henry, John Manville's retiring CEO, to stay in his post. Henry ultimately retired in mid-2004. John Manville's returns on capital were good but cyclical. This is not surprising considering how closely it was tied to a notoriously cycle-prone industry. Between 1993 and 1999, its returns on capital averaged 18%, which included the low of 4% in 1993. The premium Berkshire paid for Johns Manville was double the company's underlying capital. Berkshire could still earn a satisfactory return for itself if Johns Manville continued to average the same results through future business cycles. Insurance. Berkshire's insurance group posted an underwriting loss of $1.6 billion that produced a cost of float of 6.1%. As we will see in a moment, this cost was not as bad as it seemed. Compared to an average 10-year U.S. Treasury rate of around 5.5%, it was higher than Buffett preferred. Apart from the primary group, each of Berkshire's main insurance operating segments posted a pre-tax underwriting loss, and General Re was by far the worst. General Re. General Re posted a $1.25 billion underwriting loss. It represented a cost of float of over 8% on the unit's average float of $15 billion. Pricing mistakes of the past still affected General Re, and it would take time to reprice certain policies. Correcting for those past underwriting mistakes required booking a charge in the current year to cover the adverse loss development of policies written in the past. Progress was being made by top managers Ron Ferguson, Joe Brandon, and Tad Montross to get underwriting discipline under control. In General Re's North American property casualty line, earned premiums rose 19.5% to $3.39 billion, but its underwriting loss grew 7% to $656 million. Despite the year-over-year loss widening, results were considered better because underwriting discipline began producing improvements and because of a large aggregate excess reinsurance contract. This contract was responsible for a large part of the increase in premiums, but also $239 million of the net underwriting loss due to accounting rules. The economics of excess reinsurance contracts is such that a large premium is paid up front and claims are paid, usually, over a long period of time. The result is a large amount of float, which compensates the reinsurer for assuming an expected payout above the premium amount. Such an economic arrangement is not unlike that of a loan. The way the accounting works for these contracts is the premium is booked up front in addition to all future expected losses. The difference, usually a negative number, is booked as an underwriting loss. Berkshire had a total of $482 million of such excess reinsurance losses in 2000, $239 million at Gen Re, the remainder at Berkshire Hathaway Reinsurance Group, or BHRG. This represented over one-third, 34.4%, of the underwriting loss for the year in reinsurance. Given the accounting treatment, Buffett thought it appropriate to adjust these types of contracts when analyzing Berkshire's cost of float. This adjustment changed Berkshire's cost of float to more like 4.5%, said Buffett, better than 6%, but not zero. The other type of reinsurance contract Berkshire wrote, General Re and Berkshire Reinsurance, was retroactive insurance, where accounting and economic treatments were more closely aligned. The economics of retroactive insurance contracts are very similar to an excess contract, with premiums booked up front. However, instead of being booked as an immediate underwriting loss, the difference between the lower premium amount and the higher expected loss is booked as an asset. This asset is then amortized into earnings as an incurred loss expense over time. Both excess reinsurance and retroactive reinsurance were considered good lines of business for Berkshire, even if they were not of the gold standard negative cost type. Buffett welcomed such pain today, gain tomorrow business, so long as the policies were priced appropriately, and he thought it important that shareholders understand the economics and the accounting of such business. Returning to General Re, the notes to the financial statements did not sugarcoat the results in international property casualty. Underwriting results for General Re's international property casualty segment for 2000 remained very bad. It suffered another year of motion picture losses, which added 4 points to the ratio. The only good news was that the aforementioned contract had ended. Berkshire's summary of the carnage in General Re's international property casualty segment. 2000. $416 million loss on $2.48 billion of earned premiums, combined ratio of 117%. Comparison from 1999. $473 million loss on $2.34 billion of earned premiums, combined ratio of 120%. General Re Global Life Health earned just 2.8% more business in 2000, and its underwriting results remained unsatisfactory. On premiums earned of $1.77 billion, the group lost $84 million, a combined ratio of 104.7%. Both General Re Global Life Health and International Property Casualty segments reported an extra quarter earnings in 2000. The 15 months of results, which were not considered to be material to Berkshire's overall results, were done to bring reporting in line with other segments. The two groups had previously been reporting on a one-quarter lag, and in 2000 that lag was corrected. Berkshire Hathaway Reinsurance Group. Buffett heaped well-deserved praise on Berkshire Hathaway Reinsurance Group, BHRG head Ajit Jain. During 2000, volume at Jain's Group nearly doubled to $4.7 billion. The growth came mainly from a single $2.44 billion contract that retroactively covered a major UK company, not disclosed. Jain also wrote a contract for the Texas Rangers covering its star, Alex Rodriguez, in case he became permanently disabled. Berkshire covered disability for many sports figures. Another contract covered the payout of $1 billion, $170 million present value, price for Grab.com. The underwriting loss from retroactive reinsurance was $191 million. Like General Re, BHRG wrote excessive loss reinsurance contracts that produced 5-year losses with no offsetting accounting treatment. In 2000, such losses were $154 million, which accounted for the bulk of the $162 million underwriting loss from the group. Its catastrophe business again experienced favorable results and posted a profit of $183 million. BHRG had become a remarkable operation under Jain's leadership. Supporting nearly $5 billion in premium volume was just 2.4 percentage points of overhead, the underwriting expenses line. The rest was 101.3 points of losses and loss expenses. Due to the nature of its business writing a few very large contracts, overhead rates fell to low single digits beginning in 1999 as premiums swelled. Before that, the group's overhead ran closer to 20 points, which was about the same as General Re's rate between 1998 and 2000. Berkshire Hathaway Primary Group. Within the more mundane, but no less exciting from an economic standpoint, Primary Group, premiums expanded 24% to $325 million, and pre-tax underwriting profits rose 14% to $25 million. The increases were primarily due to the inclusion of U.S. liability. Geico. Geico had the rare off year after many years of very good results. One of the reasons was self-inflicted. Buffett said he was wrong in the enthusiasm he displayed in 1999 about investing heavily in advertising. The The law of diminishing returns hit Geico hard. In some cases, the company ran 3 advertisements per hour, with the third most likely having very little effect on new business compared to the first. Additionally, Geico's growing market share meant it had already picked up the low-hanging fruit. Other customers would take longer to convert. Due to these factors, Geico entered a new phase of its operations where growth would be slower. This new phase was already evident in 2000. Geico previously focused on preferred customers or good drivers that were low risk to insure. The non-preferred market was dominated by drivers with blemishes on their driving records, including traffic violations and sometimes driving under the influence, DUI. With the non-preferred business, lapse ratios, where people did not pay their premiums, were higher, meaning fewer renewals. So even though Geico added almost 1.5 million new voluntary policies during the year, its policies in force count grew by only 20% of that amount. The major factor in Geico's underwriting loss was competition. The dominant player in the auto industry in the U.S. was, and still is, State Farm. With 19% of the market, State Farm let its pricing slip and tolerated higher loss ratios. This put pressure on industry rates. Geico played the long game and focused on underwriting profitability. Its higher market share and increased pricing translated into 18% premium growth, but this wasn't sufficient to cover all costs. One poor year and a 6.1% cost of float wasn't enough to tarnish Geico's reputation or its prospects. It still had the low-cost business model and plenty of room to grow and catch up with State Farm. Manufacturing, service, and retailing. Berkshire's financial reporting again shifted to accommodate the newer, larger businesses joining the family. The Buffalo News, the Shoe Group, Dairy Queen, and See's Candies now found themselves lumped together with Berkshire's many smaller businesses in the other business category. This was necessary to make room for a new building products reporting line to accommodate Acme Building brands, Benjamin Moore and Johns Manville, when that acquisition closed in 2001. These businesses reported pre-tax earnings of $906 million. That represented strong growth compared to the year before, but included new businesses. A more comparable metric is pre-tax return on capital, which fell 6 percentage points to 20.7%. Buffett was not one to bury problems. In his letter to shareholders, he touched on the Shoe Group, which struggled mightily against foreign competition. Dexter played its part in dragging the Shoe Group's pre-tax operating profit down from $85 million in 1994 to $17 million in 1999, the last year before the group was consolidated into other business. Berkshire now had overwhelming evidence that Dexter was worth less than it paid for the company. As a result, it recorded the $219 million goodwill impairment charge late in 2000. In retrospect, acquiring Dexter was a mistake. A mistake compounded by the fact that Dexter was purchased with Berkshire's shares. Buffett would continually chide himself for underestimating the powerful economic forces at work. We may regain some economic goodwill at Dexter in the future, but we clearly have none at present, Buffett wrote. Other U.S. shoe manufacturers probably share this sentiment. Earnings from the 2 flight services businesses dipped 5% that year, $213 million, but still represented 13% of Berkshire's consolidated pre-tax operating earnings. Flight Safety, the pilot training business, spent $272 million on simulators during 2000. That figure was far above the $70 million figure Buffett cited at the annual meeting as the company's annual depreciation expense. The larger number represented physical growth of the business. Flight Safety's 83-year-old founder, Al Ultzchi, like Buffett, was not slowing down. Executive Jet's monthly management fees and hourly usage rate fees grew by 49% during the year, which was on top of 46% growth the year before. The business was growing as fast as it could, taking up 7% of the world's output of jets. But building out its business, including the expansion into Europe, was expensive. This weighed on profits and was the reason behind the overall decline in earnings for flight services. With soaring growth, Executive Jet was at the same time careful. Buffett said founder and CEO Rich Santulli insisted on unusually high amounts of pilot training, good news for flight safety. Executive Jet's pilots flew just one aircraft model and received an average of 23 days a year of training, making them among the best. Citing a competitor's crash the year before in Aspen, Colorado, Charlie Munger told shareholders that executive jet's pilots had refused to fly into the airport due to weather conditions. The competitor was pressured by its customer to make the landing, which ended in tragedy. Operating profit from Scott Fetzer's 20 non-finance businesses declined 17% to $122 million. The big hitters were Kirby, Campbell Housefield, and World Book, which comprised 60% of its revenues and 65% of its operating profits. Continued struggles at World Book and an unusually strong year at its generator business the year before due to the Y2K scare hurt comparable results in 2000. Buffett devoted a section of his annual report to praise Ralph Shea, who retired at the end of 2000. Since Berkshire purchased Scott Fetzer in 1985, it had sent $1.03 billion to Omaha against a net purchase price of $230 million. Those funds were the seed capital for some of Berkshire's subsequent purchases. He attributed billions of dollars of value to Shea's contributions to Berkshire. Buffett wrote that he and Munger welcomed Shea to the Berkshire Hall of Fame. Finance and financial products. The finance and financial products businesses had quietly grown sizable and received a boost in 1998 with the addition of General Re's finance-related business. At year-end 2000, it had $16.8 billion of assets supported by $1.77 billion of equity capital. It looked very much like a bank leveraged almost 10 times. Such leveraging was ordinary for a bank. Pre-tax earnings jumped from $125 million in 1999 to $530 million in 2000. It housed everything from Scott Fetzer finance arm to the structured settlements and annuities business to General Re's security business, but relatively little was disclosed about it. Shareholders understandably wondered about the unit. At the annual meeting the following year, Buffett reassured shareholders about the relative risk of the unit, though he really did not reveal much. The more basic operations, he said, such as the structured settlements business, were straightforward, quite predictable and very easy business to understand. Moving up the complexity scale, the segment also contained a trading business outside the normal investment category. Buffett described this as arbitrage or semi-arbitrage of various types of fixed income securities. That line of business was run by Mark Byrne, son of longtime Geico manager Jack Byrne, who Buffett and Munger praised as smart and trustworthy. Buffett said the derivatives business within General Re was admittedly outside of their comfort zone, which led them to begin winding down the business. In 2000, Gen Re Securities still had a huge number of derivatives contracts on the books that would take a lot of time and ultimately a lot of red ink to dispose. Investments. Turning to Berkshire's main investments business run by Buffett, with Munger's input, almost all of its Fannie Mae and Freddie Mac shares were sold. The investments were jettisoned after Berkshire's chief capital allocators sensed their risk profiles had changed. They would later be proven right after the companies were found to have overstated their earnings. They would also play a part in the 2008-2009 financial crisis close to a decade later. Poking around the edges, Buffett said Berkshire established 15% positions in several mid-sized companies, bought the high-yield bonds of a few issuers, and added to our holdings of high-grade mortgage-backed securities. There are no bargains among our current holdings. We're content with what we own, but far from excited from it. With little exciting investment news to share, Buffett devoted a couple of pages of his chairman's letter to expanding on the ESOP analogy he first discussed at the prior year's annual meeting. He said investing was as simple as the ESOP proverb that a bird in the hand was worth two in the bush, with one minor qualification. The qualification was when and what was the risk-free rate. If you can answer these three questions, he said, you rank the attractiveness of all possible uses of capital throughout the universe. Those questions were: 1. How certain are you that there are indeed birds, cash, in the bush? 2. When will they emerge and how many will there be? 3. What is the risk-free interest rate? The answers to these questions were the foundation of Berkshire's investment program. It was no coincidence that certainty was placed at the head of the list. Buffett said others had strayed into speculation and forgot to pay attention to this framework. They were instead more concerned about movements in share prices that often traded far ahead of what the fundamentals would suggest was reasonable. Comment by Charlie Munger at the 2001 annual meeting was instructive, as it sheds light on his and Buffett's correct thinking about buying internet companies around the time of the dot-com bubble. He recalled that both he and Buffett had worked at Buffett's grandfather's grocery store in Omaha as youngsters. Munger noted that the business, which included delivering goods to customers, barely supported one family. Buffett made explicit what Munger was referring to. Webvan, an internet-based grocery delivery business, ran into the same cost that Buffett and Son did generations earlier delivering groceries. The internet hype roped many into a speculative frenzy based on the false belief that technology would somehow eliminate costs and shower profits on all. Buffett and Munger looked beneath to the basic economies and saw otherwise. They saw that ordering groceries would go from paper to computer entry, but the costs of buying the product and distributing it to customers would not change. There was a lot of money transferred from the gullible to the promoters of internet stock. It's been a huge trap for the public, Buffett said. Berkshire vs. S&P 500. Though Berkshire beat its preferred benchmark, the S&P 500, by 15.6% in 2000, its book value increased just 6.5%. That was because of a 9.1% decline in the S&P that year. Buffett told shareholders he thought Berkshire's gain in intrinsic value, the metric that really counted, moderately exceeded the gain in book value. With 1999 and 2000 containing pre-tax operating losses before considering investment income, the two-column method, investments per share plus multiples of pre-tax operating earnings per share excluding investment income, for determining Berkshire's intrinsic value, became a bit more complicated. See Table 6.27. Buffett even omitted the table in his 2000 annual report. Estimating Berkshire's value required working directly from the financial statements, and it also called for some assumptions on insurance profitability. The first part of this estimate, investments per share, is relatively straightforward. Berkshire's balance sheet provides the amounts for cash and investments excluding the finance businesses. Pre-tax operating earnings is a little more complicated. A quick calculation results in a per-share loss. Capitalizing a loss would lead to a larger negative value, which would reduce the intrinsic value calculation. Yet we know that Buffett would not tolerate large ongoing losses from insurance underwriting, and we know that the operating business had meaningful value. If we make the relatively conservative assumption that insurance underwriting would break even, the per-share operating earnings from the non-insurance business can be capitalized. We can use the same methodology for 1999, which showed a similar pre-tax loss due to insurance underwriting. The change in intrinsic value from 1999 to 2000, using the same method, is 12%, a figure consistent with Buffett's moderately higher change. Berkshire's goal of attaining a 15% average annual rate of return was getting harder year by year, owing to Berkshire's growing size. Buffett told shareholders at the annual meeting that very few large companies would achieve such a record over the next decade. Berkshire would do its best, using opportunity cost as its guide. Buffett summed up the strategy very well at the 2001 annual meeting. I think our method is a pretty good one. I think the idea of having a group of good businesses to throw off cash in aggregate, in a big way, that themselves grow, that are run by terrific people, and then adding on to those sometimes at a slow rate, but every now and then at a good clip, more businesses of the same kind, and not increasing the outstanding shares, I think that's about as good as business model as you can have for a company our size. But what it produces, we'll have to see. There is nothing more to add. 2001. In its race to outpace the S&P 500, Berkshire Hathaway had only fallen short of the benchmark a few times. Those years it at least finished within some sort of increase to book value per share. That changed in 2001 when book value per share declined 6.2% against a decline of 11.9% for the S&P. The string of advances was broken only by a truly terrible catastrophe, the terrorist attacks of September 11, 2001. Like the United States itself, Berkshire was injured but resilient in the face of adversity. Buffett reminded shareholders that relative performance was the name of the game. Berkshire had outperformed the S&P by 5.7%. If you expect, as Charlie Munger, Berkshire's vice president, and I do, that owning the S&P 500 will produce reasonably satisfactory results over time, it follows that, for long-term investors, gaining small advantages annually over that index must prove rewarding. Some disagree with Buffett, but he was stalwart, reminding the shareholders his goal of relative performance would not change. Part of Berkshire's poor performance during 2001 was self-inflicted. Buffett admitted as much. General Re had taken on terrorism-related risks without being properly compensated. Buffett chided himself for knowing General Re was exposed to some of those risks, but he said, "On September 11th, this error caught up with us." On the non-insurance front, Berkshire's businesses were also affected by the attacks and the economy. Buffett thought the country had entered a recession even though economists hadn't announced it. Officials later dated the early 2000s recession between March and November 2001. Still, Berkshire added non-insurance subsidiaries during the year, completing the previously announced Shaw and Johns Manville acquisitions and closing and initiating several others. The long-term strategy at Berkshire of continually searching for good investment opportunity was unchanged, even in the face of the shock of September 11th. 3 of them are listed below. Mytech. Acquisition date, July 31st, 2001. Description, Building Products Company. Purchase price, $400 million in cash for 90%. Mytech had connector plates for roofing trusses as well as other building-related materials. It also had a proprietary software system it leased to customers. The business came to Buffett's attention the prior year when Gene Toombs, its CEO, sent him a letter along with a hunk of metal, a connector plate. Prior to Berkshire's purchase, Mytech was owned by Rexam plc, a UK company. Mytech was headquartered in Chesterfield, Missouri. The remaining 10% of the company was purchased by 55 of its managers, each of whom put up their own cash to participate. No detailed financial information was available from Mytech because it was part of a group within Rexam. Extra. Acquisition date, September 11th, 2001. Description, trailer leasing business. Purchase price, about $578 million. Buffett said the deal came from his friend Julian Robertson, whose investment fund, Tiger Fund, owned shares in the company. Even though Berkshire's offer contained an out that would have allowed it to back away considering the events of the day, Berkshire completed the acquisition. Extra purchased trailers which were then leased to trucking companies and others moving freight. Its dependence on economic activity made it a cyclical business and therefore like many of Berkshire's other businesses, which overall earned good returns. Owing to the nature of the business, it was placed among the finance and financial products businesses. As a financial-related business, Extra's balance sheet contained a meaningful amount of debt. The company also earned good returns on total capital. Berkshire's purchase price represented a premium of about 60% over the company's underlying equity capital. Considering the purchase from the standpoint of a 100% cash finance business, the effective purchase price yielded 12%. Larson Jewell. Acquisition date, February 8, 2002. Description, manufacturer and distributor of quality custom framing products. Purchase price, approximately $225 million. Continuing to add to its low-tech, non-insurance businesses, Berkshire in 2001 agreed to purchase Albeca Incorporated, which conducted business as Larson Jewell. The company serviced a network of 18,000 framing shops in the U.S., and also did business in Canada and Europe. The company was owned by Craig Ponzio, who had worked in manufacturing in college. Ponzio bought the company in 1981 and went on to increase its revenues 100-fold to $300 million. The business was now run by CEO Steve McKenzie. Larson Jewell's economics were very simple. The company serviced many smaller framing shops with very small volumes of business each year. What was important to these shops was a wide selection of inventory available, but without the large carrying costs. With its tens of thousands of customers, Larson Jewell could carry such inventory economically, even though each individual shop might place orders infrequently. This meant 85% of the time Larson Jewell could have an order to a framing shop the next day. This network and a service organization that called on customers half a dozen times a year created a moat around the business. Buffett said the deal came together quickly, having first come to his attention on December 3, 2001. He called it a fat pitch, meaning one which took less than 15 minutes to size up over the phone and 90 minutes to work out in person. Buffett foresaw opportunities for bolt-on acquisitions, small acquisitions by Larson Jewell that would fit into its existing operations in the future. Insurance. The main story of 2001 was insurance. The September 11th attacks caused the largest insurance losses in history, and Berkshire took its share. Buffett took the unusual step of issuing a press release on September 12, 2001. He said estimating losses from the terrorist attacks would take a very long time to determine, but he thought Berkshire would incur about 3 to 5% of the industry's losses. In a subsequent unusual move, Buffett included commentary in Berkshire's third-quarter earnings release, which estimated the loss at about $2.275 billion. In that same press release, Buffett chided General Re for breaking all 3 of the rules of operating a successful insurance company. Paraphrasing, those rules were: 1. Only accept risks one is capable of evaluating. 2. Limit aggregated exposure, i.e. diversify risks. 3. Avoid doing business with bad actors. Breaking those rules cost CEO Ron Ferguson his job. Buffett replaced him with Joe Brandon and praised Brandon and his new lieutenant, President Tad Montross, as talented leaders who would clean up General Re. While Berkshire Hathaway Reinsurance had lost money on September 11th, Buffett noted that unit, led by Ajit Jain, had adhered to all 3 rules of successful underwriting. The insurance group as a unit turned in an underwriting loss of $4.1 billion on $18 billion of earned premiums. Berkshire's cost of float was a staggering 12.8%. That average float grew 19% to $35.5 billion at year-end 2001 was not necessarily a good thing. Remember that a component of float is unpaid losses. Berkshire's float during 2001 grew in large part by incurring losses for which it wasn't compensated. Float at an overall cost in the double digits would not be tolerated for long at Berkshire. General Re. Since Berkshire had purchased General Re in late 1998, the business had cumulatively lost nearly $6.5 billion for underwriting. In fact, in each year since 1998, the losses had only grown. The $3.7 billion loss for 2001 was a terrible underwriting result. Having written coverage for which it wasn't paid, terrorism insurance, General Re lost $1.9 billion from the attacks alone. The segment also took an $800 million loss to correct prior year's underwriting miscalculations. The bulk of the loss at General Re came from its North American property casualty segment, a $2.84 billion loss on $3.97 billion of earned premiums. This was not a case of long-tail contracts or any effective accounting, but simply poor underwriting. A full $1.5 billion of the loss came from September 11th. It was the North American property casualty segment that recorded the $800 million addition to its loss reserves during the year. The international property casualty segment in General Re also experienced very poor results. Some stemmed from September 11th. On earned premiums of $2.4 billion, up slightly from $2.5 billion, the unit lost $746 million. The international segment recorded the net $313 million of September 11th related losses, as well as a $143 million loss from coverage of a steel plant in the UK, which had exploded. An additional blunder at General Re was its Argentinian business, which was in peril owing to an economic and political crisis there. General Re's global life health business continued to be the less dark segment. During 2001, the unit increased premiums 10.4% to $1.99 billion. It reported an underwriting loss of $82 million, including $15 million of September 11th losses. Berkshire Hathaway Reinsurance Group, BHRG. While Ajit Jain's group contained some terrorism-related losses from September 11th, they were not nearly as bad as at General Re. On $2.99 billion of earned premiums, down from $4.7 billion, BHRG reported a $647 million pre-tax underwriting loss. Of that, $530 million, or 82%, was related to September 11th. BHRG's results also included $371 million in losses from retroactive reinsurance contracts, which were the type that came with deferred charges relating to the asset put on the books at inception. While it's possible some of the loss was due to incorrect underwriting, it's more likely the bulk of that $371 million came from accounting charges. Buffett expanded on his thinking regarding the economics of retroactive reinsurance policies at the 2002 annual meeting. It didn't matter, he said, what type of claims they were. Buffett used the example of asbestos versus auto claims. What really mattered was the speed of the claims. Since Berkshire always capped its limits, even if it paid up to the capped limit but over a long period of time, the economics would still be favorable owing to the large amount of float. From purely a financial standpoint, Berkshire's insurance companies, especially the reinsurers, were entities that incurred debt of a slightly different nature. Unlike traditional debt, insurance liabilities had irregular and unknown payments and the possibility of paying less than full face value. Each insurer played an important role in society, which in turn provided the opportunity to generate float. Deferred charges relating to retroactive policies made good performance elsewhere at BHRG. Other catastrophe and non-retroactive reinsurance business earned a profit of $254 million, which partially offset the September 11th losses. With its core catastrophe and non-retro business profitable, Buffett praised Ajit Jain in his letter to shareholders, commenting, "Never on even a single occasion have I seen him break away from our 3 underwriting rules." Jain's team, now with 18 other individuals, would occasionally book a loss, as would be expected, but they would not, Buffett wrote, book foolish losses. While General Re was in restructuring mode under close supervision by Buffett, BHRG used its position as a leader with unparalleled financial strength to write considerable business. Right after the attacks, Jain's group wrote billions of dollars worth of premiums for coverage relating to terrorism, and all risk was retained for Berkshire's account. This time Berkshire was paid appropriately for the risk, and its coverage contained both caps on exposure and exclusions relating to nuclear, chemical, or biological type attacks. These latter exposures were so large that they could conceivably wipe out all the capital in the insurance industry. Therefore, the only natural insurer of such risks was the government. Berkshire Hathaway Primary Group. Berkshire's steady group of direct writers of insurance reported equally steady gains during 2001. On earned premiums of $501 million, the group reported an underwriting profit of $30 million. While they likely had some terrorism-related losses, none were disclosed. Geico. Geico bounced back from its rare off year with a $221 million underwriting gain in 2001, the best performance within the insurance group. Earned premiums rose 8% to $6.1 billion. Its reversal back to a positive underwriting experience was driven primarily from lower losses, which fell 2.9 points to 77% of earned premiums. This was partly due to a mild winter with few accidents. Geico still had difficulty turning advertising dollars into new customers. It spent $219 million on advertising in 2001 while treading water on the new policy front. Its largest share of customers, the preferred group, the segment on which Geico had built its business, represented 81% of policyholders and grew just 1.6%. The non-preferred standard and non-standard group fell by over 10% during the year, resulting in a 0.8% decline in overall policies in force. Geico's float grew 8% to $4.25 billion, despite the overall decline in policies in force, and there were signs soon after year-end pointing to growth in policies in force resuming at Geico. Manufacturing, service, and retailing. Note: in 2001, Berkshire stopped reporting separate financials for the MSR businesses, so data for their collective earnings and return on capital aren't available. Data reappeared in the 2003 Chairman's Letter with an earnings look back to 2002. Rather than attempt to fill in the gaps, we'll proceed with a look at the individual business units. The addition of so many new businesses necessitated another change in grouping Berkshire's results. The building products line, new in 2000, listed just $34 million in pre-tax profit that year. In 2001, it swelled to $461 million as Benjamin Moore, Johns Manville, and Mytech contributed results. Shaw received its own reporting line because of its size. In 2001, it earned $292 million pre-tax on $4 billion of revenues. Revenues declined $100 million, reflecting lower volumes, and were attributed to the September 11th initiated recession in home building. Shortly after year-end 2001, Berkshire acquired the remaining 12.7% of Shaw it did not own. Berkshire paid $4,740 in A-share equivalents, or about $324 million. The September 11th terrorist attacks directly impacted the flight services business. Executive Jet would need to incur additional costs relating to new safety and security rules. There was also a slowdown in fractional jet services usage and a lower level of training at flight safety. Executive Jet had its competitive advantage, which stemmed from its 300-plane fleet of jets, available on short notice to ferry customers around the country and Europe. Flight Safety also remained committed to the long term, investing $67 million more than its annual depreciation expense to expand capacity. Retail operations, comprised of the home furnishings and jewelry businesses, earned $175 million, unchanged from the year before. This flat result represented weakness since it included a full year from Benbridge, a small acquisition by Nebraska Furniture Mart, and a new R.C. Willey store in Nevada. Same-store sales from the jewelry business declined 8%. Scott Fetzer managed to increase earnings 6% to $129 million through continued cost discipline. This was even more impressive in the face of continued declines in sales of Kirby units overseas and at World Book generally. Utilities. Perhaps one of the most notable changes, aside from large losses in insurance, was Mid-American. In 2000, Berkshire reported $197 million in pre-tax earnings for Mid-American. In 2001, this figure jumped to $565 million. Why? Two major factors were an increase in operating earnings and the fact that GAAP stopped requiring goodwill amortization, affecting Mid-American to the tune of $94 million in 2000. Finance and financial products. The finance and financial products business again reported strong pre-tax results, $519 million pre-tax versus $530 million the year before. But this was becoming Buffett's show more than ever. The core business of Scott Fetzer's finance arm and the annuity business remained. General Re's securities, like its parent, had fallen from grace. General Re's derivatives business was now in runoff mode. Berkshire was doing its best to get out of the business, but it would take a long time. Investments. As in prior years, Berkshire's investment portfolio changed at a glacial pace in 2001. Buffett's letter to shareholders used such descriptive phrases as few changes, restrained enthusiasm, and lukewarm feelings about the prospects to describe his and Munger's feelings toward investments and the market overall. They were content to hold on to most of what Berkshire already owned, since the long-term prospects for American Express, Coca-Cola, Gillette, Washington Post, and Wells Fargo remained favorable, but they thought their own portfolio in aggregate was not undervalued. Two new investments did join the summary chart in Buffett's letter in 2001, having crossed the $500 million threshold established as a cutoff. Berkshire's nearly 16 million shares in H&R Block Incorporated, a tax preparation service company, had a market value of $715 million at year-end 2001 and cost Berkshire $255 million. While new to the table, Berkshire had owned shares in the company since the last quarter of 2000. Another investment crossing the threshold was Moody's Corporation. Moody's was a credit rating agency that graded companies' debt instruments for investors. Berkshire owned 24 million shares in the company and had first purchased it at the same time as the H&R Block stake. Berkshire put its money where Buffett's mouth was in terms of lower expectations on its investment performance. The expected rate of return on its pension plan was reduced to 6.5% in 2001 from 8.3% that it expected in 2000. This caused a higher expense and a greater liability, all things being equal, since the shortfall between expected returns in the market and cash contributed by Berkshire would widen. Berkshire made a significant fixed income investment in 2001. Early in the year, it committed to be part of a joint venture to loan money on a secured basis to Finova Group. Finova was a troubled finance company that failed. Its prepackaged bankruptcy had been approved in August 2001. While the deal did close, it was not before being terminated and renegotiated. Berkshire chose to terminate the deal based on a clause allowing Berkshire to do so if the markets closed, which they did after the September 11th attacks. Unlike the Extra deal, which contained a similar clause but went unexercised, Finova was materially affected by the event. Finova's assets contained loans relating to aircraft assets that were significantly diminished by September 11th. Its receivables were also affected negatively. The deal called for Berkshire and Leucadia National Corporation to form a joint venture. The joint venture, dubbed Berkshire, purchased the failed company. As part of the deal, Berkshire would borrow $5.6 billion to relend, with a 2% spread, to Finova for its own finance activities. This debt in turn was guaranteed to Berkshire and Leucadia. Berkshire provided a 90% primary guarantee matching its economic interest guarantee. Click, click. Berkshire provided the 90% primary guarantee matching its economic interest in the loan. Berkshire also received 50% of Finova's common shares, which were in turn owned 50-50 by the joint venture. True to Berkshire's style, it would be the Leucadia part of the partnership that would manage the investment, not Berkshire. Goodwill. In June 2001, the Financial Accounting Standards Board, FASB, changed the way goodwill was presented in company financial statements. Prior to this change, goodwill was amortized over a period of 40 years. Starting in mid-2001, it would remain on the books forever until and unless it was found to be impaired. Such an impairment was available under the old system as well, and Berkshire had made such a change in 2000 when it wrote off the goodwill associated with Dexter. A consequence of this accounting change was to bring the accounting closer to the economic reality that Berkshire had always considered more appropriate. For years, Buffett had presented his summary of reported earnings table in a way that separated accounting charges from the underlying business results that he and Munger considered most important. The new accounting began in July 2001, affected acquisitions, The new accounting, begun in July 2001, affected acquisitions made after that date. For acquisitions made prior, it would begin in 2002. If the acquisitions Berkshire made during the year were not proof enough of its unwavering long-term optimism, its existing operating subsidiaries were undeterred as well. Buffett pointed to R.C. Willey, which had made an unusual investment in Idaho, and then turned to do the same thing in Las Vegas to much success. Nebraska Furniture Mart began constructing a 450,000 square foot store in Kansas City, which would open in 2003. Berkshire was bruised but not broken by the trying year. Like the country itself, Berkshire learned its lessons and moved forward to strengthen into a better version of the company it was pre-September 11th. 2002. September 11th and the 2001 recession were in the near past, but you wouldn't know it to look at Berkshire's results in 2002. Knowing where and how it aired, Berkshire almost immediately began writing large amounts of reinsurance. Say for General Re, each of the four major parts of the insurance group turned in favorable results. During the year, it completed and initiated billions of dollars of additional investment, and its marketable securities portfolio outdid the market, even though valuations remained elevated. These factors came together to produce a 10% increase in per-share book value, fully 32.1 percentage points higher than the S&P 500. As Buffett put it in the opening sentences of his 2002 letter to shareholders, in all respects, 2002 was a banner year. Insurance. After poor results for 3 years, Berkshire had a 1% cost of float in 2002, compared to 12.8% the prior year. On earned premiums of $19.2 billion, Berkshire posted a pre-tax underwriting loss of $411 million. This result was mostly due to no large catastrophe losses. Float grew by $5.7 billion to end the year at $41.2 billion. The real story, though, was mini-stories, meaning the individual businesses in Berkshire's insurance operating segment. General Re began the process of remolding itself into the reinsurer Buffett had thought he purchased at the outset. Ajit Jain's group at the Berkshire Hathaway Reinsurance Group outdid itself again. Geico shot the lights out, and the primary group had an outstanding year. General Re. With Joe Brandon and Tad Montross now in control at General Re, Buffett thought the company was well-positioned to deliver huge amounts of no-cost float to Berkshire, without the hidden risks of yesteryear. Both Brandon and Montross focused on profitability of underwriting above all else, along the formula of Berkshire's other insurance businesses. The pair increased premium rates on new business, which served to offset the lower volume of business written across General Re's units. Even though General Re's combined ratio came in at 116.4% on $8.5 billion of premiums, a loss of $1.4 billion, the underlying business was transformed in short order. This was evident in its underwriting loss, which fell 62% from 2001. The bulk of the loss stemmed from a $1 billion underwriting loss in the North American property casualty segment, which in turn reflected $990 million of additional loss reserves and followed $800 million in 2001. Continued upward revisions to prior year loss reserves represented real liabilities and clearly frustrated Buffett. The large loss reserve adjustment swamped a $66 million gain attributable to the 2002 accident year and followed a $115 million reduction in reserves related to September 11th, which had been estimated too conservatively. Proving Buffett's hunch that September 11th claims would take a long time to sort out, the North American segment paid out just $241 million of the estimated $1.54 billion net loss attributable to the terrorist attacks. The underlying positives were a nice reversal for General Re, but like all things related to reinsurance, the ultimate results would not be known for years. Berkshire estimated that just 15% of the reinsurance claims in any year were reported the year they occurred. A full 50% of the General Re North American property casualty net loss reserves of $14.9 billion were of the incurred but not reported IBNR category. In other words, future information could move the figure in any direction. The international property casualty segment at General Re turned in an underwriting loss of $319 million on written premiums of $2.65 billion. Premiums grew 10% in dollar terms and were aided by the group's participation in a Lloyd's of London syndicate program, where General Re International took over 90% of written business. Like the North American segment, the international segment recorded a loss to correct prior loss reserves, this time to the tune of $240 million. The group also recorded $107 million in losses relating to floods in storms in Europe. General Re Global Life Health saw its underwriting loss improve to $55 million on earned premiums of $1.89 billion. This was a slight improvement from the $82 million loss on $1.99 billion of earned premiums the year before. Its underwriting results were characterized as poor, reflecting losses from exited lines of business. Berkshire Hathaway Reinsurance Group. Ajit Jain made so much money I don't even want to tell you about it, Buffett quipped at the 2003 annual meeting. BHRG turned in an underwriting gain of $534 million before tax, a dramatic reversal from the previous year's $647 million loss, and the most of any insurance division. To do this, BHRG overcame accounting charges and was aided by no major supercat losses. For the first time, the annual report broke down BHRG's subsegments in table form to clearly show its various lines of business. Due to a lack of catastrophes during the year, the catastrophe in the individual risk line turned in a pre-tax underwriting gain of $1 billion on $1.3 billion of premiums earned. The catastrophe segment also benefited from $85 million of reduced reserves relating to the September 11th terrorist attacks. Like General Re, BHRG overestimated its losses and an accounting adjustment corrected for the new estimate. Catastrophe was the type of business prone to large fluctuation in results, but over time was expected to earn a reasonable profit. The profit in 2002 was clearly on the upside. Buffett told shareholders to adjust their assessments of Berkshire's earning power downward because of it. It was not uncommon for reinsurers to lay off their own risk. To do this, they would purchase reinsurance to cover the risk they assumed in reinsuring primary companies. Berkshire Hathaway Reinsurance rarely did this. Berkshire was wary of the ability of collecting on others' promises many years into the future and had seen supposedly strong reinsurers go out of business. Berkshire was willing to take the volatility in periodic results in exchange for better results over the long term, and it had the necessary capital to hold all its volume. The retroactive reinsurance segment of BHRG reported a loss of $446 million on earned premiums of just $407 million. It was this segment of BHRG's operations that had significant accounting peculiarities. Even though the economics were in Berkshire's favor, receiving large premiums up front, followed by, usually, long periods of payments out the door, the accounting caused results to look poor. The premiums earned in 2002 were swamped by $428 million amortized of deferred charges relating to premiums earned in prior years. The favorable economics are illustrated in the $7.5 billion of year-end float from retroactive reinsurance. Berkshire could put this sum to work for its own benefit while concurrently paying claims as they came in. Amortization of the deferred charge asset relating to writing those premiums would remain no matter how much in premiums showed up on the top line. Berkshire estimated that 2003 would see $400 million of such charges from contracts already on the books in 2002. BHRG's quota share business grew almost sixfold in 2002. Quota share business, which was a way of participating in a percentage of the business of another insurer, earned premiums of $1.29 billion and reported a loss of $86 million on that volume. Seeing favorable underwriting conditions, the group participated in a new Lloyd's of London syndicates and booked a contract with a major U.S.-based insurer. BHRG also earned $60 million on $321 million of earned premiums in its other segment. It is worth taking a moment to discuss Lloyd's of London, which has been noted several times. Lloyd's of London was not a single entity, but rather a marketplace for insurance transactions. Insurance could come together to form syndicates or risk-sharing pools. Lloyd's was like a clearinghouse with known rules and ways of conducting business. Berkshire Hathaway Primary Group. The primary lines turned in another year of profit and grew float 38% to $943 million. While most of this segment continued to do well, the workers' compensation business and the home state group suffered. Buffett said its reserving severely missed the mark, placing profitability over growth. He said, "Until we figure out how to get this business right, we will keep it small." Geico. Buffett had a maxim: there are no positive surprises in insurance. This was perhaps off mark with Geico. Geico had another great year in 2002, and Buffett summed it up succinctly. At Geico, everything went so well in 2002 that we should pinch ourselves. Growth was substantial, profits were outstanding, policyholder retention was up, and sales productivity jumped significantly. These trends continued in early 2003. Geico's 10% growth in earned premiums reflected its growth in voluntary auto policies. Its loss ratio also benefited from a mild winter, which edged down 2.9 percentage points to 77% of earned premiums. Its combined ratio came in at 93.8%, a 6.2% pre-tax underwriting margin. Outstanding indeed. Acquisitions. During 2002, Berkshire closed 5 substantial acquisitions in addition to numerous bolt-on acquisitions to operating subsidiaries. 2 of the 5 closed transactions were Albeca, doing business as Larson Jewell and discussed in 2001, and Fruit of the Loom, discussed below. 2 others, with a combined pre-tax profit of $60 million, were CTB and Garon. CTB meant agricultural equipment for the poultry, hog, egg production, and grain industries. Garon manufactured children's apparel and is best known for Garanimals, its largest line. Buffett said each company earned decent returns on capital, but no details were disclosed. Berkshire acquired the Pampered Chef on October 31, 2002, the same day it closed on Garon. Doris Christopher started the Pampered Chef in her basement in 1980 with $3,000 borrowed from her life insurance policy. The company sold kitchenware and equipment at home parties. At the time of Berkshire's purchase, the company was doing $700 million of sales a year through its 67,000 kitchen consultants. Buffett told shareholders it took about 10 seconds for him to decide Berkshire wanted to partner with Christopher and the CEO she had brought in to run the company, Sheila O'Connell Cooper. The purchase price wasn't disclosed. Fruit of the Loom. The well-known underwear maker was the largest low-tech business to find its way onto Berkshire's radar. How Fruit of the Loom became a Berkshire subsidiary was a little out of the ordinary. The company faced bankruptcy after stumbling with operating and financing issues. Berkshire first purchased its bonds and bank debt at 50% of face value, which equated to a 15% current return and amounted to 10% of Fruit of the Loom's senior debt. An unusual feature of the bankruptcy, allowing for interest payments on senior debt during the bankruptcy process, attracted Buffett. The investment was originally intended to be nothing more than junk bond investment, one of very few such outlays during that time. 2 things led to Fruit of the Loom's bankruptcy. First, the company ran up debt of over $1.2 billion. This compared to revenues under $2 billion and falling, and just $130 million of gross profit. Buffett said such metrics pointed to a company that in a financial sense was out of control. A second major issue which both precipitated the debt problem and exacerbated it was bloated costs and other operating issues. Buffett saw the potential for it to regain its status as a low-cost producer of a basic needed product. It had a 40% plus market share in the men's and boys market. Buffett believed the company could once again be a good business once it shed its debt burden and costs were brought back in line. The man to do that job was Fruit of the Loom's former CEO, John Holland, who returned on the scene to fix the mess the prior management team made. It was telling that the only major contingency in Berkshire's offer to the bankruptcy court was that Holland remain as CEO. Berkshire offered the bankruptcy court $835 million, which included the assumption of certain liabilities. Unlike its other deals, the offer to buy Fruit of the Loom came with no strings attached, save for Holland running the company. Neither Berkshire's ability to finance the deal or even more could derail the transaction from closing. Many contracts have what's called force majeure clauses that allow termination for major events such as war or other foreseeable circumstances. The deal closed on April 30, 2002. It's not entirely clear what sort of financial returns Berkshire could expect from Fruit of the Loom. It appears the purchase price roughly equated to book value. If the rescued Fruit of the Loom could earn returns on capital near what it had during Holland's heyday, Berkshire could likely expect satisfactory returns upwards of 15%. The Fruit of the Loom story has another historical element. During the 1950s, while Buffett was working for Graham Newman, Fruit of the Loom crossed his path. Union Underwear Company, which produced a product under the Fruit of the Loom brand name, had been sold at a mouth-watering price to a company Buffett owned shares in, the Philadelphia and Reading Coal and Iron Company. Philadelphia and Reading purchased Union Underwear, which subsequently purchased control of the Fruit of the Loom brand name and grew pre-tax earnings to over $200 million. Both the 1955 and 2001 deals were assisted by Graham Newman partner Mickey Newman. Mickey was the son of Graham Newman partner Jerome Newman and had assisted Buffett during the 2001 bankruptcy proceedings by sharing his historical knowledge of the company and introducing Buffett to John Holland. Newman attended the 2002 Berkshire annual meeting and received applause from shareholders for his work on their behalf. Another related historical note is appropriate. In December of 2001, H.H. Brown acquired the inventory and trademarks of Acme Boot. Acme had also been purchased by Philadelphia and Reading in 1956. Unlike Fruit of the Loom, Acme had fallen from its former graces. What had been a company worth $7 million in annual revenues was sold for a tenth of that amount in What had been a company worth $7 million in annual revenues was sold for a tenth of that amount in 2001. Berkshire also made two additional acquisitions through Mid-American. Mid-American contracted to buy Northern Natural Gas, a 16,600-mile pipeline supplying gas to Midwestern states. The business was originally headquartered in Omaha. It ultimately ended up with the infamous Enron Company in Texas. Enron's bankruptcy led to the business being held by Dynegy, an Enron creditor that took the pipeline as collateral. It was then quickly sold to Mid-American over the course of a weekend. The other Mid-American purchase in 2002 was Kern River. Kern River was also a pipeline business, this time supplying gas to Southern California. Mid-American now supplied 8% of the gas used in the United States. Berkshire injected additional capital into Mid-American to fund the Northern Natural and Kern River purchases. Remember that Berkshire could not control Mid-American, so its original purchase was structured in such a way to give it a majority economic interest, but a much lower voting interest. To remain a non-controlling shareholder of Mid-American and in compliance with the Public Utilities Company Holding Act, Berkshire purchased an additional $402 million of convertible preferred stock and $1.27 billion of trust preferred securities. As a result of the additional investments, Berkshire's fully diluted economic interest in Mid-American rose to 80.2% at year-end. Interestingly, Mid-American was not just an energy company. It had an accidental business called Home Services, a residential real estate brokerage. Residential real estate and energy were very different, but so were the myriad businesses at Berkshire. Home Services had grown to be the second largest residential broker in the country and did $37 billion of transactions in 2002 alone. This was double its volume just a year earlier. The business was cyclical but had low capital requirements and plenty of room for growth under the leadership of CEO Ron Peltier. Mid-American's pre-tax earnings grew 8% to $613 million, in part due to acquisitions. Manufacturing, service, and retailing. Berkshire's other non-insurance businesses had good results in 2002, especially when considering the recent recession. General weakness in the consumer market prevailed, but Berkshire's jewelry and furniture businesses held their own. Pre-tax earnings in the retail operations segments, which included jewelry and furniture, dropped just 5% to $166 million. Shaw, the newly acquired carpet manufacturer, increased earnings by 45% to $424 million. Just 1% of the increase was attributable to prices, while the rest was because the company judiciously controlled expenses, leading to margin improvement. The chairman's letter grouped Acme Brick, Benjamin Moore and Johns Manville, Mytech, and Shaw into a home and construction-related business category for discussion purposes. As a group, these businesses earned $941 million in 2002. The apparel segment recorded pre-tax profits of $229 million. These weren't comparable to the $33 million loss the year before, since the current year included results from Fruit of the Loom, Guerin, and H.H. Brown. Scott Fetcher's pre-tax earnings were unchanged at $129 million. Results in the flight services segment were worse than they appeared. The reported 21% increase in pre-tax earnings to $225 million included a $60 million gain from exiting a joint venture with Boeing. Operations continued to struggle with post-September 11th challenges that included reduced training, reflecting fewer overall flights, and cost to expand fractional jet service into Europe. Finance and financial products. Within the finance and financial products business category, pre-tax earnings grew from $519 million in 2001 to $1 billion in 2002. Considering that included a $173 million loss related to winding down General Re Securities, contributions from elsewhere were significant. A large part came from Buffett himself, who conducted undisclosed arbitrage-related activities in highly rate-fixed income securities. Another boost came from Berkshire's earnings in its stake in Value Capital, a limited partnership run by former Geico CEO Jack Byrne's son, Mark. Viewed in two broad categories, insurance underwriting and non-insurance businesses, the progress made at Berkshire in 2002 was readily apparent. From an underwriting loss of $2.66 billion after tax and after minority interest in 2001, Berkshire's insurance group improved to a $292 million loss in 2002. On the non-insurance front, earnings jumped from $1.3 billion to $2.2 billion, again after tax, due largely to the addition of several new operating businesses. Berkshire was putting its cash to use productively and returning its core business of insurance to the top of the industry. Investments. Charlie Munger's favorite shareholder meeting group of nothing to add seems appropriate with respect to Berkshire's equity investments in 2002. M&T Bank made the $500 million cutoff to be included in the chairman's letter table for the first time, though it was not a new investment. American Express, Coke, Gillette, and Wells Fargo remained untouched. The only change was in the other category with about $600 million of additional investment at cost. Berkshire's equity portfolio remained concentrated, with 69% of its $28 billion year-end market value in the four returning companies just mentioned above. It seems Berkshire's equity portfolio would remain in a holding pattern for some time. Buffett told shareholders that, unless, however, we see a very high probability of at least a 10% tax return, which translates to 6.5 to 7% after corporate tax, we will sit on the sidelines. Asked about this 10% target at the next year's annual meeting, Buffett said it was nothing scientific, only a somewhat arbitrary point below which he would feel sloppy. He and Munger would rather endure low rates on earned cash than historically low at around 1.25% and wait for opportunities to earn higher rates. While equity markets weren't accommodating, credit markets offered an opportunity for Berkshire to put some of its surplus cash to work at attractive rates of return. A significant decline in the prices of junk bonds began in 2001 and continued into 2002. This improved the risk-reward scenario. As noted earlier, the Fruit of the Loom investment started as a junk bond investment. Berkshire's purchased $8 billion of additional junk bonds in 2002 in various energy and telecommunications companies. One notable purchase was $169 million cost of euro-denominated Amazon.com junk bonds at 57% of par, purchased after the company announced it would expense stock options, a practice that was optional at the time. The action gave Buffett confidence in the business and its management. Derivatives. As much as Buffett disliked the accounting of stock options, he thought derivatives as a class represented a true risk to the real economy. Buffett railed against the widespread use of derivatives and their potential to cause unintended harm, devoting 2 pages of his chairman's letter to it. Derivatives, as the word implies, are contracts that derive value from the performance of an underlying entity such as an asset, index, or interest rate. Buffett called them time bombs and saw their potential to aggregate risk rather than disperse it. Once concentrated into a few counterparties, these would then pose systemic risk to the financial system and the broader economy. Derivatives carry dangers that, while not latent, are potentially lethal. In December 2001, Enron's bankruptcy filing shined a light on the dangers of derivatives. Enron had created a market for energy-based derivatives. When the market collapsed, Enron shareholders lost $74 billion. Less than a decade later, their dangers would again be on display during the real estate crisis, in that case due to mortgage-backed securities. The problem was not the efficacy of derivatives to shift risk among parties on a micro level, but their aggregated effects. One entity taking the risk of another at times made sense, such as a manufacturer hedging a key input so that costs are known and fixed prices can be established. The issue arose on a micro level where certain intermediaries collected many of those microtransactions. These intermediaries would then seek to hedge their own risks with the use of still more derivative transactions, thinking themselves protected. This is the type of behavior that General Re Securities undertook, eventually finding itself with over 14,000 contracts with 672 counterparties. Disaster could and did strike when a key counterparty failed or several down the line failed to keep their promises. This could cause a chain reaction that wiped out many once strong institutions. Think of Enron. Another related pernicious effect of derivatives went on accounting and compensation. Buffett and Munger had first-hand knowledge from their time at Solomon and then at General Re of how hard some derivatives were to value. With sometimes thin trading, many derivatives were marked to model, meaning accountants couldn't use market data to establish their value and instead relied on a calculation of value. Oftentimes, these models were constructed by the same people compensated for their results. Accountants, to their shame, sometimes failed to question them. Optimism seeped in, of course, and some contracts had a profit attached to it on both sides of the transaction, which clearly could not be the case. Further, since many contracts spanned years or decades, the results of bad bets would be felt long after the traders who booked them received their own paychecks. Berkshire began winding down General Re's derivatives at the start of 2002, realizing losses in the process. Square's Notes. Berkshire issued a first-of-its-kind security during 2002. It was done with the help of Byron Trott, a Goldman Sachs banker who would play an increasingly large role in Berkshire's acquisitions and financing over the coming years. Christened Squares, S-Q-U-A-R-Z, the $400 million issue carried a negative interest rate in exchange for the right to purchase shares in Berkshire at a premium. See Table 6.31. The issue was broken up into $10,000 par value notes in November 2007. Each required the holder to pay Berkshire 3.75% annually for the right to a 3% coupon and the ability to convert the notes into 0.1116 BRK A shares. Thus, Berkshire was paid 0.75% net annually. What did the term of the Squares note say about Berkshire's prospect as judged by each side of the transaction? Those purchasing the notes would benefit only if Berkshire shares increased at a steady clip over the ensuing 5 years, but the rate of return would be lower than the underlying change in share price because of the large upfront premium to both the underlying share price and book value. If the share price declined, holders could elect to receive their cash back at maturity, after paying Berkshire for the privilege. The advantage of the Squares notes lay almost entirely with Berkshire, yet investors nonetheless found them attractive, perhaps due to Berkshire's historical rates of return. Berkshire had the benefit of 1. Upfront use of the cash, 2. Annual interest income from the negative interest rate, 3. Low effective cost if the notes were converted into shares. Buffett was effectively monetizing his modest outlook for Berkshire's future returns. Accounting lessons. Buffett's 2002 chairman's letter purported to be the first to include a negative pro forma adjustment to earnings. He was poking fun at a very serious problem gripping the accounting and business world. Some companies of the day touted adjusted numbers that sought to exclude one-time or non-recurring items. These appeared to make sense on the surface, but over time they served to divert the reader from what was happening. Buffett's jab in his letter was a downward revision, since others adjusted upward without fail, to correct for Berkshire's benefit from no catastrophe losses in 2002 and some outsized gains Buffett booked in the financial products business. His lessons for investors were simple and founded on a base of sound skepticism. Lesson 1 was be wary of companies displaying weak accounting. He used 3 examples. 1. Companies not expensing stock options, which was still optional at the time. 2. Overly optimistic pension assumptions. 3. And companies and managers touting EBITDA, earnings before interest, taxes, depreciation, and amortization. The D in EBITDA, depreciation, particularly bothered Buffett. He said ignoring depreciation was akin to ignoring some other real expense. Just because depreciation was considered non-cash, since no cash went out the door after the initial capital outlay, it was still an expense. Further, it was the worst kind of expense, since money went out the door day one and was only recouped over time as the expense was charged against earnings. He knew from first-hand experience that companies not spending their average depreciation would fall behind in real terms. The second lesson was to be skeptical of unintelligible footnotes. He thought such fuzzy disclosures indicate untrustworthy management. If a reader couldn't understand them, it was probably not their fault, and it could be because the CEO didn't want them to. His third lesson was to have a healthy level of skepticism. It's worth repeating in its entirety. Finally, be suspicious of companies that trumpet earnings projections and growth expectations. Businesses seldom operate in a tranquil, no-surprise environment, and earnings simply don't advance smoothly, except, of course, in the offering books of investment bankers. Charlie and I not only don't know today what our businesses will earn next year, we don't even know what they will earn next quarter. We are suspicious of those CEOs who regularly claim they do know the future, and we become downright incredulous if they consistently reach their declared targets. Managers that always promise to make the numbers will at some point be tempted to make up the numbers. Business results fall where they may, Buffett would always tell the unvarnished truth. Chapter 10, 2003 to 2004. 2003. Berkshire's gain in book value per share fell behind the S&P 500 for the first time in 3 years. While Berkshire's 21% gain was itself highly satisfactory, the 7.7% lag nonetheless represented the 5th time since 1965 that it had fallen short of the market. Part of the reason had to do with the changing nature of the company. Berkshire's fortunes were less tied to its marketable securities portfolio after it completed a slew of acquisitions. A higher proportion of capital invested in operating businesses would cause performance to lag in an up market like 2003, but lead to outperformance during market downturns. Capital allocation decisions and operating performance in 2003 were far from disappointing. On the contrary, Berkshire added important non-insurance subsidiaries to its roster, and the insurance group turned in underwriting profits fit for praise. Insurance. Last year was a standout, wrote Buffett of 2003 insurance group performance. The group turned in an underwriting profit of $1.7 billion, and float grew to a record $44 billion. All 4 of its main insurance segments contributed. Berkshire Hathaway Reinsurance Group continued its tradition of overachieving, General Re was fixed, Geico continued to impress, and Berkshire Hathaway Primary Group remained stellar. Berkshire Hathaway Reinsurance Group. Ajit Jain's group at BHRG again impressed during 2003. Its total underwriting gain of $1 billion on $4.4 billion of earned premiums was in large part due to a lack of catastrophes. The catastrophe and individual risk segment, the segment holding the catastrophe risks, earned $1.1 billion on its $1.3 billion earned premiums for the year. Its maximum probable loss from a single event was $6.7 billion. Such a loss would swamp several years of gains, but its operating philosophy was sound with expectations of modest profits over the long term, catastrophes included. Individual risks also contributed to profits in 2003. Jain's group found easy bars to step over. One was a Pepsi promotion where Berkshire insured a $1 billion prize. No one won. Such mammoth and unusual risks were bread and butter for BHRG. The retroactive reinsurance segment reported a $387 million loss on $526 million of earned premiums. This was a good result considering amortization of deferred charges hit losses to the tune of $400 million a year, regardless of premium volume. Even with low levels of earned premiums and reported losses, the retroactive reinsurance segment remained a money generator for Berkshire. This segment alone accounted for $7.7 billion of the nearly $14 billion of float attributable to BHRG. Buried in the footnotes in 2003 was an unusual $41 million gain attributed to the BHRG retroactive segment relating to a commutation of contracts written in prior years in exchange for payments of $710 million. What was going on here? While retroactive reinsurance contracts are typically long-term arrangements, they are sometimes prematurely terminated. The $710 million represented a payment by Berkshire to the original ceding company, essentially giving them back some of their original premium. The $41 million was the accounting gain relating to over-reserving expected losses from those contracts. The net effect was a reduction in float for Berkshire as the premium was returned. Other activities at BHRG in 2003 included $2.6 billion of earned premiums and $326 million of underwriting profit on traditional multi-line businesses, with a large part coming from Lloyd's of London syndicates. General Re. The fixtures of General Re, CEO Joe Brandon and President Tad Montrose, received Buffett's praise for restoring underwriting discipline to Berkshire's problem child. The company was still beset by some unfavorable prior year loss estimates. Nonetheless, General Re managed to eke out a $145 million underwriting gain on $8.2 billion of earned premiums. General Re's North American segment, which recovered its underwriting to a $67 million profit on $3.4 billion of earned premium, improved most. This was up from a staggering loss of $1 billion on $4 billion of earned premiums in 2002. The segment was able to do this via a combination of increased pricing, which was partially responsible for the lower premium volume, and a lack of major catastrophes during 2003. Its current year gains, underwriting attributable to just 2003, were $200 million, but those were offset by $133 million of adjustments relating to prior year losses. Included in those prior year loss adjustments were increases to director and officers' insurance liabilities resulting from the fallout from the scandals of the early 2000s. Director and officers' insurance provides protection to executives for claims arising from their governments and management of companies. Claims for misconduct in prior years, and the related adjustments insurance companies make to account for them, happen after the fact since most claims come to light only after a major scandal or bankruptcy. One drag on General Re's North American underwriting results in 2003 was a change to the discount rate used to value workers' compensation claims. Berkshire changed its rate of discount of 4.5% for claims prior to 2003 and began using a 1% rate. This weighted those liabilities closer to the present, which necessitated a $74 million charge in 2003. The international segment of General Re improved similarly in 2003. While premiums earned increased about 6% to $1.9 billion, they only did so as a result of the weakness in the U.S. dollar. Absent such currency-related tailwinds, premium volume declined over 8%. A $20 million pre-tax underwriting gain was a marked improvement from the $319 million loss booked in 2002 and came after a $104 million addition to loss reserves. Berkshire disclosed more details on General Re's activities in the Faraday or London market, which was previously and subsequently included as part of International. General Re participated in 61% of the Faraday Syndicate 435 business in 2001, 97% in 2002, and 100% in 2003. This additional information showed that most losses were outside of Faraday. The segment was responsible for $200 million of losses between 2001 and 2003, inclusive, with $178 million of that coming in 2001, which was just a fraction of the $921 million of pre-tax loss from the segmented international property casualty results over that same time period. The General Re Global Life Health segment reported a $58 million gain in 2003. Most of the gains were in its international business. Geico. Geico had excellent results in 2003, even by its own high standards. Preferred policyholder count grew 8.2%, and non-preferred grew 21.4% for a 10.9% overall growth rate. Premiums grew 16.7% to $7.8 billion on the heels of the unit growth and a 2% average premium rate increase. Such high growth rates necessitated expansion, and in 2003 the company announced an expansion into Buffalo, New York. It was no coincidence that it was in the same city as Berkshire's newspaper, the Buffalo News. Stan Lipsey, the paper's publisher, was instrumental in the expansion, which would eventually add 2,500 new jobs. Even with its ever-increasing need for more employees in space, Geico kept costs down and profits up. Geico boosted advertising during the year and still achieved a combined ratio of 94.2%. Moreover, growth in premiums and policies reflected an increasing market share. From the time CEO Tony Nicely took over in 1992 to 2003, Geico more than doubled its market share from 2.1% to 5%. Berkshire Hathaway Primary Group. The primary group turned in an underwriting profit of $74 million on premiums of $1 billion. Its float grew 41% to $1.3 billion. How could Buffett and Munger be anything but pleased with this group of managers? It seemed every year the group turned in higher premiums, higher profits, and more float. Buffett's comment in his letter to shareholders in 2003 sums up the group nicely. These men, though operating in unexciting ways, produced truly exciting results. Acquisitions. During the year, Berkshire agreed to acquire two companies, Clayton Homes, a leading producer and financer of manufactured homes, and McLean, a distributor of goods to convenience stores and related outlets. Clayton Homes. The Clayton acquisition came about in a most unusual way, even for Berkshire. Buffett long hosted groups of students who flocked to Omaha to hear him speak. On one such visit, he received an autobiography of Clayton founder Jim Clayton from a group of Tennessee students. Buffett had some familiarity with the Tennessee-based Clayton Homes, but he had not studied the company to any great extent. Clayton was a big business. It had 20 manufacturing plants, 300 company-owned stores, over 500 independent retailers, and 89 housing communities. It also had a financial services arm that played an integral role in the company's success. Buffett's newly piqued interest combined with industry turmoil led Berkshire to make an offer for Clayton. Some of Clayton's competitors engaged in poor lending practices to sell homes or make loans to unqualified consumers. Such practices continued longer than they otherwise would have because most loans were securitized. Securitization is a process where many loans are packaged together and sold to investors. Those investors then take on the risk of borrowers defaulting from the manufacturer originators. Once credit problems began to materialize, the ability to securitize dried up and affected Clayton's ability to obtain financing and in turn lend to its own customers. Clayton's board of directors recognized Berkshire's ability to provide financing and agreed to sell to Berkshire. Berkshire paid $1.7 billion for Clayton. The deal closed on August 7, 2003. When Berkshire completed the acquisition of Clayton Homes, it placed its operations in the finance and financial products category. At first, this seems quite odd. That is, until the extent and importance of its financing business becomes apparent. The basic business model worked like this. A manufacturer like Clayton produced a home and marketed it through a distribution channel that could include its own stores or other retailers. Clayton had a mix of both. The home was either purchased for cash or, more likely, with financing provided by an unrelated third party or a financing arm of the manufacturer. Over time, lenders incented to make loans and manufacturers incented to sell homes loosened their standards and began pushing homes and loans on unsuspecting customers with poor credit. To increase their volume of business, the financing was often securitized. The original packages of the loans, incented to produce volume in perspective of repayment capacity, ultimately underwrote many bad loans. The resulting defaults then caused the securitization market to dry up, which affected everyone in the industry, including Clayton. When this happened, Clayton had no way to recoup its cash for additional loans. Berkshire's purchase solved that problem by providing almost unlimited financing to Clayton. Berkshire borrowed money and relent it to Clayton at a 1% spread. But why not just give Clayton the money since Berkshire had ample cash and it was now entirely owned by Berkshire? Buffett said Berkshire had a philosophy of every tub on its own bottom. He went on to explain, We believe that any subsidiary lending money should pay an appropriate rate for the funds needed to carry its receivables and should not be subsidized by its parent. Otherwise, having a rich daddy can lead to sloppy decisions. At year-end 2003, Clayton had just over $2 billion of such loans on its books to finance customers' purchases. Clayton's financing arrangements contain two lessons. One, financing interest-bearing receivables with debt is entirely appropriate. It was like a mini bank inside Berkshire that funded its interest-bearing assets with interest-bearing liabilities to take a spread. This was not the first of its kind at Berkshire. Scott Fetzer had a financing subsidiary that financed the purchase of World Book encyclopedias and Kirby vacuum cleaners this way. A second lesson from Clayton's financing was the role of credit risk and incentives. With Clayton under Berkshire's umbrella, it could retain all its loans from its customers. This meant it would ultimately bear the cost of underwriting bad loans and had an incentive to do good by its customers. The securitization model in which the industry previously operated failed in large part because lenders did not care about short-term outcomes. Requiring lenders to keep some of each loan would play a key role in reshaping the U.S. credit system after the Great Recession of 2009, where many subprime loans were resold in packages as mortgage-backed securities. Berkshire's purchase price of $1.7 billion suggests it paid a fair price for Clayton's straightforward business model and its history of consistent financial returns. However, its pre-tax return on capital appears to have been at a low in 2002 as a result of the cyclical nature of its business. Berkshire could see an upside benefit if Clayton could achieve its historical average return of 21%. It could also benefit by providing financing to Clayton and avoid expensive securitized financing. McLean. Berkshire's second major acquisition of 2003 was McLean. McLean came to Buffett's attention via Byron Trott, the Goldman Sachs banker who had worked on the Square's debt issue. McLean was a subsidiary of Walmart that had grown from Walmart's need to distribute products to many stores. The business then expanded to include non-Walmart stores such as convenience stores, drugstores, wholesale clubs, restaurants, and theaters. Not surprisingly, Walmart accounted for 35% of McLean's revenues. McLean conflicted with Walmart's competitors because of its growth, leading Walmart to sell the subsidiary. Berkshire paid Walmart $1.5 billion for McLean, with the transaction closing on May 23, 2003. See Table 6.34. The business was simple and understandable and fit right in with Berkshire's other non-insurance businesses. From an earning power standpoint, McLean's business was not all that unusual. Its profit margins compared to other Berkshire subsidiaries, however, were. McLean was a no-value-add type operation. It simply moved products from one location to another. Consequently, it commanded slim margins, so slim that it earned just 1% pre-tax on a massive $23 billion of revenues. This was a figure greater than all of Berkshire's non-insurance subsidiaries combined. While it was profits, not revenues, that mattered, accounting conventions required that businesses be reported based on their revenues. As a result, McLean would have to remain a separate reporting item in all Berkshire's financial reports going forward. McLean's thin profit margins are a good lesson on the importance of focusing on the right variables in business analysis. Profit margins would seem to be a good indicator of the desirability of a business, and indeed they do carry some important information. As McLean proves, however, a small profit margin can translate into a satisfactory return on capital, provided enough turnover. Non-insurance businesses. As Berkshire's stable of businesses grew in number, it became challenging to report results to shareholders in a useful and intelligible way, or as Buffett put it, without turning out something as long as the World Book. In 2003, the long familiar sources of reported earnings was omitted from the chairman's letter. In its place, Buffett reported on Berkshire's four major operating sectors. 1. Insurance. 2. Regulated utility businesses. 3. Finance and financial products. 4. Manufacturing, service, and retailing. Buffett said his goal was to give shareholders the facts he and Munger would want if roles were reversed, without providing data inessential to calculating Berkshire's intrinsic value. He also cautioned shareholders to be careful in their analysis and to remember that the company should be viewed as an unfolding movie, not as a still photograph. Those who focused in the past on only the snapshot of the day sometimes reached erroneous conclusions. With Berkshire's policy of retaining all its earnings, the reinvestment factor was an important part of the valuation exercise. Regulated utility businesses. Since the insurance group was presented above, we will start with the utility businesses, all under the umbrella of Mid-American. Mid-American's $1.1 billion of earnings before interest and taxes, EBIT, broke down as follows. $289 million, UK utilities, $269 million, Iowa-based utility businesses, $261 million, pipelines, $113 million, home services, $144 million, other income. Mid-America's 2003 EBIT increased 36%, and its net earnings of $416 million were up 9% from the year before. These increases were largely due to the new pipelines funded with additional capital contributions. Mid-America owed $10.3 billion to others and $1.6 billion to Berkshire Hathaway. Including interest income, Berkshire's earnings from Mid-American were $429 million, up from $359 million a year before. Finance and financial products. The finance and financial products segment had the feeling of a drawer of financial odds and ends. All were important businesses and capital allocation activities. Because of the bank-like nature of these activities, they were largely supported by borrowings. One of the largest businesses was trading, which earned $379 million in 2003 and was supported by $7.8 billion of interest-bearing liabilities at year-end. This was an operation managed entirely by Buffett and consisting of a few opportunistic strategies in AAA fixed-income securities. Though far from foolproof, these transactions involve no credit risk and are conducted in exceptionally liquid securities. In other words, an arbitrage operation. The flip side to Buffett's operation was Gen Re Securities, where the derivative business continued to lose money as it wound down. Gen Re Securities lost $99 million pre-tax during 2003 as outstanding contracts shrunk almost 50% from the year before. Such a slow unwinding illustrated a major risk of derivatives. Berkshire was trying to exit during a time of market tranquility. What would happen if markets wouldn't or couldn't work in an orderly fashion? That question would be answered in just a few years. Another investment included in this segment was Berkshire's investment in Value Capital, a fund run by Mark Byrne. Buffett noted that though the fund had close to $20 billion of debt, the operation was sound and Berkshire did not guarantee the debt. At year-end 2003, Berkshire had a net investment of $634 million in Value Capital after receiving a $30 million distribution. The more natural components of this segment were the trailer leasing business, Extra, which was reported under leasing operations, and the life and annuity business. The segment also contained the Berkshire operation, which was nearly completed at year-end 2003. As was noted earlier, Clayton's entire operations were included in the finance and financial products segment due to the size of its financing operation, even though it also manufactured and sold housing units. All told, the finance and financial products segment earned $666 million pre-tax in 2003 compared to $775 million in 2002. These figures were before $1.2 billion and $578 million of pre-tax capital gains in 2003 and 2002, respectively. Manufacturing, service, and retailing. As the years went on, Buffett's sources of reported earnings table had been consolidating certain businesses with others. Home furnishings and jewelry became retail operations. Scott Fetzer's non-finance businesses were reconsolidated back into that category, and the Buffalo News, the Shoe Group, Dairy Queen, and See's Candies were lumped into other businesses. Beginning in 2002, the table disappeared, but the commentary and the annual report footnotes still contain line items for apparel, building products, flight services, McLean, and Shaw Industries. These businesses could be viewed as one sector because of their similarities, though detail was provided for many businesses where needed or important. Each business in the group was closer to a typical business that required working capital, fixed assets, and some limited amounts of debt than the insurance or utility sector. To aid analysis, Buffett now presented a summary balance sheet and earnings statement for the MSR group that was like the supplemental disclosure presented up until 2000. Buffett said the eclectic group, which sells products ranging from dilly bars to B737s, earned $1.3 billion on $32.1 billion of revenues in 2003. The resulting 20.1% return on average tangible net assets, tangible equity, was evidence of their above-average economic characteristics. While we don't have information from 2002 to compare, we know the manufacturing, service, and retailing businesses earned higher returns in the past. In 1994, the first year of the former presentation, after-tax return on equity was 32.4%. Returns dropped to the low 20% range by the late 1990s as Berkshire acquired additional businesses. The new businesses were very good, just not quite as good as the earlier ones. Struggles in footwear and publishing hurt results too. Buffett judged businesses and their operating managers based on returns on capital employed, but Berkshire paid a premium to acquire many of its subsidiaries, and he judged himself based on total purchase price, which included goodwill. Berkshire's after-tax return on carrying value for the MSR businesses was just 9.2% in 2003. Berkshire separated purchase accounting and goodwill accounts to enable shareholders to distinguish the true quality and performance of the businesses and their accounting representation. The building materials business, Acme Brick, Benjamin Moore, and Mytech, earned 21% on tangible net worth. This was quite an impressive statistic for boring businesses. The businesses collectively earned $559 million pre-tax, up 8%, on revenues of $3.8 billion, up 4%, benefiting from strong housing demand. Shaw also benefited from the strong housing market and earned $436 million pre-tax, up 3%, on revenues of $4.7 billion, up 8%. In November, Shaw acquired a related carpet business from Dixie Group, which added $240 million to its revenues. Fruit of the Loom, under the direction of John Holland, returned to profitability and now accounted for 42% of the men's and boys' underwear sold by large retailers. Its women's and girls' share increased to 14%. Two of Berkshire's furniture retailers owned new stores during 2003. R.C. Willey owned a hugely successful store in Las Vegas, which was even more impressive given its closed-on-Sunday policy, and Nebraska Furniture Mart opened a large store in Kansas City, Missouri. Revenues for the retail segment, which included the jewelry businesses, increased 10% to $2.3 billion, but pre-tax earnings remained flat at $165 million due to startup costs for new stores. Flight services continued to experience some turbulence. Combined pre-tax earnings fell 68% to $72 million. Flight Safety earned $113 million after writing off $37 million in obsolete simulators. NetJets, Executive Jet now went by this name, lost $41 million as it continued to struggle despite being the dominant player in the fractional jet industry. The NetJets loss included a $32 million loss on aircraft inventory, on top of continued operating losses building out its European business. Buffett remained upbeat on both businesses and noted that both Flight Safety and NetJets were leaders in their fields. The apparel business continued to struggle. While the additions of the Fruit of the Loom and Garin increased reported pre-tax earnings to $289 million on revenues of $2.1 billion, revenues declined 5% and earnings declined 11% on a comparative basis. Investments. Berkshire's portfolio of equity securities moved just faster than glacial speed in 2003. Buffett reminded shareholders its major positions hadn't changed in a long time. Coca-Cola, 1994, American Express, 1998, Gillette, 1989, Washington Post Company, 1973, and Moody's, 2000. The one exception was Wells Fargo, whose cost basis increased by $157 million. This raised Berkshire's position by 3.2 million shares and brought its ownership interest to about 56.5 million shares and 3.3% of the company. Two new companies made the $500 million threshold to be included in the chairman's letter. HCA Incorporated, a company that ran hospitals, and PetroChina, an oil and gas company. Berkshire had 15.5 million shares in HCA, representing a 3.1% interest in the company. At year-end 2003, it had 2.3 billion shares in PetroChina, representing a 1.3 interest in the Chinese company. Buffett expressed neutral feelings on the portfolio, both in his letter to shareholders and at the next year's annual meeting. We are neither enthusiastic nor negative about the portfolio we hold. We own pieces of excellent businesses, all of which had good gains and intrinsic value last year, but their current prices reflect their excellence. While the intrinsic values of these companies increased, so did their share prices. This did not create a price-value discrepancy wide enough to make major changes. Buffett also discussed Berkshire's default position, which was to place any surplus cash in U.S. Treasuries. He said Berkshire would never reach for a little more income by dropping our credit standards or by extending maturities. Charlie and I detest taking even small risk unless we feel we are being adequately compensated for doing so. Knowing that markets could turn quickly and valuing certainty, Berkshire placed its excess cash in the safest, most liquid securities available. Governance. Berkshire added 4 new board members to its roster in 2003. This brought its total to 11. The 4, all friends of Buffett, were David Gottesman, Charlotte Guyman, Don Keough, and Tom Murphy. Don Keough, a former Coca-Cola executive who now served as chair of Allen & Company, and Tom Murphy of Capital Cities ABC were already known to Berkshire shareholders through Buffett's writings and comments over the years. Buffett had known David Sandy Gottesman for almost as long as he had known Munger. Gottesman had partnered with Buffett and Munger in the Hochschild-Kahn department store acquisition in the mid-1960s, which was purchased via Diversified Retailing, the entity that was eventually merged into Berkshire Hathaway. The last addition was Charlotte Guyman. Guyman retired from Microsoft in 1999, and at the time of her appointment to the Berkshire board, she was chair of the Finance Committee of the University of Washington Medical Center. All of Berkshire's directors shared common traits essential to Buffett. To start, each director and his or her family owned at least $4 million of Berkshire stock that they had, importantly, acquired themselves and held over many years. 6 had fortunes that included hundreds of millions of dollars worth of Berkshire stock. This meaningful level of ownership aligned their interest with those of rank-and-file shareholders, wrote Buffett. He said the common trait among the group was business savvy, a shareholder orientation, and a genuine interest in the company. Buffett valued their independence, even though not all of them met the strict SEC test. Buffett's wife Susan and son Howard clearly failed the test as family members. Their role was to ensure the culture of Berkshire continued intact once he was no longer in control. Ron Olson also failed the test because his firm, Munger, Tolles, Olson, performed legal work for Berkshire. Buffett reasoned that the single-digit percentage of income Olson received from Berkshire would not be enough to cause him to lose his independence. Buffett pointed to the directorship of other corporations, including mutual funds, whose directors derived a significant percentage of their income from directors' fees, but were nonetheless considered independent per SEC rules. Berkshire would comply with the SEC rules, though it would do it in such a way that ensured it was to Berkshire's shareholders' benefit, not just to meet a technical test. Buffett defined true independence not by family or financial ties, but as the willingness to challenge a forceful CEO when something is wrong or foolish. Gifts Program. Berkshire's designated gifts program had directed $197 million to thousands of charities since its inception in 1981. In 2003, that program was terminated due to politics. Individuals and groups who were pro-life had begun to boycott Pampered Chef because of Berkshire's donations, at the direction of shareholders, to pro-choice charities. Buffett said it did not matter to these groups that other Berkshire shareholders had donated to pro-life organizations. Buffett and Munger terminated the program after judging the negative impact to the independent consultants as greater than the benefit. Burlington Industries. In early 2003, Berkshire placed a bid for bankrupt former competitor Burlington Industries. Burlington had labored on long after Berkshire got out of the textile business. Not surprisingly, it struggled mightily. The bid was a $500 million offer to the bankruptcy court to buy Burlington. Ultimately, the court decided that Berkshire's $14 million breakup fee, less than 3% of the offer, was too rich. 2004. Berkshire just missed matching the S&P 500 in 2004. Its 10.5% increase in per-share book value fell 0.4% behind the benchmark. The cause was the self-forged anchor Buffett long predicted. Berkshire's operating businesses, with their 400 sluggers, were hitting it out of the park, but that success and the resulting growing cash pile in Omaha had no immediate profitable outlet. As was typical of Buffett, he blamed himself for not finding operating businesses or marketable securities to put Berkshire's now $43 billion cash pile to work. Insurance. Buffett devoted a few pages of his chairman's letter to a history of how Berkshire had grown from a $20 million float business in 1967 to its 2004 collection of excellent insurance businesses with over $46 billion of float. He asked, how had Berkshire overcome the dismal economics of the industry? The answer? Discipline, correct incentives, and capital strength. The chairman's letter presented a portrait of a disciplined underwriter, a summary table of National Indemnity's key metrics from 1980 to 2004. Over that time, it had some loss years, but overall wrote to a profit. It also survived the decade-long slump in premiums that tested its managers and employees. National Indemnity had grown to $366 million of written premiums in 1986, and then endured 13 years of declines in volume, ending 1999 with just $54.5 million of premiums written before rocketing back to $606 million in 2004. Importantly, in each of those 13 down years, National Indemnity wrote to an underwriting profit. Subsequently, the only loss year was 2001. Buffett contended that other insurance companies could not or would not endure the unrelenting decline in volume. Where its competitors were focused primarily on volume, National Indemnity focused solely on profitability. Even though huge volumes of business were available, National Indemnity only accepted risk it understood and could price to a profit. Part and parcel to the disciplined underwriting were incentives that encouraged such behavior. Starting with National Indemnity, employees of Berkshire insurance companies were rewarded based on profitability, not volume. The incentives at National Indemnity extended to a no-layoff policy, which dissuaded writing business to justify an employee's existence. This did not mean indiscriminate spending on personnel. Costs would have to be controlled, but Berkshire tolerated higher levels of operating expenses than its competitors. National Indemnity and Berkshire's other insurance businesses also possessed above average, and usually far above average, capital strength. Capital strength was less important to National Indemnity in its primary operations. After all, no one bought an auto policy based on name brand. Price was usually the deciding factor. But capital strength allowed Berkshire's insurance companies to market themselves to knowledgeable buyers, including other insurance companies, via its reinsurance operations. Once Berkshire entered the reinsurance field, Buffett quickly realized that capital strength could be a huge advantage. Primary insurers looking to shed risks they might have to collect on years in the future understandably sought out a well-capitalized reinsurer to pay the bill. So too would buyers of supercap policies with large covers. Berkshire, bolstered by its conservatism and capital, was and is a standout. Another way to prosper in a commodity-like business is to be the low-cost operator, and Geico was among the best. Its direct-to-consumer distribution model provided a price advantage over rivals. Though the company had lost its underwriting discipline in the 1970s, it avoided bankruptcy. Under Berkshire's complete ownership, it had flourished as a disciplined and much larger enterprise with an almost 6% market share. Perhaps Buffett's most important job as overseer of the insurance managers was to monitor and reinforce the culture of discipline. His guidance was needed after General Rhee stumbled, but Berkshire was blessed to have managers like Tony Nicely at Geico, Ajit Jain at Berkshire Hathaway Reinsurance Group, and many others within the primary group who operated with strong discipline. Each of Berkshire's major segments within the insurance group reported a profit in 2004. On $21 billion of premium volume, the group earned $1.6 billion pre-tax, producing Buffett's highly valued negative cost of float. Float increased by 6% to $46.1 billion at year-end. Geico. Geico continued to shower profits on Berkshire. In 2004, its 89.1% combined ratio produced a pre-tax profit of almost $1 billion. Premiums earned grew 14.5%, reflecting an 11.8% increase in policies in force, on top of a 2% rate increase. Part of the growth resulted from expanding into a new state during the third quarter of 2004. Prior to this, the state of New Jersey had a tough regulatory climate, and GEICO chose not to do business there. GEICO now served 140,000 customers in New Jersey, or about 4% of the state. A clear vote of confidence in GEICO's ability to save its customers money. While GEICO held its overhead in check, it was the loss experience that really boosted the results for the year. GEICO experienced lower claims frequencies in physical and bodily damage, which more than offset the increased severity it saw in both categories. General Re. Berkshire's former problem child demonstrated it was refocused on the one thing that mattered, profitability. It raised prices and rejected unsound risks. Consequently, it allowed written premiums to fall 14.5% to $6.9 billion. Earned premiums declined 12% to $7.2 billion. General Re earned a second year of underwriting profits with a $3 million gain. The profit meant its cost of float was technically negative, but the pullback in writing new business caused float to shrink 2% to $23 billion. North American property casualty earned premiums fell 15% to $3 billion. Current year gains of $166 million included $120 million of catastrophe losses from 4 hurricanes that hit the U.S. Unfavorable loss development of $155 million brought the profit down to $11 million. International property casualty business earned premiums fell 22% to $2.2 billion. Hurricane-related catastrophe losses of $110 million and $102 million of unfavorable loss development contributed to a pre-tax underwriting loss of $93 million. Global life health earned premiums grew 9% and reported an $85 million underwriting profit. Over half of the premium growth was a result of a weaker dollar against foreign currencies. Berkshire Hathaway Reinsurance Group, BHRG. Berkshire's untarnished reinsurance gem was hitting on all cylinders. It reported an overall profit of $417 million on earned premiums of $3.7 billion, down 16%, and grew float 9.5% to end the year at $15.3 billion. BHRG's float represented one-third of Berkshire's total float. Declines in volume in the retroactive reinsurance and multi-line segments echoed Gen Re's experience, which was general pullback due to inadequate pricing. Earned premiums and multi-line business declined 20% to $2.1 billion, but profits grew 36% to $444 million on gains from aviation coverage and commutations. Retroactive insurance almost fell off the map in 2004. From a high of almost $4 billion in 2000, earned premiums had fallen each year to $188 million in the current year. That line booked a $412 million loss, which was largely attributable to amortization of deferred charges. The catastrophe and individual risk segment would have declined during the year had it not been for several contracts reinstated after the hurricane losses. Even after $790 million of hurricane-related catastrophe losses, the catastrophe and individual risk segment reported a $385 million profit. Berkshire Hathaway Primary Group. The primary group had another good year in 2004. Earned premiums grew 17% to $1.2 billion, and favorable claims experience led to a 118% increase in underwriting profit to $161 million. Its float ballooned 30% to $1.7 billion. Manufacturing, service, and retailing. Berkshire's eclectic group of manufacturing, service, and retailing businesses continued to produce good results despite some acute cost pressures. A separate balance sheet and income statement reappeared in the chairman's letter and provided additional detail. The MSR businesses earned $1.5 billion on revenues of $44 billion in 2004. The addition of McLean in 2003 made a comparison to prior years difficult. A better comparison, return on tangible equity, improved from 20.7% in 2003 to 21.7% in 2004. Strong growth in the U.S. economy, led by housing, played a part in the improved results. The strong construction market led the building products segment to increase revenues 13% to $4.3 billion. Pre-tax earnings increased 15% to $643 million. Earnings would have increased just 11% if not for a fire the year before at an insulation plant. Digging into some unit-specific results, Mytech, the building products business and a heavy user of steel, experienced a 100% increase in steel costs. Other businesses in this group also experienced increased input costs, which negatively impacted margins. At Shaw, input costs for carpet increased significantly due to rising oil prices. Many synthetic fibers are made from oil. Shaw's input cost increases were followed by price increases to customers, though on somewhat of a lagging basis. Shaw nonetheless turned in an excellent year. Its revenues increased 11% to $5.2 billion on higher volume and higher pricing, and from the two acquisitions the year before. Its pre-tax earnings rose 7% to $466 million, which represented a 26% return on tangible equity. Fruit of the Loom increased its unit sales by 10%, including a 31% increase in the women's and girls segment. That carried the apparel segment to a 6% increase in revenues to $2.2 billion. Pre-tax earnings in apparel improved 12% to $325 million. Margin pressures at Fruit of the Loom kept its contribution to earnings at half, while H.H. Brown, Justin, and Garan contributed the rest. Dexter by this time had been merged into H.H. Brown, and its specific results weren't disclosed. Berkshire's jewelry and furniture retailers were buoyed by the strong U.S. economy. Ben Bridge and R.C. Willey particularly stood out. Ben Bridge had 11.4% growth in same-store sales, topping off a decade where annual same-store sales growth averaged 8.8%. R.C. Willey, against Buffett's better judgment, expanded its Las Vegas presence with a second store located within 20 miles from the first. The result was a huge success. While retailing revenues increased 13% to $2.6 billion, same-store sales in 2004 increased just 2.4%. Pre-tax earnings declined 1% to $163 million as startup costs associated with the new stores weighed on profits. Flight Safety earned a 15.1% return on tangible equity during 2004. This was up from 8.4% in 2003 as a result of a return to higher usage of the company's simulators by corporate and regional airlines. The 2004 result was after another write-down of simulators, but not to the same degree as the prior year. Flight Safety's founder, Al Ulschi, while still involved in the business, turned over the CEO position to Bruce Whitman, a 43-year veteran employee. Buffett disclosed that Berkshire's subsidiary, NetJets, formerly Executive Jet, was Flight Safety's largest customer. This was not surprising given the average of 18 days NetJet pilots spent in training annually and the fact that the business was growing rapidly. NetJets captured 70% of net new business in 2004. Part of that growth was a result of a new non-affiliated company that was essentially further fractionalizing NetJet's ownership. The Marquee card, offered by Marquee Jet Partners, gave customers the ability to purchase flight time in 25-hour increments. Buffett and NetJets apparently were okay with this arrangement, perhaps because it fed volume into the system without additional overhead on their part. NetJet's profitability continued to lag, with some U.S. profits offset by expenses in building out its European business. Buffett pointed to the volume of U.S. customers taking intercontinental and intracontinental European flights as a reason to stay the course to become the market leader in Europe. McLean, the distribution business acquired in May 2003, increased its revenues by 6% to $23 billion and its earnings by 1% to $228 million compared to its full prior year results. Finance and financial products. Given Buffett's activities within this segment, large fluctuations were not uncommon. In 2004, pre-tax operating earnings fell 6% to $584 million, with some important changes in the details. Perhaps the most important segment within finance and financial products was Clayton Homes. This included manufacturing. The company was doing well under Berkshire's ownership. Buffett even ventured to use the word synergy to describe the benefit to both parties of Berkshire financing Clayton's financing activities. At year-end 2004, these interest-bearing liabilities had risen $1.5 billion to $3.6 billion. By January 2005, the total had risen to $7.35 billion. Buffett used the word inadequate to describe the poor but improving earnings at Court, the office furniture leasing business held under Wesco. He also noted that Extra, the trailer leasing business, had taken a play from Geico. Extra refocused on its core trailer leasing business and dropped the container and intermodal businesses it previously entered. The strategy appeared successful as pre-tax earnings rebounded from $34 million in 2003 to $92 million in 2004. One accounting-related change to this segment was value capital. Accounting rules dictated that large owners such as Berkshire Hathaway fully consolidate the financials of investees. Since value capital had found additional investors, Berkshire would be spared this requirement. Lastly, Buffett commented on the ongoing wind-down of General Re's derivatives business. He said that even in a benign market, the portfolio had been stubbornly hard to liquidate. This fact served to reinforce his and Munger's view that derivatives were weapons of mass destruction. Regulated utility businesses. Mid-American, in addition to its Iowa-based electric business, had grown to include a UK utility business and several pipelines. The company also owned a California geothermal operation that turned out to be a rare stumble for Mid-American's management team. Mid-American's geothermal operation offered a tantalizing opportunity to recover and modernize zinc from the brine in its geothermal wells. Starting in 1998 and lasting 4 years, Mid-American spent hundreds of millions of dollars trying unsuccessfully to make the project viable. It was ultimately shuttered when progress never materialized. The financial impact was a $579 million pre-tax loss in 2004 that included the project's write-off and followed a $46 million operating loss the year before. The zinc project offered a broader lesson. Because of the many steps involved in the zinc recovery process, even small chances of failure at each step would compound into very low overall success rate. Buffett reminded shareholders it was better to stay with simple propositions, bringing to mind his dictum to avoid trying to clear 7-foot bars and focus on finding 1-footers. Despite the zinc blunder, the core of Mid-American's business was doing well and improved earnings in each segment. Berkshire's 80.5% share of Mid-American's earnings fell 45% to $237 million, largely due to the write-off of the zinc project. Berkshire also had slightly lower interest income as a result of Mid-American using $100 million of excess cash to repay some debt owed to Berkshire. Investments. Berkshire's common stock investment changed little in 2004, but the cutoff to make the chairman's list grew to $600 million. There was one new name on that list, and it carried some historical significance. White Mountains Insurance Company was the remnants of the Fireman's Fund, the insurance former Geico CEO Jack Byrne ran after leaving his post. 4 companies accounted for 65% of the $37.7 billion portfolio. They were American Express, Coca-Cola, Gillette, and Wells Fargo. One statistic reflected Berkshire's business owner mindset, as contrasted to a short-term trader's mindset. Berkshire's equity investments had been held for an average of 12.5 years. Holding these investments through ups and downs, like an owner of a private business would, the normalized earnings from just those 4 now amounted to $1.2 billion, almost a third of their $3.8 billion purchase price. Foreign currency investments. At year-end 2004, Berkshire owned $21.4 billion of foreign exchange contracts across 8 currencies. This was a decided change for Berkshire, which owned no foreign exchange contracts before March 2002. The investments were an example of Buffett putting his and his shareholders' money where his mouth was. Over the past year or so, he became more vocal in public about America's worsening trade situation and even wrote an article in Fortune magazine. The crux of the matter was that the United States was overconsuming. Buffett thought the inevitable balancing effect would be depreciation of the dollar. Buffett's focus was almost always on microeconomics or the bottoms-up workings of the economy. But he was also well-versed in macroeconomics. Now the macro picture had changed significantly, providing Buffett with some certainty that something had to change and he could profit from it. It was admittedly outside of his normal scope of investment activity. Judging there to be a probability of a decline of the dollar, he bet on currencies. Buffett said he would have made the same decision had he owned 100% of Berkshire and was prepared to risk embarrassment if he was wrong. Buffett pined for something intelligent to do with the now $43 billion of cash on Berkshire's balance sheet. The marginal changes in the investment portfolio and the foreign currency investments were just activity around the edges. Buffett would remain disciplined, just like his insurance companies, and wait for an opportunity to swing the investing bat. His comment at the 2005 annual meeting was prescient. I think you will get a chance to do something that is more screamingly intelligent in not too many years and maybe a lot shorter than the alternatives that you're offered now. The Oracle of Omaha would be proven remarkably right. Decade in review. The word transformational could aptly be used to describe any decade of Berkshire's history. The 1995 to 2004 decade was notable for the wave of acquisition activity, in particular the growth in insurance through the acquisitions of General Re and the remainder of Geico. It was also notable for how little had changed. While the business world and economy were changed by the internet boom, Berkshire remained on the sidelines. Textiles were firmly in the past, but the lessons of investing in industries with sound economics was Berkshire's guide. Internet companies failed that test. Berkshire expanded in the two broad areas that now defined its business activities, insurance and non-insurance. The insurance businesses provided the double benefit of profits and showers of float to invest. Buffett shared his formula in his 1995 chairman's letter. Berkshire had benefited greatly to a degree that is not generally well understood because our liabilities have cost us very little. Buffett said a company's profitability is determined by three factors. 1. What its assets earn. 2. What its liabilities cost. And 3. Its utilization of leverage. Berkshire did a good job earning high returns on assets, but its liabilities also contributed to its outsized success. Not only did float provide leverage to enhance Berkshire's return on equity, it came at a negative cost and was therefore profitable. The hardships of the prior decades gave Berkshire a complete understanding of how to maximize the value of an insurance operation. The secret was as obvious and simple as it was difficult: discipline. Berkshire's insurance possessed a culture that prized profitability over volume, and this paid off handsomely. Comparing the sources of Berkshire's shareholders' equity growth between decades, we see that some sources changed little while others changed significantly. Net income from operations contributed about the same as it had in the prior 2 decades. Realized gains are also about the same proportion as in prior decades. Unrealized appreciation, however, had noticeably decreased. The big standout is in mergers and divestitures. During the 10 years ending in 2004, Berkshire made numerous acquisitions in both the non-insurance and insurance fields. By far the largest was General Reinsurance, with $22 billion of shares issued in connection with the merger. Numerous other acquisitions completed in whole or in part with shares, as well as the Squares notes, comprised the $3 billion balance. In total, about 1/3 of the increase in Berkshire's net worth could be chalked up to shares issued. All sources of equity considered, Berkshire increased its overall net worth by $74 billion during the 1995 to 2004 decade, a 623% increase. However, as Buffett frequently pointed out, the increase in overall net worth was not the real measure of success. The most important concern for shareholders was the change in per-share value. The increase in net worth translated into an annual rate of change of 21.9%. However, adjusting for the increase in shares outstanding, the per-share rate of book value change was 18.7% per annum. Berkshire's stock price increased at an even slower, but by no means unsatisfactory rate. A shareholder holding on at the average price between the fourth quarter 1994 and 2004 would have earned 15.6%. This 3 percentage point per annum deficit is explained by Berkshire's price-to-book value decline over the 10 years. While we cannot know for sure the reason for the decline in price-book, it wasn't interest rates. The 10-year Treasury declined yet again from 7.8% in December 1994 to 4.2% in December 2004. The more likely reason was reversion to a proper range of valuation guided by Berkshire's communications. Berkshire's market capitalization rose from an average of $24 billion at year-end 1994 to over $130 billion in 2004. Berkshire found itself 14th on Fortune magazine's 500 largest companies list. Berkshire went on a spending spree during the decade. The additional capital from float, which increased from an average of $3 billion at year-end 1994 to $45 billion at year-end 2004, and profits from existing operating businesses fueled the expansion. Berkshire made two very important insurance investments and a host of non-insurance investments. In 1996, it paid $2.3 billion to acquire the half of Geico it did not already own, and in 1998, it made the largest acquisition in its history with the $22 billion purchase of General Re. Both became catalysts for future growth in profits and float, though Gen Re went through some very difficult times to earn its worth. Berkshire created many powerhouses in jewelry and furniture retailing. It purchased jewelers Helzberg and Ben Bridge, and acquired furniture retailers R.C. Willey, Star Furniture, and Jordan's Furniture. In each case, Buffett allowed their managers complete autonomy to operate independently post-acquisition. Berkshire also shunned the tech boom and doubled down on decidedly low-tech but proven cash-generating businesses important to everyday life. Some were household names, others were important to the workings of the economy, but largely unknown to the average consumer. Berkshire welcomed Justin Industries, Benjamin Moore, Shaw Industries, MyTech, Albeca, Larson Jewell, CTB, Garan, The Pampered Chef, Clayton Homes, and McLean. In addition, 3 new operating subsidiaries, Johns Manville, Fruit of the Loom, and International Dairy Queen, came to Berkshire after stumbling on their own. Berkshire's capital allocation strategy was subtly beginning to shift with the acquisition of a major economic interest in Mid-American. Finding it difficult to deploy capital into either wholly owned business or part ownership interest in common stock, Berkshire found an outlet for some of its cash in highly stable, though capital-intensive utility businesses. Returns from these investments would not come close to the potential of other non-regulated businesses. But their relative certainty, coupled with the ability to put large incremental sums of capital to work, represented a logical outlet for Berkshire's excess cash. Opportunities to put Berkshire's cash to work could not come fast enough to keep it from piling up at headquarters. Even with the large volume of acquisitions during this period, Berkshire ended the decade with $40 billion of readily investable cash. Compounding the problem was the relative scarcity of good opportunities in marketable securities, Berkshire's next go-to area of capital allocation. Some opportunities had presented themselves. In 1994, Berkshire's balance sheet listed $15.2 billion of equity securities and another $2.4 billion in bonds. 10 years later, at the end of 2004, the balance sheet had $37.7 billion in equities, $22.8 billion in bonds, and $2.3 billion of other investments. Viewing Berkshire's equity portfolio on a point-to-point basis, we see remarkably little change. 5 of its investments at year-end 1994 remained over the 10-year period: American Express, Coca-Cola, Gillette, Washington Post, and Wells Fargo. In addition, one investment at year-end 1994, Geico, turned into a wholly owned subsidiary. The net $3.5 billion of additional investment in the equity portfolio during the decade is somewhat misleading since the portfolio did generate substantial capital gains. Berkshire sold or otherwise disposed of its investment in Solomon Travelers, Capital Cities ABC, Walt Disney, and McDonald's, among others. In the minds of Buffett and Munger, the equity portfolio was largely a category of less than 100% owned businesses to complement their wholly owned subsidiaries. They would not have minded if the stock market did not give them quoted values for their holdings at all. All they wanted was to increase their holdings at favorable prices. At year-end 1994, Berkshire's investment in American Express, Coca-Cola, Gillette, and Wells Fargo represented 57% of the entire portfolio. Fast forward 10 years, and those same 4 represented 65% of the portfolio. 2, Coke and Gillette, went untouched during the period, while Berkshire added to its holdings in American Express and, to a lesser extent, Wells Fargo. Berkshire's balance sheet remained fortress-like. Its $189 billion of 2004 year-end assets were financed by $86 billion of equity and just $3.5 billion of true debt. The balance sheet was funded with other real liabilities, but these were of a different nature. The largest were the insurance-related liabilities, including losses and loss adjustment expenses and unearned premiums. In all, these insurance liabilities amounted to $59 billion. Berkshire also had a $12 billion year-end deferred tax liability that provided capital to fund assets. While very much a real liability, deferred tax liabilities were payable only if, when, Berkshire sold its appreciated investments or stopped investing in capital expenditures in excess of its depreciation costs. The last category of liabilities, amounting to $20 billion, were the finance and financial products liabilities. These liabilities included borrowings to finance Clayton Homes' mortgage portfolio, Scott Fetzer's finance arm, and other bank-like activities. Considering that the $20 billion of liabilities were backed by $30 billion of assets, including $3.4 billion in cash, this Berkshire mini-bank was very conservatively financed. The $9.7 billion of equity attributable to finance and financial products was akin to a 32% capital ratio, far in excess of anything seen in a typical bank. As the decade progressed, Berkshire became less concentrated in insurance, see Table 6.39. Not only was Berkshire moving more into non-insurance operations, but as we've seen, the many businesses it acquired over the preceding decade were very diverse. The shift away from the concentration in insurance was a natural consequence of Berkshire's growth, and the non-insurance businesses reinforced the insurance businesses. Berkshire was well poised to take on huge insurance risks others could not or would not take on themselves because it had a growing and diverse stream of non-insurance earnings. The insurance companies were strong on their own, but to have assets and earning streams not tied to insurance gave Berkshire confidence to expand into the reinsurance field when opportunities arose. Neither the economics of the business, the ability to take the lumpiness as it came, nor the accounting were impediments. The little debt that Berkshire incurred during this time was structured in Berkshire's favor and done cheaply. In 1996, it raised a $500 million convertible issue. Berkshire also issued the first negative interest rate security with its $400 million Squares issue in 2002. Other debt was incurred in the finance and financial products area to support the Fanova-Berkadia transaction and Clayton Homes lending activities, and to fund certain arbitrage situations managed by Buffett. Otherwise, very little debt was used at Berkshire by design. The one exception was Mid-American. Being a utility, Mid-American had the stability of earnings to borrow appropriately. Importantly, this debt was not guaranteed by Berkshire. There were more than a few instances of share issuances during the decade. The largest was a $22 billion issued in connection with the General Reinsurance acquisition. Numerous other acquisitions during the decade, including Helzberg, R.C. Willey, Flight Safety, Executive Jet, NetJets, and Dairy Queen, had all or some Berkshire stock involved. The issuance of the Class B shares brought $565 million of net proceeds to Berkshire, not tied to any acquisition. Increasing Berkshire's share count by about 1%, it prevented investors from being duped by a stock promoter that sought to cash in on Berkshire's well-earned reputation. But it was otherwise, in Munger's words, a non-event. What would have been a real event was if any of the attempts to create unit trusts using Berkshire stock had been successful. That would have harmed the reputation of Berkshire and Buffett, as investment returns would necessarily have lagged Berkshire's underlying business results. Berkshire was well positioned to enter a fifth decade under Buffett's control. It had $40 billion of cash to work with, additional cash coming in from diverse streams, and reasonable expectations of additional capital via growth in float. It faced real challenges, to be sure, including its massive size, earning the number 14 spot in the Fortune 500. Its size would prevent it from earning the types of returns it had in the past, but Berkshire would have plenty of opportunities in future years to grow into a conglomerate in a class of its own. 40 years in, Buffett and his longtime business partner, Charlie Munger, acted as if they were just getting started. Lessons, 1995 to 2004. 1. A well-structured liability like insurance float can be just as valuable as equity. Under the right conditions, such as within Berkshire's insurance group where profits were placed ahead of growth, float acted more like equity. Better yet, it did not dilute existing shareholders' equity and could grow without additional capital investment. Just as important is the acknowledgement that others recognized the value of float and competed vigorously. sometimes irrationally, for premium volume, which drove down pricing. 2. There are many ways to earn a satisfactory return on investment. Focusing on just one number can be misleading. A great extreme example is McLean. With its 1% pre-tax margin on revenues, McLean might not seem like a good business. Yet with extremely high capital turnover, that slim margin turns into a much larger and satisfactory return on capital. An opposite example is flight safety. With low capital turnover, its hefty, near 30% pre-tax margin turns into a lower but still good return on capital. Better is Seas, which had a 20% plus profit margin and lower capital requirements, but little opportunity for investment. Nirvana was Coke, with the ability to reinvest at very high rates of return. 3. Economics is more important than accounting. Berkshire accepted different types of insurance business that greatly impacted its financial statements. Since Berkshire was focused on long-term profitability, it ignored, but communicated to shareholders, the accounting treatment which made the business look much worse than it was. Berkshire did not have stock options of its own, but Buffett wrote about the pernicious effects of their accounting. If options aren't a form of compensation, what are they? If compensation isn't an expense, what is it? And if expenses shouldn't go into the calculation of earnings, where in the world should they go? 4. Thinking through basic economics is important and profitable. The internet craze that took the world by storm tricked many, but not Berkshire's managers. They correctly considered the implications of the internet and concluded the exact opposite of many participants, that competition would negate most advantages offered by technology, and that some costs simply could not be eliminated due to the internet. Grocery sales, for example, still required delivery vehicles. The internet would change the world, but in the early 2000s, profits were still elusive and many investors ultimately lost money. It would take another decade for the industry to mature and develop into an investment landscape capable of attracting the attention of serious value investors. Chapter 11, 2005 to 2007. Introduction. The fifth decade of Berkshire Hathaway under Warren Buffett's direction was one of enormous growth for the conglomerate. Cumulative operating earnings for the decade topped $100 billion, and net worth grew to a level surpassed by very few corporations. But as the dollars increased, the rate of increase in shareholders' equity continued to decline. The decade proved what Buffett had been saying all along: size was an anchor to performance. Still, Berkshire's multiple levels of redundant capital and liquidity proved to be an enormous asset. Berkshire was ready when the Great Recession of the late 2000s struck, and it emerged from the decade stronger than ever. The decade included the addition of many new operating subsidiaries. Among them were an entire railroad, Burlington Northern Santa Fe, and many other major acquisitions costing tens of billions of dollars in aggregate. Nearly $75 billion was spent on existing operations, including in the newly acquired businesses, for capital expenditures, about half of which represented capital to grow the businesses and strengthen their competitive positions. As a result, 70% of the change in net worth during this period came from operations, the largest proportion since the 1965-1974 decade. Berkshire's insurance operations contributed more than their share. The insurance group reported an underwriting profit in each of the years of this decade. Better yet, they almost doubled float from $45 billion to $81 billion. Berkshire's superior financial strength and its reputation allowed it to write some of the largest reinsurance contracts in history, including one single premium worth $7 billion. The financial crisis that came mid-decade provided Berkshire with ample opportunity. Berkshire became the go-to source for near instantaneous capital during the height of the crisis and invested many billions over a very short period. It also invested tens of billions into its equity portfolio, and the market value of the portfolio nearly tripled in size during the decade. Yet with all this capital allocation, Berkshire still found itself with over $63 billion in idle cash at the end of 2014. A modicum of share repurchases in the latter part of the decade provided glimpses into Berkshire's future when it would begin returning capital to shareholders. 2005. From a quantitative standpoint, Berkshire's book value increased 6.4% in 2005. This was below the rate Buffett preferred to see on an absolute basis, but still 1.5 percentage points ahead of the S&P 500 for the year. The insurance group reported an overall profit despite being hit by losses from major hurricanes. Ever on the quest to find new outlets for Berkshire's cash, capital allocators Warren Buffett and Charlie Munger closed 3 acquisitions and lined up 2 more to close the following year. Berkshire's businesses were thriving. Buffett shared updated figures for his 2-column method of tracking Berkshire's progress. Breaking down the longer-term track record highlighted the shift toward growth in operating earnings relative to growth in investments. This shift was a direct result of Berkshire's many acquisitions during the preceding decade. The policy of retaining all of its earnings, in addition to shares issued for acquisitions, funded this expansion. The result of that capital allocation is evident in the rate of growth in investments compared to pre-tax operating earnings during the 1995-2005 decade compared to the 1965-2005 period. See Figure 7.1. Importantly, the base and ending years did not artificially skew the analysis. Buffett reiterated his and Munger's goal to provide shareholders with the key pieces of information they would want if roles were reversed. He thought the task of estimating Berkshire's intrinsic value could be accomplished more accurately than other companies. Why? Because Berkshire had the following characteristics. 1. A wide variety of relatively stable earning streams. 2. A lot of liquidity. 3. Minimum debt. He was quick to note that simply looking at the consolidated parent-level financial statements was not enough. Shareholders did not need to examine the detail of every business, but a few broad delineations were important. We have attempted to ease this problem by clustering our businesses into 4 logical groups, he said. Those groups were presented for the first time in 2003. 1. Insurance. 2. Regulated utilities, Mid-American. 3. Manufacturing, service, and retailing. 4. Finance and financial products. Insurance. Berkshire's insurance businesses suffered from 3 major hurricanes, Katrina, Rita, and Wilma, that hit the United States in the latter part of the year. This was the most Category 5 hurricanes recorded in a single season, breaking the old record of 2 Category 5 hurricanes set in 1960 and 1961, and cost Berkshire $3.4 billion. Hurricane Katrina was the worst in insurance industry history, creating a need for the reinsurance operations to either firm up pricing to compensate for increased supercat risk or begin scaling back volume. Berkshire's losses from Katrina alone cost it $2.5 billion. Considering its significant hurricane-related losses, a $53 million pre-tax underwriting profit for the insurance group in 2005 was a great result. It provided Berkshire with the all-important negative cost of float, which now totaled $49.3 billion at year-end and amounted to almost 10% of float for the entire American property casualty industry. Geico. The shining gem of the insurance group was Geico, and it again delivered spectacular results for both its customers and Berkshire. Buffett once more gushed about Geico's brilliant CEO, Tony Nicely, who over the past 2 years had reduced headcount by 4%, yet grew policy count by 26%. The result was increased market share to 6.1%, increased profits, and the ability to give more value back to its customers, all of which strengthened the brand. Digging into Geico's 2005 financial results, earned premiums grew 13% to $10.1 billion. Part of that growth came from Geico's entrance into the New Jersey market. Overall, Geico benefited from a broad-based lower claim frequency offset by higher severity in injury and physical damage. Despite $200 million of losses attributable to Hurricanes Katrina, Rita, and Wilma, Geico posted a $1.2 billion pre-tax underwriting gain, a combined ratio of 87.9%. Such strong profitability was above Geico's 4% underwriting profit target, 96% combined ratio, so Geico reduced premiums and passed more savings to customers. General Re. Hurricane-related losses at Gen Re were estimated at $685 million and led to its underwriting loss of $334 million. The bulk of the hurricane-related losses at General Re were in its North American property casualty line, which reported a pre-tax underwriting loss of $307 million on earned premiums of $2.2 billion. Results in that segment were better than at first glance since $480 million came from hurricane-related losses. Other North American property casualty underwriting turned in profits of $220 million related to current year accident gains, less $47 million of adverse loss development for prior years. In short, the, hopefully, irregular large supercat losses overshadowed better underwriting discipline in other North American property casualty lines. Gen Re's international property casualty segment reported pre-tax underwriting losses of $138 million on earned premiums of $1.9 billion. Included in losses were $205 million from U.S. hurricanes and a windstorm in Europe. It booked $108 million of favorable loss development. The life health business reported another increase in underwriting profits, up 30% to $111 million on earned premiums that grew 14% to $2.3 billion. The business benefited from favorable mortality trends, primarily in international operations. Results also included $66 million of losses from a U.S.-based health business that was in runoff. Berkshire Hathaway Reinsurance Group. BHRG gave up almost 2 years of underwriting profits to hurricane-related losses. In 2005, it reported a pre-tax underwriting loss of $1.1 billion on earned premiums of $4 billion. Irregularity was the hallmark of the Berkshire Hathaway Reinsurance Group. While hurricane losses surely stung, the catastrophe and individual risk segment was operating as designed. For one, profits from other underwriting activities within the segment partially offset $2.4 billion of hurricane losses and reduced the loss by half to $1.2 billion. Second, looking at the longer-term track record of catastrophe and individual risk, it earned cumulative underwriting profits of $1.2 billion between 1999 and 2005. This is to say nothing of the value from its float. BHRG's retroactive insurance line stood out for its third year of decline in premiums earned. Retroactive premiums earned fell $526 million in 2003 to $108 million in 2004, and then plummeted 95% to just $10 million in 2005. Berkshire gave no reason for the precipitous decline in retroactive policies, which indemnified others for past loss events. It was most likely due to a lack of appropriately priced business. Even though Berkshire recorded a $46 million gain from settling one retroactive insurance contract and another $75 million in reduced loss reserves, the large amount of annual deferred charge amortization led the business line to record a $214 million loss in 2005. Unamortized deferred charges related to BHRG's retroactive reinsurance business amounted to $2.13 billion at year-end 2005. This would all work its way into underwriting expense over time. Berkshire also slowed its deferred charge amortization in 2005 as a result of slower-than-expected loss payments. This meant float was sticking around longer. Pre-tax underwriting earnings from BHRG Other Multi-Line were $323 million on $2.3 billion of earned premiums. Its profits were after $100 million hurricane-related losses from Katrina, Rita, and Wilma. In addition to the physical hurricanes inflicting pain on Berkshire during 2005, it also contended with the improper dealings of several of General Re's former executives, which was naturally picked up by the press. General Re's misbehavior boiled down to improperly using reinsurance contracts to hide underlying issues instead of actually transferring risk. Berkshire quickly severed ties with the executives as their guilt came to light in the mid-2005. Click, click. Berkshire quickly severed ties with the executives as their guilt came to light in mid-2005. Berkshire Hathaway Primary Group. Berkshire's not-so-hidden gem of primary insurers continued to have consistent underwriting profits. Earned premiums grew 24% to $1.5 billion, and underwriting profits ballooned 46% to $235 million. But part of that growth was due to a new addition to the team. Berkshire acquired medical protective company, MedPro, from GE Insurance Solutions, a subsidiary of General Electric, on June 30, 2005. It came about after Buffett struck a deal with General Electric CEO Jeff Immelt. MedPro was based in Fort Wayne, Indiana, and had been in business for 106 years. It provided professional liability insurance for physicians, dentists, and other healthcare providers. For $825 million cash, Berkshire acquired the AAA-rated insurance company, with over $700 million in premium volume and $2 billion of statutory assets. Regulated utility business. There were two big pieces of news in the regulated utility business segment in 2005. The most important economic development was the agreement to acquire PacifiCorp. PacifiCorp was an electric utility serving 1.6 million customers in California, Idaho, Oregon, Utah, Washington, and Wyoming. Mid-American purchased it from Scottish Power plc. To fund the deal, which closed in 2006, Berkshire would purchase $3.4 billion of additional capital stock in Mid-American, which would in turn issue $1.7 billion of long-term debt to meet the $5.1 billion cash purchase price. After the PacifiCorp closing, Berkshire's economic interest in Mid-American would increase to approximately 88.6% or 86.5% on a fully diluted basis. It would also increase Mid-American's revenues by $3.3 billion and its assets by $14.1 billion. The second big piece of news was the repeal of the Public Utility Holding Company Act, PUHCA, on August 8, 2005. Since its original purchase of Mid-American, Berkshire had operated under a somewhat unique arrangement, giving it a majority economic interest but leaving the voting interest with the minority partners, Walter Scott, David Sokol, and Greg Abel. That arrangement had been necessary under law since Berkshire was a holding company. Repeal of the law allowed Berkshire to convert its preferred stock into voting common shares on February 6, 2006, and allowed its voting interest to mirror its economic interest. This ended what Buffett called the convoluted corporate arrangement PUHCA had forced on us. The repeal also caused an accounting change. Berkshire's increased voting interest required the full consolidation of Mid-American into Berkshire's financial statements for accounting purposes. Like the exercise Buffett had performed with Scott Fetzer in 1986, with old and new columns presenting the same company under different accounting, nothing would change from an economic perspective. But Berkshire's financial statements would look different. For this reason, Berkshire included a separate unaudited pro forma 2005 balance sheet in its financial reports to highlight the changes. The most notable changes were entries on both the asset and liability sides entitled Utilities and Energy, with the corresponding balance sheet items formally detailed in the notes to the financial statements. Berkshire's consolidated 2005 assets would increase from $198 billion under the old, current year GAAP format to $214 billion under the new, future years GAAP format. Berkshire's $91.5 billion of total shareholders' equity remained unchanged, which was to be expected. Manufacturing, service, and retailing. The MSR businesses generated almost $47 billion of revenues and earned $2.6 billion pre-tax during the year. The $1.7 billion of after-tax earnings from these businesses represented a 22.2% return on average tangible equity. Because of the premium Berkshire paid above and beyond the tangible equity for these businesses, Berkshire's return on carrying value was a lower but still satisfactory 10.1%. Furthermore, the businesses operated with very little debt. With 2 years of balance sheet data, we can see the pre-tax return on tangible invested capital improved from 24.5% to 25.1%, which is additional evidence of the underlying quality of these businesses as a group. The MSR Group gained a new business on August 31, 2005, with Berkshire's acquisition of Forest River. Forest River, a recreational vehicle manufacturer based in Elkhart, Indiana, was founded by Pete Legal. After Legal sold a predecessor company, Cobra Industries, to a leveraged buyout operation, it promptly fired him and almost as quickly went bankrupt. Legal then purchased Cobra's assets out of bankruptcy and rebuilt the business under the name of Forest River. Although the terms of the sale were not disclosed by Berkshire directly, an article included with the 2005 Berkshire Hathaway annual report put the figure at around $800 million. The company had annual revenues of $1.6 billion and operated out of 60 plants with 5,400 employees. Several of Berkshire's MSR businesses were impacted by higher input costs in 2005, though most nonetheless reported higher profits. Strong prevailing economic conditions caused prices for raw materials energy and transportation, among others, to rise, sometimes sharply. Building the products, which contained Acme building brands, Benjamin Moore, Johns Manville, and Mytech, the result of Berkshire's mini-spending spree in the early 2000s, turned in pre-tax profit of $751 million, up 17%, on revenues of $4.8 billion, up 11%. Shaw earned $485 million pre-tax, up 4%, though its margin slipped due to increased raw material costs. Even though profits were up and moats gave these businesses pricing power, it would take time to raise customer prices to counter rising input costs. The apparel category, which included footwear, increased its pre-tax earnings 7% to $348 million on revenues up 4% to $2.3 billion. Results in apparel were largely driven by Fruit of the Loom, the largest business in that segment, which increased its market share in all categories. The footwear businesses were shadowed by Fruit of the Loom. H.H. Brown Shoe Group and Justin Boots turned in a respectable 5.3% increase in sales. Profitability was not disclosed. Buffett's chairman letter conveyed his delight at Ben Bridge and R.C. Willey, which increased same-store sales by 6.6% and 9.9% respectively. Together, same-store sales for the jewelry and home furnishing business increased 2.5%. The increase at R.C. Willey was that much more impressive considering its closed on Sundays policy. R.C. Willey's newest location in Reno, Nevada contributed to results, and it planned to open another store in Sacramento, California. Jordan's Furniture also opened a new store in 2005, a 60,000 square foot clearance center in Avon, Massachusetts. The chairman's letter also reported that Chuck Huggins, See's Candy's longtime CEO, had passed the reins to Brad Kinsler. Kinsler previously headed Cypress Insurance in Fetchheimer and impressed Buffett greatly. He was the obvious choice for the See's job, Buffett said. All told, the jewelry, home furnishings, and candy segment increased pre-tax profit 20% to $257 million. Within the flight services segment, results were mixed. Increased demand for simulator time at Flight Safety resulted in higher utilization. Profits were up 10% to $200 million. With the increased demand came expansion plans, including a $100 million project underway for 15 new simulators at a major facility in Farnborough, England. This would bring its total facility count to 42. Results at NetJets were a different story. The business reported a loss of $80 million. The cause? Struggles maintaining the European operation thought necessary to dominate the worldwide fractional ownership industry. Even though European contracts increased 37%, its low efficiency resulted in red ink. With profits off 5% to $217 million, McLean was a fairly steady generator of revenues and profit. Part of that steadiness was due to Walmart, its former corporate parent, which remained a large customer. Due to the low value-add nature of its business, McLean generated over half, 51%, of the MSR Group's total revenues, yet only 8% of its pre-tax profit. The individual results of the MSR businesses highlighted the strength of the U.S. economy in 2005, when there was a 3.5% increase in real GDP. The ability of the building products businesses to pass through input costs over time highlighted the strong housing market and the strength of the businesses. Results from Berkshire's retailers were proof of strong consumer demand. In hindsight, we know this period was the beginning of a crescendo that would end in disaster. Buffett's comments at the 2006 annual meeting suggested caution. He pointed to the ridiculous credit being extended to homeowners and the slowdown in home sales seen at Mid-American's home services business as areas of concern. Finance and financial products. The finance and financial products segment contained a wide variety of businesses. They were an eclectic mix of financial-type businesses and operations. From Clayton Homes, a manufactured housing company, included because of its large financing arm, to the remnants of General Re's security operations, to Buffett's own proprietary trading, and more, the group was nonetheless very important to Berkshire. Buffett said the star of the finance sector was Clayton Homes. It was not hard to see why. The company had grown to include 36 manufacturing plants since Berkshire's purchase in 2003. This included 12 acquired via the bankruptcy of competitor Oakwood in 2004. Another 4 plants came from the purchase of Karsten, a West Coast-based operation, in 2005. Clayton's manufacturing operations were dwarfed only by the size of its lending business, which provided financing for Clayton's customers and others. Clayton, as of 2005, serviced $17 billion of loans, of which $9.6 billion was owned by Clayton. To finance that $9.6 billion, Clayton had borrowed from Berkshire, which in turn borrowed at an attractive interest rate. To compensate Berkshire for the use of its pristine credit rating, Berkshire charged Clayton a 1 percentage point spread, which, in 2005, cost Clayton $83 million. Over the years, the finance and financial products segment had grown sizable. At year-end 2005, the segment collectively held $24.5 billion of assets. This included 1. $4.1 billion cash, 2. $3.4 billion fixed maturity securities, 3. $11.1 billion of loans and finance receivables. That last category that contained the Clayton portfolio in addition to other loans and receivables such as those from World Book and Kirby customers. The liability side of the finance and financial products segment balance sheet was equally large. The $20.3 billion of debt within this segment was less worrisome than at first glance since it operated more like a bank. Over half of $10.9 billion of liabilities were longer-term notes payable and borrowings used to finance the interest-bearing loans and receivables portfolio. Berkshire took pains to structure its debt to avoid the possibility of an immediate need for liquidity, since, unlike a bank, it did not have reliable sources of deposits as funding. There were another $5.1 billion of derivative contract liabilities, in addition to some residual liabilities related to Gen Re securities. These trading activities and the irregular losses from unwinding General Re securities meant the earnings of the finance and financial products segment were irregular at best. From a profit of $584 million pre-tax and pre-capital gains in 2004, the segment reported an $822 million profit in 2005. Just over half of the 2005 profit, $416 million, was from Clayton Homes. Most of the remaining profit came from Buffett's trading, $200 million, and leasing operations of Extra and Court, $173 million. Investments. Buffett thought general stock market levels already reflected a positive economic outlook. Expect no miracles from our equity portfolio. Setting characteristically low expectations, Buffett thought Berkshire's portfolio of equity securities might double over the next decade, an annualized rate of return of about 7%. Still, he and Munger found a few intelligent things to do during 2005. Berkshire increased its Wells Fargo holdings substantially over the preceding year, almost doubling its shares to 95 million shares in 2005. Berkshire now owned 5.7% of the West Coast Bank. In addition, Berkshire purchased stakes in 2 other companies, Brewer Anheuser-Busch Company in St. Louis, Missouri, and Walmart Stores Incorporated, the Bentonville, Arkansas-based retailer long admired by Buffett and Munger. 2 other names found their way onto the list of investments with a market value greater than $700 million. Notice the minimum amount keeps going up. Both were accounting-related more than economics and the result of corporate actions outside of Berkshire's control. The first was the spin-off of Ameriprise Financial from American Express. Berkshire now owned 12.1% of Ameriprise, roughly equal to its 12.2% stake in American Express, with a cost of $183 million and a market value of $1.2 billion. Second, during the fourth quarter of 2005, Gillette merged into Procter & Gamble. This created a lot of accounting noise and much less economic change, providing one of Buffett's famous accounting lessons. Berkshire did not sell a single share of Gillette. It simply accepted the 0.975 shares of Procter & Gamble stock for each Gillette share it owned. However, GAAP rules required a $5 billion non-cash pre-tax gain be booked through the income account. Many people would rightfully ask why. This was a perfect example of economics versus accounting. In economic terms, Berkshire's cost basis in Gillette at the time of the merger was $600 million. Berkshire's cost basis for tax purposes in Procter & Gamble was $940 million. This was because Berkshire purchased $340 million of Procter & Gamble to an even 100 million shares. In accounting terms, the cost basis increased to $5.96 billion, reflecting the non-cash gain booked through the income statement. With the wind largely at its back, Berkshire had a relatively good year in 2005. The insurance group, though not without struggles, turned in the all-important cost-free float, and its non-insurance businesses largely did well, despite signs of a peak in the booming economy. Berkshire used $2.4 billion of its excess cash to complete acquisitions of Medical Protective and Forest River, in addition to several other bolt-on acquisitions. The following year would see more acquisitions, including Berkshire's first major acquisition overseas. 2006. Berkshire's results in 2006 were probably at the high end of what could be expected for a conglomerate its size. With revenues approaching $100 billion and 217,000 employees, Berkshire Hathaway was the 12th largest U.S. corporation according to Fortune magazine. Berkshire's $16.9 billion increase in net worth year over year translated into an 18.4% increase in per-share book value. Buffett wanted shareholders to keep expectations in check going forward. While overall Berkshire's 73 business units did outstanding, the insurance group benefited from a large dose of luck. This was not Buffett displaying his usual modesty. The year 2006 for insurers was all good news. The wind was also at Berkshire's back on the capital allocation front. Berkshire spent $6 billion closing the Pacific Core, Business Wire, and Applied Underwriters acquisitions that were pending at year-end 2005. It spent an additional $4 billion on ISCAR, its first foreign acquisition, $1.2 billion on Russell Corporation, plus several other tuck-in acquisitions at Mytech, CTB, Shaw, and Clayton. Insurance. A combination of luck and continued underwriting discipline was behind the large jump in underwriting profit in 2006. Premiums earned grew 9% to $24 billion, aided in part by the addition of Applied Underwriters on May 19, 2006. The real story, though, was Berkshire's loss experience, or rather, lack thereof. While each major segment did not contribute to premium growth, all contributed to a $3.8 billion underwriting profit, which was up from just $53 million in 2005. On top of that, float increased 5% to $50 billion, providing even more capital to put to work. General Re. The favorable insurance climate was most apparent in the two reinsurance units. Underwriting at Gen Re swung from a loss of $334 million in 2005 to a profit of $526 million in 2006, despite earnings premiums falling 6% to $6.1 billion. Gen Re's underwriting discipline was starting to show. Its North American property casualty segment recorded a pre-tax underwriting gain of $127 million, even as earned premiums fell 18% to $1.8 billion. Including gains from current year business and favorable loss development, property lines produced a gain of $348 million. Casualty workers' compensation reported a loss of $221 million, which included discount accretion, deferred charge amortization, and additional loss reserves. The international segment reported profits of $246 million on flat volume of $1.9 billion. More net gains from aviation lines and no catastrophe losses led to a strong gain of $360 million, while $114 million in casualty losses produced profits for the segment. Casualty losses included an unspecified amount of cost related to the ongoing regulatory investigations surrounding misconducts by former executives. An underwriting gain of $153 million on volume of $2.4 billion continued a long string of profits from Gen Re's Life Health segment. Berkshire Hathaway Reinsurance Group. The story was much the same, but even better, at Berkshire Hathaway Reinsurance Group in 2006. Premiums earned grew 26% to $5 billion, and profits rebounded strongly from a loss of $1.1 billion in 2005 to a profit of $1.7 billion in 2006. BHRG benefited from both higher rates and higher volumes after other insurers pulled back following large hurricane losses in 2005. It was rewarded for staying the course. Premium volume and catastrophe and individual risk grew 32% $2.2 billion, and profits rose sharply from a loss of $1.2 billion in 2005 to a gain of $1.6 billion in 2006. Underwriting results in 2006 included $200 million unfavorable loss development, primarily tied to revised estimates of losses associated with Hurricane Wilma, which occurred during the fourth quarter of 2005. The big news at BHRG was its huge $7.1 billion retroactive insurance deal with Equitas, the largest reinsurance contract in Berkshire's history and very likely the largest in insurance history at the time. Though finalized in 2006, the policy would not begin until 2007. Equitas was an entity created to hold all the risk incurred by thousands of names or underwriters on contracts written by the Lloyd's syndicates prior to 1993. Those names were still on the hook for any losses, no matter how far into the future. The development of latent asbestos and environmental losses caused a pullback in their willingness to write new policies on any type of business. This uncertainty froze the market. Ajit Jain and Buffett offered a policy to insure all 27,972 names backing Equitas. In exchange for $7.1 billion in cash and securities, Berkshire wrote a policy that covered all future claims on policies in effect prior to 1993, up to a limit of $13.9 billion. Buffett and Jain reasoned that the payment of future claims would either be lower in amount or longer in duration, making the transaction a good bet for Berkshire. The transaction was like a loan, but with an unknown repayment schedule. The sooner and higher the ultimate payments, the higher the cost, and vice versa. The two certain variables were the upfront cash and the upper limit of the policy. Time would reveal the cost of this float. Before leaving Equitas transactions, it's worth highlighting Buffett's accounting lesson on reinsurance from his 2006 chairman's letter. Laying out the debits and credits, he explained exactly how the Equitas accounting worked. The major debits will be to cash and investment, reinsurance recoverable, and deferred charges for reinsurance assumed, DCRA. The major credit will be to reserve for losses and loss adjustment expense. No profit or loss will be recorded at the inception of the transaction, but underwriting losses will thereafter be incurred annually as the DCRA asset is amortized downward. Eventually, when the last claim has been paid, the DCRA will be reduced to zero. That day is 50 years or more away. It's important to reiterate the economics versus accounting for a reinsurance transaction like Equitas. From an accounting standpoint, there was no impact to profitability on day one. Subsequent periods would show underwriting losses as the DCRA was amortized into expense. From an economic standpoint, any earnings from the $7.1 billion received up front would be recorded in investment income. Retroactive insurance contracts always produce underwriting losses. The question is whether the float generated via the cash received up front produced investment income exceeding those losses. Buffett made no guarantee on this bet but wanted shareholders to have the facts. He stressed this by jabbing Enron for its purposely unintelligible 10K filings. BHRG's retroactive business in 2006 reported an underwriting loss of $173 million on $146 million of earned premiums, which was primarily a result of deferred charge amortization and gains from commuted, amended contracts. Other multi-line had a gain of $243 million on premiums of $2.6 billion, which reflected strength in workers' compensation and aviation lines that offset a decline in quota share volume. Geico. Geico's results were simply splendid. No surprise there. The company grew policies in force 10.7% overall and ended 2006 with 8.1 million policies. Its $1.3 billion pre-tax underwriting gain on $11.1 billion of earned premiums produced an 88.1% combined ratio and led Geico to reduce rates in certain markets. Berkshire Hathaway Primary Group. Berkshire's primary group earned $340 million pre-tax, an 18% underwriting profit on $1.9 billion of premiums earned. Each of its component businesses reported an underwriting gain, and results were bolstered by MedPro, which closed in mid-2005, and Applied Underwriters, which officially joined Berkshire on May 19, 2006. Applied Underwriters. In December 2005, Berkshire agreed to acquire a majority stake in Applied Underwriters, a writer of workers' compensation insurance to small businesses, as well as a provider of payroll services. Even though most of its customers were based in California, the business was based in Omaha. Berkshire purchased an 85% ownership interest, and the remaining 15% of the business was retained by Sid Ferentz and Steve Menzies, whom Buffett praised for having built Applied Underwriters from nothing just over a decade before. The favorable loss experience and strong underwriting profitability in insurance in 2006 suggested conditions were expected to deteriorate soon. Buffett pointed to the flood of capital entering the supercat field. He told shareholders that Berkshire would employ a lesson from investing to the insurance field. Be fearful when others are greedy, and be greedy when others are fearful. For the time being, Berkshire would reduce exposure to wind-related events, but stand by willing to assume risk at an appropriate price. Manufacturing, service, and retailing. Like the insurance group, Berkshire's MSR segment had a good year in 2006. It could be traced to several factors, including a strong U.S. economy and acquisitions of additional businesses. Net earnings grew 29% to $2.1 billion, a very respectable 25.1% return on tangible equity. Pre-tax return on tangible capital expanded 4 percentage points to 29.1%. Iskar Metalworking Companies was the most significant newcomer to the MSR group. The Israel-based company first came on Buffett's radar when Chairman Eitan Wertheimer sent him a short letter in October 2005. The company faced a familiar challenge transferring ownership to the next generation of a large family, and Wertheimer thought Berkshire the perfect fit. Buffett agreed. On July 5, 2006, Berkshire paid $4 billion for an 80% stake in Iskar, valuing the whole business at $5 billion. Iskar produced cutting tools used in conjunction with expensive machine tools. Iskar's business was a very good one. Although not many details are known, the fact that almost $2.1 billion remained as goodwill on the Iskar balance sheet post-transaction was a major clue. In thinking through Iskar, we can envision the superior economics at work. Its cutting tools were a crucial element of any metalworking project. While the price of each consumable cutting tool might be very high, its relative price to the overall project was relatively low. Iskar can therefore deliver an excellent economic result for itself while continually reinvesting in R&D to further enhance the value delivered to its customers. Other newcomers and bolt-on acquisitions in 2006 bolstered the MSR group. Fruit of the Loom spent $1.2 billion, including assumed debt, to purchase Russell Corporation, an athletic apparel business, and in December it agreed to purchase the underwear portion of the Vanity Fair Corporation. Elsewhere, CTB, Shaw, Clayton, and Mitek acquired other businesses during the year. Buffett highlighted Mitek's acquisition of 14 businesses for $291 million since Berkshire acquired it in 2001. Mitek was now debt-free, having repaid all the $200 million Berkshire lent it at the time of its acquisition. These type of expansionary capital allocation activities were prized by Buffett since they widened the scope of the businesses and managers he knew well. Berkshire's newest service business was Business Wire, a global wire service that distributed corporate news, including regulatory filings. Acquired February 28, 2006, Business Wire came across Buffett's desk much like Iskar. In November 2005, CEO Kathy Barron Tamraz wrote Buffett a short 2-page letter that piqued his interest. Lori Loki founded Business Wire in 1961 and grew it to serve over 25,000 clients in 150 countries. Buffett was particularly impressed with the company's relentless focus on value creation. Citing Tamraz in his chairman's letter, he talked about the parts of the pitch he liked best, keeping unnecessary spending under wraps, but investing where there were gains to be had. Buffett shared this approach. The price was not disclosed. The existing manufacturing businesses, many of which were tied to the building industry, reported higher revenues and earnings during 2006, although weakness was seen going into 2007 as the construction industry began to slow. Shaw, one of the largest, increased revenues just 2% to $5.8 billion, but pre-tax earnings ballooned 22% to $594 million. Shaw was successfully passing along higher prices to customers, 7% on average, which resulted in the surge in profits on lower unit volume. The story was much the same with the other manufacturing businesses, including Acme, Benjamin Moore, Johns Manville, and Mytech, which had similarly good years, no specifics disclosed, but looked forward with caution. While these businesses performed well themselves, the addition of Forest River to the segment, beginning in mid-2005, was largely responsible for a 29% increase in revenues to $12 billion and a 32% increase in pre-tax earnings to $1.8 billion. Within the service sector, NetJet's dominance of the fractional jet industry returned to its profitability. NetJets produced a profit of $143 million, finally realizing economies of scale from its large fleet of planes. That fleet was now larger than its three largest competitors combined. If NetJets was the formerly difficult business getting better, the Buffalo News was the formerly great business getting worse. Because of its small size, the paper remained consolidated within dozens of other sister companies for reporting purposes. The chairman's letter pointed to the deteriorating economics of the newspaper industry and highlighted a once shining star now dimmed. Earnings were down 40% from its peak. As a newspaper business, the Buffalo News was one of the best and had one of the highest penetration ratios in the country. Yet a plethora of online information from low-cost competitors was destroying the once great economics. Buffett highlighted one of Berkshire's owner's manual principles to calm any nerves. Unless we face an irreversible cash drain, we will stick with the news just as we've said that we would. He continued, I think we will be successful, but the days of lush profits from our newspaper are over. Berkshire's retailing businesses were the same story of good results in 2006. Revenues within the segment grew 7% to $3.3 billion, and pre-tax profits rose 12% to $289 million. Strong consumer spending bolstered results. R.C. Willey opened 2 new stores that added $77 million in revenues. Same-store sales for the home furnishing businesses increased 6% over the prior year. Sears was the major contributor in this segment, responsible for $27 million of the $32 million increase in retailing pre-tax profits. McLean's pre-tax earnings rebounded to 2004 levels. Revenues increased 7% to $25.7 billion, and earnings increased 6% to $229 million. These results came in the face of losing a large customer and lower restaurant service revenues. Its grocery business expanded but faced lower margins from higher competition. Regulated utility businesses. Berkshire's Mid-America Energy Holdings was the parent of its utility operations. It acquired PacifiCorp on March 21, 2006. From no utilities 6 years earlier, Berkshire now controlled major utility operations spanning the globe. The utility operation lacked the potential for outsized investment returns because of its heavy regulation, but it contained the ability for outsized additional investment. It could take the large amounts of capital generated elsewhere within Berkshire and deploy it in relatively safe, long-term assets. Just the PacifiCorp deal alone required $3.4 billion from Berkshire that would likely produce steady returns into the future. Berkshire's now 86.6% diluted stake in Mid-American Energy Holdings generated $885 million in net earnings in 2006. This amount included the interest Mid-American paid to Berkshire on a $1 billion loan, as well as earnings from PacifiCorp, which was acquired in March 2006, excluding EBIT from PacifiCorp beginning on its acquisition date. Save for one operating segment, each of Mid-America's businesses reported an increase in profits in 2006. The one laggard in the segment was home services. With lower residential real estate demand, earnings in that segment fell 50% to $74 million. Buffett did not let the current climate distract Berkshire from its long-term potential. We will be seeking to purchase additional brokerage operations. A decade from now, home services will almost certainly be larger. Finance and financial products. Gen Re's derivative operation was now largely in the history books. From the time the wind-down began in 2002 through the end of 2006, Gen Re Securities had recorded a $409 million loss over 23,000 contracts. At one time, their value was blessed by accountants. Charlie Munger later quipped that the derivatives contracts were good until reached for. Clayton Homes was the largest contributor, making up almost half of this segment's $1.2 billion in pre-tax earnings. In addition to earnings, Berkshire received an $86 million fee from Clayton to use Berkshire's credit to finance its $10 billion plus portfolio of mortgages. The industry was unprofitable in 2006. Unit sales were just one-third of 1999, and Clayton itself had its lowest sales volume since 1962. But Clayton was an anomaly. Unlike other home builders, Clayton's earnings were largely tied to its portfolio of mortgage receivables, which is why it was included in the finance and financial products segment. Clayton's earnings grew 23% to $513 million on 12% higher revenues, $3.6 billion. Investments. Berkshire's investment portfolio grew to $61.5 billion at year-end 2006. Buffett was pleased with the operating performance of the businesses in the portfolio, singling out stellar results from the CEOs of American Express, per share earnings up 18%, Coca-Cola, plus 9%, Procter & Gamble, plus 8%, and Wells Fargo, plus 11%. All exceeded the 6% to 8% range he thought earnings would increase over the next 10 years in aggregate. Buffett then summarized the profits Berkshire made over the preceding 6 years in foreign currency and used that as a launching point to discuss the U.S. trade deficit. His long-standing conviction that the U.S. trade deficit would negatively impact the U.S. currency led Berkshire to make sizable foreign currency bets across a portfolio of currencies. From 2002 to 2006, profits from those operations totaled $2.2 billion. Buffett strongly believed the United States was like a large, rich farm that traded off pieces of the family estate to finance current consumption. In the year 2006, the U.S. had a trade deficit of $760 billion worth of imports above and beyond its honest-to-God trade of $1.44 trillion, where exports matched imports. This deficit, accounting for 6% of GDP, was what Buffett called IOUs to the rest of the world. The evidence against the strength of the dollar was so strong that Buffett couldn't help but find a way to profit from it. He did that using derivatives, even though he had spoken out forcefully against their existence. Why, you may wonder, are we fooling around with such potentially toxic material? The answer is that derivatives, just like stocks and bonds, are something wildly mispriced. For many years, accordingly, we have selectively written derivative contracts, few in number but sometimes for large dollar amounts. We currently have 62 contracts outstanding. I manage them personally, and they are free of counterparty credit risk. In other words, Buffett's derivative activities involved him taking advantage of a few mispricings in the market, not a large-scale operation with the potential to explode like mortgage-backed securities would in the future. Governance. Buffett concluded his 2006 chairman's letter with an announcement that Malcolm Kim Chase was retiring from the board. Kim replaced his father on Berkshire's board in 1992. Buffett was now on the lookout for a director who was owner-oriented, business-savvy, interested, and truly independent. He found such a candidate in Susan Decker, CFO of Yahoo. Buffett, philanthropist. In July 2006, Buffett pledged 85% of his Berkshire stock, which was comprised of 474,998 A shares, to 5 charities. The largest was the Bill and Melinda Gates Foundation, which was to receive 10 million Class B shares over time, or about $31 billion at the time of the gift. The 4 other charities were the Susan Thompson Buffett Foundation, the Howard G. Buffett Foundation, the Novo Foundation, and the Sherwood Foundation. The gifts were the ultimate display of rationality. Buffett could continue to do what he did best, run Berkshire, and let others do the hard work of giving. Since the shares would be distributed over time and conclude no earlier than 10 years after his death, the net effect on Berkshire was effectively nil. Buffett was quick to point out he was in good health and had an actuarial expected lifespan of 12 years. The actuaries would be proven wrong. 2007. The year 2007 could best be described as the calm before the storm. Berkshire and most other businesses did well, but cracks were beginning to appear in the economy. And no one had better insight into the broader economy than Buffett and Munger, with front-row seats to Berkshire's diverse businesses. Berkshire's 2007 operating performance delivered a $12.3 billion gain in net worth and 11% gain in per-share book value, exactly double the S&P 500's performance for the year. Most of its businesses did well, except for the canary in the coal mine, housing, which showed signs of weakness foreshadowing what was coming in the next few years. Calm described the insurance market, which again provided a good underwriting year, but its profitability foretold a familiar storm, the entrance of new capital and inadequate pricing. Insurance. Berkshire's collection of world-class insurance companies ended 2007 with $58.7 billion of float, up 15% in large part due to the Equitas deal described earlier. Better still, underwriting profits came in at $3.4 billion, though this was admittedly due to another year of calm weather with its resulting lack of supercat events. General Re. Gen Re continued to stay the course, rejecting inadequate risks and earning a $555 million pre-tax underwriting profit, up 6% from 2006. This won CEO Joe Brandon and President Tad Montross Buffett's praise for restoring its luster. Though premiums earned were flat in 2007 at $6.1 billion, two factors caused them to be higher than they otherwise would have. The first was the weakening U.S. dollar, which meant Gen Re's non-U.S. business translated into more dollars upon conversion. The other was $114 million from a reinsurance-to-close transaction with the Lloyd's of London syndicate. A reinsurance-to-close transaction is usually associated with Lloyd's of London, an insurance and reinsurance market where syndicates join to insure and spread risks. In a reinsurance-to-close transaction, a reinsurer takes on the risks and rewards of a particular year. This allows the syndicates to close the books for that year and determine a profit or loss, thus the name reinsurance-to-close. In this case, Gen Re was paid a $114 million premium to increase its share of the Lloyd's Syndicate 435 2001 account from 60% to 100%. This reinsurance-to-close transaction was similar to the Equitas contract. The key difference was the assumption of risk of 1 year particular syndicate, whereas the Equitas deal was for many years covering many syndicates. In 2007, Gen Re began consolidating its North American and international property casualty segments into one property casualty reporting line. This new consolidated segment reported an underwriting gain of $475 million, up 27% on a comparative basis. Gen Re benefited to the tune of $429 million of favorable loss experience on prior year's property business. On top of that, the current underwriting year produced a gain of $90 million, even after $192 million in catastrophe losses. These were offset by $44 million in net losses from the casualty workers' compensation line, which was heavily impacted by amortization charges. Life Health reported 48% lower earnings, but the $80 million underwriting profit continued a long streak of profitable operations. Berkshire Hathaway Reinsurance Group. Berkshire Hathaway Reinsurance Group reported a 139% increase in earned premiums to $11.9 billion. Pre-tax underwriting profit fell 14% to $1.4 billion. The large increase in premium volume was due to the $7.1 billion Equitas reinsurance transaction. The Equitas deal masked a 28% drop in earned premiums from catastrophe and individual risk business as competition and inadequate pricing resurfaced. A lack of major supercat events in 2007 meant $1.5 billion of the $1.6 billion premiums earned in that segment fell to the bottom line. Although the Equitas deal provided a large boost to earned premiums, its retroactive nature meant the earned premium was offset by associated incurred losses. Further, while the entire $7.1 billion was available to earn investment income, deferred charge amortization caused the retroactive segment loss to balloon 116% to $375 million. The third major segment within BHRG was the other multi-line, which reported flat premium volume of $2.6 billion. The other multi-line segment turned in 34% higher profit to $325 million, largely due to favorable loss experience in both property and workers' compensation. Geico. The successful march forward continued at Geico, with earned premiums up 6.8% to $11.8 billion and 656,000 more voluntary auto policies in force. Geico now boasted a 7.2% market share. Buffett disclosed it also had a 6% share of the motorcycle market, had started lines covering recreational vehicles, and, working with National Indemnity, covered select commercial accounts. Based on prior comments about returning value to customers, Geico's decline in profitability was intentional. Even after allowing average premiums per policy to decline, the year's profitability represented a 90.6% combined ratio, good for over $1.1 billion in pre-tax profits. Berkshire Hathaway Primary Group. The primary group reported a $279 million pre-tax profit, which produced a 14% underwriting gain on $2 billion of premium volume. Premiums grew largely as a result of the impact of MedPro, Applied Underwriters, and the newest addition to the team, Boat US. Very little was disclosed about Boat US. This included its price. Headed by Bill Oakson, Boat US provided services to an association of about 650,000 boat owners, including a boat insurance offering. It must have been a very small tuck-in acquisition, as it was not included in the footnotes at all. Regulated utility business. With a full year of operations from Western Utilities, PacifiCorp, in addition to more customers and higher usage due to warmer weather, pre-tax earnings from Mid-American grew 18% to $2 billion. On an after-tax basis, Berkshire's share, including the interest on a portion of the company's debt, grew 25% to $1.1 billion. EBIT was flat if PacifiCorp's results were excluded. Perhaps the biggest news at Mid-American, though not the best, came from its smallest unit, Home Services. Pre-tax earnings went from a high of $148 million in 2005, halved to $74 million in 2006, and just about halved again in 2007 to $42 million. The cause was the dramatic slowdown in residential real estate sales. Still, Buffett saw the long-term potential of the business and said Berkshire would look to grow where it made sense. Home Services was already the second largest real estate brokerage firm in the country, with 20 firms and 18,800 agents. Manufacturing, service, and retailing. Including the recent additions, the MSR segment reported overall pre-tax earnings of $2.4 billion, up 10%, on revenues of $59.1 billion, up 12%. Even with the headwinds faced by the building products businesses and some of the retail businesses, the group earned 22.8% on tangible equity. This translated into a 9.8% return on Berkshire's investment, all while maintaining a strong balance sheet. Pre-tax return on tangible capital slipped 1.5 points to 27.6%. Buffett laid out the wreckage in the building products market. Pre-tax earnings fell significantly at Shaw, negative 27%, Acme Brick, negative 41%, Johns Manville, negative 38%, and Mytech, negative 9%. Combined pre-tax earnings from these businesses fell 27%, to $941 million compared to 2006. Despite these challenges, Shaw, Mytech, and Acme found tuck-in acquisitions. Down markets provide an opportunity to examine Down markets provide an opportunity to examine the dynamics of economies of scale. Consider Shaw, the largest building-related business in the segment. With carpet volumes down 10%, revenues decreased 8% to $5.4 billion. The ratio between volumes and revenues determines the company's relative need to pass through price increases. Working down the earnings statement, Shaw's gross profits decreased 17% due to the lower volume and higher input costs. Management at Shaw was only able to cut overhead costs, selling, general, and administrative, by 6%, and as a result, pre-tax earnings declined by the 27% seen above. Similar stories likely played out at the other building products businesses. In addition to having a full year of ISCAR included in its results, the manufacturing businesses had two other additions in 2007 with the acquisitions of Vanity Fair Corp. And Richline Group. Vanity Fair Corp. Berkshire acquired the intimate apparel business of Vanity Fair Corp. On April 1, 2007, though it was announced in 2006. The business was tucked into Fruit of the Loom along with Russell Corporation, which was acquired in 2006. Richline Group. This was a newly formed jewelry supplier. Dennis Ulrich, a vendor of Benbridge, contacted Buffett with a plan to combine his company, Bell Oro, with that of Orofin, another supplier, to form Richline. The deal came about after Buffett visited a Benbridge jewelry store in Seattle for a talk to vendors. Richline then made two smaller acquisitions. Buffett noted that the combined enterprise was far below the threshold normally considered for an acquisition by Berkshire, but he was confident the company would grow and maintain good returns on capital employed. A new business, TTI Incorporated, joined the service segment of the MSR Group on March 30, 2007. TTI is a distributor of electronic components that was founded by Paul Andrews Jr. in the early 1970s. The business was brought to Buffett's attention by John Roach of Fort Worth, Texas. Roach was chairman of Justin Industries, which Berkshire bought in 2000. Beginning in the 1970s, Andrews built the business from $112,000 in revenues to over $1.3 billion by 2007. The company was based in Fort Worth and had distribution centers globally. Berkshire's other service businesses performed well in 2007, with gains coming from the Business Wire acquisition in 2006, in addition to growth from Flight Safety and NetJets, which posted a second consecutive year of profits after struggling the prior year. Buffett noted that Flight Safety trained about 58% of U.S. corporate pilots, and its growth seemed to reflect strong demand. Its revenues and pre-tax profits grew 14% and 20% respectively. The other service businesses as a group earned $968 million on revenues of $7.8 billion, which were up from earnings of $658 million on $5.8 billion of revenues in 2006. The retailing businesses fared less well than service, though they were not without pockets of good and bad. On the whole, pre-tax earnings from the retailing businesses declined 5% to $274 million, with the fall attributed to the jewelry operations. Among the furniture retailers, Nebraska Furniture Mart stood out. In a disastrous year for many furniture retailers, sales at Kansas City increased 8%, while in Omaha the gain was 6%. Buffett reported that each store had sales of over $400 million in 2007, which placed them at the top of home furnishing stores in the U.S. by a big margin. See's also had a good year with pre-tax earnings of $82 million on revenues of $383 million. McLean continued its steady progress. Pre-tax earnings increased 1.3% to $232 million on revenues of $28.1 billion, up 9%. Finance and financial products. Even though the primary driver of earnings in the finance and financial products segment came from Clayton, the housing-related business, earnings were not impacted nearly as much as the building products manufacturers. In fact, earnings at Clayton rose 2.5% to $526 million, even as finance and financial products pre-tax, pre-capital gains income fell 13% to $1 billion. That's because Clayton was both a manufacturer and a financer of homes. A detailed breakdown was not provided, but Clayton's finance operations would have been the primary driver of results. Its year-end outstanding loan balances amounted to $11.1 billion, with good credit quality metrics. Berkshire's leasing businesses, Extra and Court, reported a 39% drop in earnings. Extra was singled out as the primary reason because its utilization of trailers declined considerably during the year. Another examples of economies of scale working in reverse. Another reason for the overall decline in earnings in finance and financial products was the life and annuity business, which swung from a profit of $29 million in 2006 to a $60 million loss in 2007, based on a charge to mortality assumptions on certain contracts. Investments. Berkshire's investment portfolio saw more than its usual glacier pace of change during 2007. Net purchases of equity securities amounted to over $11 billion, funded in part by $3.5 billion of net reductions in fixed maturity investments. Here were the major changes. Elimination of its stake in PetroChina, which netted Berkshire $4 billion, about 5.7 times its original investment, after paying the U.S. government taxes of $1.2 billion. Purchase of a 17.5% stake in Burlington Northern Santa Fe, BNSF Railroad, at a cost of $4.7 billion. Purchase of an 8.1% stake in Kraft Foods at a cost of $4.2 billion. Buffett had teased excitedly and anonymously about two investments, Kraft and BNSF, in his 2006 chairman's letter, but there was no discussion in 2007 and very little at the 2008 shareholders' meeting. Both were destined to play much larger roles at Berkshire in future years. Kraft was the well-known, highly profitable packaged food company Berkshire had owned 2.5 decades before through its investment in General Foods. Buffett did comment on the railroad industry in general at the 2008 shareholders' meeting, stating that the economics had improved significantly from 25 or 30 years before. With less regulation, little new capacity, and a fuel advantage over long hauls compared to trucks, the railroad business was a better business now, but still very capital intensive. Buffett gave away a hint at his expectations for Berkshire at the 2008 annual meeting. He noted that Berkshire would be happy with a 10% premium tax return from its investment portfolio over time, including dividends and capital gains. The admission of the lower expectation was another reminder to shareholders of the difficulty of growing a very large conglomerate at anywhere near the rates of return achieved in the past. Opportunities for Berkshire would still exist. Some major future opportunities were foreshadowed by certain discontinuities Berkshire took advantage of during the year. One was high-grade municipal bonds, a big market, that for a short period traded at yields in the 3% to over 10% range. In hindsight, it is easy to see this event as a precursor to the major market disruptions that would happen over the coming months. A large market like municipal bonds is usually very orderly, with yields moving tightly within any given band of credit quality. That yields temporarily spiked meant liquidity was hard to come by, a foreshock of the coming major financial earthquake. Businesses: the great, the good, and the gruesome. Buffett's 2007 chairman's letter included a lesson on what he saw as the three broad types of businesses. Overall, Buffett and Munger looked for businesses they understood and that had a favorable long-term economics, able and trustworthy management, and a sensible price tag. Within these parameters, they further sorted businesses into great and good, with gruesome businesses to be avoided. Great businesses: possessing an enduring moat, protecting excellent returns on invested capital. Example: See's, a prototype of a dream business. Berkshire paid $25 million for See's in 1972. Over the course of Berkshire's ownership, See's only got better. Its pre-tax return on capital, already very good at over 60%, grew to over 200%. This happened in conjunction with significant growth in revenues. See's was a great business because it earned more with very little investment. To achieve its dramatic growth required incremental investment of just $32 million. Meanwhile, some $1.35 billion in cumulative profit between 1972 and 2007 was sent to Omaha to pay tax and reinvest elsewhere. A dream indeed. The only problem with businesses like See's was that it had very little reinvestment opportunity. See's was limited to a few western states, in addition to the Berkshire faithful. Try as they might, and they did, Berkshire couldn't find ways to materially reinvest in the business at anywhere near the returns earned in the current business. Buffett said it wasn't surprising businesses like See's were rare. He elaborated. Typically, companies that increase their earnings from $5 million to $82 million require, say, $400 million or so of capital investment to finance their growth. That's because growing businesses have both working capital needs that increase in proportion to sales growth and significant requirements for fixed asset investments. A company that needs large increases in capital to engender its growth may well prove to be a satisfactory investment. There is, to follow through on our example, nothing shabby about earning $82 million pre-tax on $400 million of net tangible assets. But that equation for the owner is vastly different from the See's situation. It's far better to have an ever-increasing stream of earnings with virtually no major capital requirements. Ask Microsoft or Google. Good businesses: deliver good benefits to owners but require significant reinvestment of earnings to grow. Example: flight safety. Over the course of Berkshire's ownership, flight safety increased earnings, but only did so by increasing its investment in fixed assets. See Table 7.10. Flight safety simulators, like most investments in fixed assets, were expensive and generated much revenue. Flight safety simulators, like most investments in fixed assets, were expensive and generated much lower revenues per dollar of incremental investment. The slightly outsized increase in earnings compared to fixed assets indicates the company increased its capital efficiency over that time, but it was nothing like the experience at Seas. Buffett laid out the cold truth about good businesses. Consequently, if measured only by economic returns, flight safety is an excellent but not extraordinary business. Its put up more to earn more experience is that faced by most corporations. For example, our large investment in regulated utilities falls squarely in this category. We will earn considerably more money in this business 10 years from now, but we will invest many billions to make it. Berkshire's growing size and the rarity of finding Seas-like businesses of the magnitude needed to move the needle meant its future would be built mainly within the good category. A more capital-intensive business like Mid-American Energy Holdings might fall on the low side of the return spectrum, but still in the good category. Gruesome businesses. The worst sort of business is the one that grows rapidly, requires significant capital to engender the growth, and then earns little or no money. Example: Berkshire's former textile business. Enough said. Marmon. Berkshire's shareholders woke up to a Christmas gift, the announcement of a major new operating subsidiary. Berkshire made many large acquisitions during its 42 years with Buffett at the helm, but the deal inked on Christmas Day 2007 was one of the largest cash purchases for an acquisition in Berkshire's history, $4.5 billion for a 60% initial interest in Marmon. Charlie and I finally earned our paychecks, Buffett joked. The deal would not close until March 18, 2008. Marmon, which will be described more fully in the section on 2008, was a conglomerate of 125 separate businesses across 9 sectors that employed 20,000 people. Berkshire not only ended the year on a high note, but had many reasons to celebrate through 2007. With tens of billions of dollars of surplus cash on hand and a fortress-like balance sheet, Berkshire was well positioned to weather any storm, and the one coming would be a doozy. Chapter 12, 2008 to 2009. 2008. Any account of 2008 necessarily includes the worldwide economic turmoil, considered by many economists as the worst recession since the Great Depression. Since much has been written about the Great Recession of the late 2000s, this book will not attempt to provide a comprehensive explanation. Instead, the focus will remain on Berkshire Hathaway, how Berkshire's businesses managed through the recession, and the ways Berkshire's unique financial strength allowed it to proactively respond to a once-in-a-generation type opportunities. For just the second time under Buffett's leadership, Berkshire's change in book value was negative, declining 9.6%, compared to a 37% fall-off for the S&P 500. Berkshire's relative 27.4% outperformance highlighted its resiliency and focus on insurance and utilities. Neither were highly affected by the economic downturn. To a lesser degree, the strength of its business franchises, both from an operating and balance sheet perspective, protected them and allowed some to use the turmoil to go on the offensive. Still, Berkshire's many businesses tied to the residential construction and retailing sectors were acutely affected. Insurance. Berkshire's insurance group earned $2.8 billion pre-tax, with each of its 4 major segments turning in an underwriting profit. Overall insurance earnings were down from 2007 due to increasing competition, but its continued profitability in the face of various economic challenges proved the group was what Buffett called an economic powerhouse. The insurance group ended the year with $58.5 billion of float, and due to another year of underwriting profits, the 6th consecutive year negative cost float. General Re. General Re earned praise in Buffett's chairman's letter for its outstanding year. Now led by CEO Tad Montross, Gen Re reported favorable runoff in its property lines and profits from current year underwriting. This was a 180-degree reversal from when Gen Re first joined Berkshire and brought years of suffering from past underwriting mistakes. With earned premiums of $6 billion and pre-tax profits of $342 million, down 38% from the year before, its third consecutive year of profits resulted from Gen Re's new culture of underwriting discipline and rejecting unsound risks. The property casualty segment reported an underwriting profit of $163 million on earned premiums of $3.4 billion. Property business included $395 million in favorable loss development, offset by $120 million of current losses stemming largely from Hurricanes Gustav and Ike, as well as storms in Europe. Casualty losses amounted to $112 million in large part due to loss reserve discount accretion and deferred charge amortization, and included unspecified amounts of costs associated with regulatory investigations. General Re also agreed to another reinsurance-to-close transaction with Lloyd's, like the one completed in 2007, for $205 million, which had a neutral effect on underwriting profit in 2008. Gen Re's life health business reported profits of $179 million on earned premiums of $2.6 billion. Berkshire Hathaway Reinsurance Group. BHRG reported its third year of billion-dollar underwriting profits, earning $1.3 billion on premium volume of $5.1 billion. The comparative headline premium numbers were skewed due to the large one-time Equitas transaction in 2007. Premiums that year were $11.9 billion. Retroactive Reinsurance reported another year of red ink, a loss of $414 million. But losses were expected given the large amount of float it generated and the ongoing accounting charges bearing little connection to economic reality. After the large Equitas deal in 2007, premiums fell to just $204 million in 2008. The retroactive reinsurance business was chiefly responsible for the $24.2 billion of float at BHRG at year-end 2008. The catastrophe and individual risk business let premiums fall 39% as increasing industry capacity softened pricing. Even after $270 million of losses from hurricanes Gustav and Ike, the catastrophe and individual risk segment reported significant profits of $776 million in relation to its $955 million premium volume. Profits included $224 million from a contract that would have required Berkshire to purchase up to $4 billion of revenue bonds issued by the Florida Hurricane Catastrophe Fund Finance Corporation under certain conditions. The entire premium went to the bottom line as the $25 billion threshold for losses wasn't met.